anybody else in here?
Hey, Evan. How you doing?
I figured that was absorbed.
All right, good morning, everyone. Good morning. We're going to get started and try to keep everything running on time today. Thanks so much for joining us on behalf of Adam, Elena, and Tomek. I wanted to say thank you for being here. We have a great program thanks to your submissions. We had many high-quality submissions, and I think a very stellar program this year. A few just housekeeping announcements. For the 45-minute sessions, we will have 25 minutes for the author, 10 minutes for the discussant, and 10 minutes for discussion. For the shorter paper sessions, it will be 20 minutes for the author and 5 minutes for open discussion. We have breaks throughout the day, fortunately, some that are 10 minutes and some that are 10 or 20. So you'll have a little bit more time to take a breath. This evening, we have a dinner that's sponsored by the Zellery Real Estate Center at Wharton and the Paul Milstein Center at Columbia, and we are switching up the location this year. So we will be at Batifol at 291 3rd Street, and we'll make another announcement. Then that's at 6:30. If you haven't signed up for the dinner but would like to attend, please come and see me. We can have a list of additions. And just in terms of a final logistics announcement, this is going to be live streamed on YouTube. So our usual good behavior should apply. And more generally, please speak in front of the microphone if you are presenting or if you are asking a question. Please use one of the mics that's around so those that are watching online can hear you. Without any further ado, I will turn it over to Stein, who will be presenting the commercial real estate ecosystem.
Thank you, Ben. Thank you to the organizers for having our paper. This is joint work with Ralph Cohen at the University of Chicago and with Neil Shah, who's here, who's a PhD student of mine at Columbia. So the context of this paper is what's called the Great Rotation, which is basically a migration of risk from public markets to private markets. We see this in the number of publicly traded companies that has been halved. We see this in the amount of dollars of private assets under management that has been rising astronomically. Indeed, pension funds now routinely allocate about a third of their investments to these private and real assets. Now, this matters for valuation because these private and real assets are special. They're traded infrequently, often in bilateral search and matching markets. They are lumpy. They are heterogeneous. For example, a building can only be in one location, so it's by definition, it has a unique location. And then, interestingly, I think to us, there's this ecosystem of quite heterogeneous investors. Some of them are investing across assets. Some of them are specialized in just this specific real or private asset class. And so what we think we need to do is develop a valuation approach that is taking into account these unique features of private and real assets. So that's what we'll do in this paper. It's a valuation as well as a trading model that thinks about how investors are valuing and trading these assets. Our model is going to be reduced form, but in the paper we have a micro foundation in a simple portfolio choice model that features these lumpy real assets that gives rise to an equation that is very similar to the one we'll end up estimating in the data. Our main findings are that the investor composition in this market significantly impacts the pricing of these private assets. That's sort of a departure from our traditional asset pricing frameworks. And then specifically accounting for nonlinearities and interactions between a set of asset characteristics and investor characteristics, as well as macro variables. It's going to be very important for explaining these valuations. We're also going to have a lot to say about the structure of trade, who trades with whom, and why. And then we're going to apply this framework to ask a few counterfactual questions. Before we do that, we're going to show you that the model does well predicting prices out of sample. The type of counterfactuals you can ask with this approach are very detailed. You can ask, for example, what would be the impact of foreigners buying high-quality Manhattan office assets in the year 2023? And so we're going to have a tool that basically allows us to remove these particular buyers from that particular asset and ask what would have happened instead in the absence of those investors. Okay, so as you will have guessed by now, we're going to be thinking about commercial real estate for this paper, but I think the framework we're developing here applies to private credit or municipal bonds, or sort of in general, any asset that's art, any asset that's not traded in liquid public markets. So let me tell you a little bit about the valuation model and the transaction model before I turn to the data. And then most of my time I'll spend on the estimation and the counterfactuals. So the valuation model, we're going to think of a buyer and a seller for a lumpy asset N as having a private valuation that has two components. It has a fundamental component H, which depends not only on the asset characteristics X and T, which we are familiar with from our standard hedonic approaches, but also on the characteristics of the investors, ZIT. It also has a shock, epsilon IT. You could think of that as a latent demand shock. You could think of that as a liquidity shock, maybe an idiosyncratic preference shock for that asset. And later on, we're going to estimate that function H, that fundamental value component, in a flexible functional form. But for now, to fix ideas, let's consider a special case where that function H is a linear function of characteristics that looks a lot like a hedonic model that we all know and love, except that the coefficients on that hedonic, on the hedonics, the prices of the hedonics, are themselves a function of the characteristics of the investors, ZIT. And so if you plug that second equation into the first, what you see is that there's these interaction effects that affect valuations, where we need to think about the interaction effects of investor characteristics and asset characteristics, okay? It turns out that particular model comes out of a micro foundation where there's a mean variance investor that's solving an optimal portfolio problem, deciding whether or not to add a lumpy asset to their pre-existing portfolio. And under some assumptions on conditional means of asset payoffs, conditional variances, and conditional covariances of the lumpy asset payoff with the rest of the portfolio, you get a functional form that looks exactly like this. Okay, so that's all in the paper. So what we observe, we're going to assume that when these two when the buyer and the seller meet each other, they're going to Nash bargain over the price. We're going to assume Nash bargaining weights of 1/2. It doesn't have to be 1/2. We relax this in the paper. We're going to assume 0 transaction costs. It doesn't have to be 0. We relax this in the paper. And so in this simplest case, the price will be the average of the valuation of the buyer and the seller. And so we observe these prices in the data. We're going to try to learn something about these V's or these H's, these fundamental values of the buyer and the seller from the observed prices. So now let me tell you a little bit about the transaction model, right? So this model is going to be motivated by a directed search and matching model where a seller and a buyer meet each other. And we're going to think about, when will a transaction take place? So the probability that a buyer trades with a seller is the product of 3 probabilities. The probability that the seller lists the asset for sale, the probability that conditional on a listing, a particular buyer meets that seller, that's the term in blue, times conditional on a meeting, the probability that a trade actually takes place between that buyer and that seller. So the key term here is that term in blue, the meeting probability. We're going to be parameterizing that meeting probability as a function of the characteristics of the buyer, right? So a particular asset that's listed for sale, how likely is a particular buyer to meet that asset for sale? We're going to say that's going to depend on the size of the buyer. Larger buyers are going to be meeting more assets. There could be a nonlinear component to that if the buyer owns more than 2 assets. It's going to depend on the relative differences between the sizes of the buyer and the seller, some sort of homophily. If a large buyer and a large seller, if they are more likely to meet each other in the data, we're going to be able to capture this way, as well as if the buyer and the seller have traded with each other in the past, right? If there's been a past interaction with them. This last set of variables, these deltas, you can think of those as consideration set variables. They are thinking about how similar is the asset for sale to the assets that are already in the portfolio of that buyer. Okay, so when we're talking about a Chicago office asset, how many Chicago assets does the buyer already have? How many office assets does the buyer already have? How many high quality assets does the buyer already have? So those terms are going to turn out to be crucial. So the data are going to tell us there's a lot of segmentation and a lot of specialization in this market. People who already own a lot of office buildings in Chicago, they're much more likely to buy more office buildings in Chicago than they are to buy office buildings in New York or apartment buildings in Chicago. So that's a little bit about the meeting probability. The transaction probability is basically, are there gains from trade? Conditional on us meeting, we're going to trade if the valuation of the buyer exceeds that of the seller, which under our assumptions is a CDF of a normal distribution. And then finally, that listing probability, we're going to parameterize that as a function of, investor type characteristics, whether the investor is sitting on a paper gain or not, following the work of Genovese and Meyer, for example. We're going to be thinking about year fixed effects in that as well. And basically, at the end of the day, our model is going to generate a certain prediction for the number of transactions, which we're going to match to the observed transactions in the data. Okay. So that describes the model. Let me tell you a little bit about the data. The data are sort of the star of the show here. We have the universe of commercial real estate transactions from Real Capital Analytics between 2001 and 2023, anything over $500,000 in the 4 main real estate sectors: apartments, office, industrial, and retail. We have a long list of asset characteristics. How large is the building? How well occupied is it? How old is it? And so forth. And we know the exact location of the asset. So we could split the US real estate market into 60 roughly metropolitan areas. The key piece of information that's hard to get, though, is the identity of the buyer and the seller. Real Capital Analytics has spent 25 years unraveling the identities of these buyers and sellers because they're all buying these things with LLCs. And so they've basically uncovered who's behind these transactions. And then, once we know who bought or who sold the transactions, we can basically build portfolios at the individual level. And by the end of our sample, we have a pretty good sense of, how many office assets does, Tomek LLC have in New York City, sort of through, we can build it up from the transactions. We're going to complement this micro data with macro data at the MSA level, things like market size, purchasing power, occupancy, and cash flow growth, as well as with quality measured by net effective rent, which is either at the property level or at the fine neighborhood level. Okay, so we're going to bring in data from Comstek and from Fannie Mae to think about, the neighborhood quality or asset level quality. Okay, and the hope is that in combination with these asset characteristics from RCA is going to give us a pretty rich set of covariates at the property level. So all told, we have about 500,000 transactions, $10 trillion in trading volume, and 325,000 unique investors. So let me tell you a little bit about the ecosystem of investors. This paper is called the Commercial Real Estate Ecosystem, after all. It's really sort of a plethora of different types. We have foreign investors, about 11%. We have private equity funds, about 11%. We have REITs, about 10%, publicly listed real estate companies. We have institutional investors. This could be your university endowment, could be your pension fund. We have users, so that could be Amazon owning its own warehouse. We have some rich individuals, and then we have this large group of owner-operator developers. These are the smaller, more local value investors in this space. If they're only active in one market, we'll call them local. If they're active in more than one MSA, we'll call them national. There's a lot of segmentation. I split the commercial real estate space here into 6 similar groups sorted by size. And what we're seeing is that the largest assets, these would be assets over $250 million, are predominantly bought or sold by large institutional investors, by foreigners, by private equity funds, whereas the small buildings, the ones under $5 million, are predominantly bought and sold by these local owner-operator developers and national owner-operator developers. So there's positive assortative matching between the size of the property and the size of the investor. Similarly, in terms of geographic diversification, these local owner-operator developers, by definition, are only active in one market, but even these national owner-operator developers are only typically active in 1 or 2 or 3 markets. The investors that are really, truly geographically diversified, they tend to be these much larger institutional investors, foreign investors, REITs, and so forth. Okay, so there's, again, positive assortative matching. The size of the portfolio is strongly positively correlated with the degree of geographic diversification. The last thing I want to show you about the data in terms of descriptives is how different investors are valuing a couple of characteristics of the asset, and specifically the occupancy rate of the asset and how recently the office asset has been renovated. What we're seeing here is that you have investors like REITs who really like high occupancy buildings. They like full office buildings, and they like new office buildings. Whereas private equity funds, they really like poorly occupied office buildings, and they like buildings that haven't been renovated so recently. Why? Because that's their comparative advantage. They like to renovate these buildings. Blackstone's motto is buy it, fix it, sell it. If there's nothing to fix, there's nothing to do for Blackstone. So you see a lot of heterogeneity, and this goes to the heart of the spirit of the model, which is the same asset with the same characteristics can have a very different value in the hands of different investors. So now let me turn to the estimation. First, the valuation model, right? So remember, we observe prices in the data, and we're trying to learn about these fundamental valuations of the buyer and the seller. We're going to do this with a machine learning method called light gradient boosted machine, which is suited for purpose because it's really, because it's a tree-based method, good at uncovering interactions. And remember, the theory is telling us we care about the interactions between the property characteristics of the buyers and sellers and the asset characteristics. So let me sort of present the main valuation results in this table here. It's good to start with a benchmark. Our benchmark is our linear hedonic valuation model that we've been familiar with since the 1960s, right? Where we basically only have asset features. And so what I'm asking here is this list of asset features, which is actually a quite rich list. How much of the variation of these asset features in a linear hedonic model, how much of the variation in transaction prices can we explain with this list of asset features? And the answer is somewhere between 30 and 50% across these 4 different sectors. Okay, now you could say, now we could add some macro variables. These are like local employment, local office occupancy, and so forth. We can add year fixed effects. We can add market fixed effects. And we end up with, about 50 to 60% explanatory power for all these effects. Now, note that this is in some sense a tough benchmark to beat because the effect of investors could already manifest itself through these year fixed effects and through these market fixed effects. I'm just going to be generous to the linear hedonic model and ascribe all of that to asset characteristics. Okay, I'm going to raise the bar for myself to see whether investor characteristics can beat this benchmark. Now, before I add investor characteristics, I want to first allow for a richer specification in terms of the asset characteristics by allowing for nonlinearities and interaction effects just among the asset characteristics. And you see that that is actually important because these nonlinearities turn out to be important, as well as these interaction effects just among the asset characteristics. They themselves already add somewhere between 12 and 17% R squared. So we get up to about 65 to 75% R squared before we think about investor characteristics. So now the key point is we're now adding these investor characteristics, not only the type, the investor types, is it a private equity fund, is it a REIT, but also all these portfolio characteristics. How many assets do they have in Chicago? How many assets do they have in the office sector? All told, these investor characteristics are very important. They can help us reduce the unexplained variation of the model without investor characteristics by 50%. Okay, so at the end of the day, we end up with being able to explain around 85% of the cross-sectional variation in these transaction prices once we've added these investor characteristics, and again, reducing unexplained variation by half. This is not only true in sample, it's also true out of sample. We try to be very conservative in our hyperparameter choices just to make sure that the patterns we uncover are real. Now, we can then use some SHAP analysis to figure out which are the most important characteristics. And it turns out among all of these characteristics in the model, it's the investor characteristics that come out as the winners. They're even more important than the building characteristics. Again, very much in the spirit of the main point of the paper. There's important nonlinearities, which you wouldn't have uncovered with a linear model. And then in terms of these interaction effects, the most important one is the one between investor size and property size. So large investors like large buildings. They have higher valuations for large buildings. Small investors like small buildings. Small investors do not like large buildings, and large investors do not like small buildings. So again, that's an interaction effect. And it's an important one. It's one that comes out of, that the model suggests we should look into, and this is the key one. So now let me turn to the estimation of the meeting model, of the trading model. So if you think about it, what we would like to do is estimate the likelihood of trades taking place with maximum likelihood. Now that turns out to be computationally, I say intractable or expensive, but it's actually impossible because there's so many combinations for each potential buyer. You would need to evaluate their value for each asset for sale in each period. And not just for the assets for sale, in theory, also for all the assets that are not trading, because you're also trying to explain the non-trades. And so that turns out to be too many combinations. So that the denominator in that maximum likelihood estimation is intractable. And so what we do is we take a page from the computer science literature, because it turns out this is the same problem that LLMs are trying to solve when they're trying to predict the next word in a sentence. Okay, you give a sentence of in English, you block out one word, and you ask the LLM what's the word that was blocked out. In theory, the LLM needs to consider every word in the English dictionary to predict that missing word. But it turns out in practice, it does not. It's enough to take 1,000 random words from the English dictionary and basically add the real word, add the 1,000 negative words that it is not, and it turns out that's a consistent estimator for that problem. And so we're going to use that same idea here. Instead of evaluating the value of this building for every potential buyer, we can sample just a true buyer and 1,000 by people that it was not, and it turns out that's a much simpler estimation problem, one that's consistent, that's asymptotically normal, and one that converges to the maximum likelihood estimator as the cardinality of that negative set grows to the full universe of potential buyers. So it turns out with 1,000 buyers, our estimation stabilizes. These are the estimates associated with that meeting model that I showed you earlier, and in particular, these consideration set variables that I emphasized before. How similar is this asset for sale to your existing assets in terms of the size, in terms of the quality, in terms of the market, turn out to be crucial and turn out to be sort of indicative of a lot of segmentation and a lot of specialization in this market. We can then ask, how well does the model predict the true buyer? How many times does it actually get the right guy out of these 1,000 potential buyers? And the answer is about 25% of the time, which is a lot relative to a random search benchmark, where with 1,000 buyers, the model would have a 0.1% probability of getting the true guy. Here, our model gets a lift of about 200x in terms of identifying the right buyer. Listing probabilities that are estimated from our model look like this. There's sort of a decline in listing probabilities during the GFC, naturally during COVID, and then during the interest rate hike of 2022, 2023. Okay, so now let me turn to some applications of this framework. The first thing we want to do is convince you that this model actually is robust, that it works out of sample, and that it generates stable predictions. So for that, we're going to ask a very simple question. If you estimate the model up until a certain date, let's say 2016, how well does the model do in predicting prices of assets that traded the following year in 2017? The model has not seen any data past 2016. How well does it predict the prices of the assets that we know sold in 2017? And we're going to compare our model to the linear hedonic model. That's as the benchmark. And so what this first chart shows you is that our model is closer to our model's prediction is closer to the actual transaction price 70% of the time relative to the linear hedonic model. And it reduces the pricing error relative to the linear hedonic model by about half, by about 50%. Okay? And that's true regardless of sort of whether we need to predict the inputs in that prediction model as well as the parameters of the model. So that hopefully should give us some confidence in these counterfactuals that we're about to do. I'm going to just focus on one in the interest of time, where we think about the role of foreign buyers. But the paper has several more where we think about REITs selling just before the GFC to private equity funds, or where we think about the private equity funds currently sitting on a lot of dry powder, a lot of cash that they're waiting to deploy. What would be the impact of that? So for these foreign purchases, we see in our transactions data that the foreigners are buying millions and millions of dollars worth of U.S. real estate, especially in this period, 2013 to 2023, in the second half of our sample. These are Middle Eastern sovereign wealth funds, Canadian pension plans, and so forth. And so we want to ask, what's the impact of those investor flows onto prices and onto trading patterns? And in particular, we're also interested in understanding the substitution patterns, right? So the idea is that if the Middle Eastern sovereign wealth fund buys this Manhattan trophy asset, now the local pension fund, TIAA-CREF, can no longer buy that same asset. What does it buy instead? So we're going to use our model to identify who gets displaced by this foreign purchase, and then look in the data at what did that displaced investor buy instead. Okay, so we can now think about substitution patterns across asset sizes, across asset sectors, across geographies. And what we find is that the displaced investors, so again, we're focused here on Manhattan office, and we're actually looking at the top quartile of the Manhattan office market. So call them Manhattan trophy assets. So we know these foreigners bought a lot of these Manhattan trophy assets. Now the question is, what substitution did that trigger? And what we find is that the people who got displaced, they still predominantly buy office. They no longer buy that Manhattan trophy office because they got displaced, but they still buy office. 60 to 70% of their purchases are office. There's a bit of substitution towards other sectors. They still buy large assets. The blue bar tells us that they still buy the largest assets, but there is some substitution towards slightly smaller assets. So they get crowded out of these very large office properties. They buy slightly smaller office properties. And they're, for the most part, stay in Manhattan. So there's limited geographic substitutability. There's some substitutability towards other superstar markets, LA, San Francisco, Washington, Boston, but not that much. So sort of the finding here is that there's actually not a whole lot of substitution. There's these Manhattan office specialists, and they get displaced. And what do? They buy slightly smaller Manhattan office properties. Okay, they don't buy a Chicago multifamily. Second question is, what did this purchase activity by foreign buyers do to prices, right? And so for that, we developed this tool called a potential price distribution, which essentially for each building, for each Manhattan trophy office asset, lets us simulate, what would have happened, who would have bought this asset, and at what price in the absence of foreign buyers in the market, right? So we can simulate our model once in the presence of these foreign buyers. We can simulate it once in the absence of these foreign buyers. Both of these models generate not only a different mean price, but an entirely different price distribution. And we can then ask what happens to this price distribution. What we're finding is that the mean of that distribution shifts down by about 5.5%. What that's telling us is that these foreigners had relatively high valuations for these office assets because in their absence, the prices would be 5.5% lower. If we focus just on if we define trophy office not to be the top 25%, but the top 10%, these price effects are even larger, 7.5%. Okay. And again, the model speaks not only to the mean price, but also to the price risk, the distribution of prices around that mean. So let me conclude. I think I'm almost out of time. We developed this new asset pricing framework for private and real assets, where the key insight is that investor characteristics are an important new hedonic. That's sort of a missing hedonic in our standard hedonic models. It recognizes the bilateral nature of trade and the uniqueness of each asset. And that the composition of the investor base basically matters for the expected price of the asset, but also for the distribution of prices, for how unlucky you could be if the wrong buyers showed up, for the price risk. And more generally, we think this is an interesting framework in light of the growing importance of private and real asset markets, especially now that this asset class is about to open up to retail investors coming to a pension fund near you. Thank you very much.
Great, thanks. And our discussant will be Jacob.
Awesome. All right. This is an incredibly rich paper to read and to think about. And my understanding is it goes back 10 years in terms of the initial inception. I remember Stein presenting very early versions of who invests where and maybe speculatively why about 10 years ago when he came to visit in Chapel Hill. So much of our work relies on understanding and controlling for asset value. In other words, searching for a compelling baseline, right? And then maybe doing some kind of analysis around that baseline, controlling for things like value. That's why we use the hedonic models. The thing is that search theory tells us that ownership and investor composition matters for pricing. But this is the first paper to take this really seriously at a granular level. In other words, to take the classical hedonic type model that we use for a baseline in our typical work, but also incorporate what search theory tells us we need to do. I would say that Christoph, sitting right over there, has done a little bit work in that dimension of trying to tie search models to empirical work. I've also had a stab at that, but that was, I'd say, in a much sort of higher level way. This is very, very granular stuff. So it's very impressive. Now, there's also an investor valuation component, which of course you need. If you're going to build a search model, you have to model what each investor thinks the property or the asset is worth, and then you model the meeting. So they model the meeting, but they also have to model the valuation. And one of the things about linear hedonic models is they miss key interactions that are nonlinear, and there are just too many of these. And this is where machine learning comes in. It's they do a lot of hard work to build a granular income type of attribute, something they call NER, which is novel. But I would say that others have incorporated both machine learning nonlinearities and income components, what we in commercial real estate call cap rates, into these types of models. But they just work a lot harder at it. So anyways, bottom line, this is a very rich paper, and I'm probably not going to do it justice. I'll talk a little bit about what I believe it is and what it may not be. And again, that's entirely subjective. There are tons of cool applications. There are limitations. I'll try and point them out. And I think there's also plenty of room to take this to a next level, which is great for the rest of us. It leaves something on the table. I'll try and unpack a few things and maybe add some applications and refinements that I thought about. So let's start with one of the things that this paper is and it isn't. So it is a benchmark type model for valuation that incorporates, as I said, some key elements from search theory. But I wouldn't say that it is competitive with AVMs on point accuracy. So what you can see up here, I think, does this show anything? No, I can't really, very weak laser. Never mind. We can see up there, Zillow has about a standard error of predictions of about 10% on off-listed, off-market type properties. In commercial real estate and some of my work, and there's some other work as well, it looks like appraisers can hit about a 12% standard deviation on valuation, on appraisal, of course. The Green Street, an consulting and advisory firm on commercial real estate, has an AVM. They call the AVM Pro. They hit about 18%. So the KSV out of sample standard errors are about twice as large. And this is something that you can infer from the work in section 7.2. So it's not clear that the value here is sort of beating the, leading, say, appraisers or Green Street's AVMs, because Green Street has a ton of data, which we just do not. I mean, they spend millions of dollars on data every year. So we just don't have that. And what they, the 30% they get it with relatively sparse amount of data. So again, I don't think we should look down our noses at that. However, I think to me that emphasizes that the value here lies in strengthening the empirical connection between search theory and price discovery, using this kind of thing in our own studies, but not yet, to maybe have cutting edge point prediction. There may be a way to do this, but I don't think that's what this paper is. So now the investor identity here adds a huge amount. This is what Stein had shown us, to the academic type hedonic linear model, and even the non-linear model that uses traditional type of variables. I think an interesting question is whether some of that is baked in to the valuations that appraisers already do. So we saw on the previous slides, appraisers do a significantly better job. Why? I mean, they do discounted cash flow analysis, they use some comps, et cetera. So I think one question for me in my mind, an academic question, is the information that appraisers use, does it already bake in the investor component? In other words, would we be able to help the appraisers by marrying the kind of thinking of search principles that Stein and his co-authors bring to the table to what the appraisers already do? And by the way, this is testable using something like NCREIF data, because they have the appraisals over there, and there may be enough information there that one could actually ask this question successfully. I'd say that my biggest concern regarding this paper lies around the counterfactual analysis. And so here's the thing, is that in the paper, at least as far as I understood, model valuation is independent of key search factors. In particular, the model valuation is independent of the distribution and valuation of other buyer and sellers who are in the market. Why is this important? It's important because it misses a really important search feedback in equilibrium through what you can call a search option channel and a future sale option channel. Let me try and explain this succinctly using the example that Stein gave about foreign investors that say we're going to take out the foreign investors and do counterfactual analysis, those foreign investors in Manhattan between 2013 and 2018. So they come up with a 5% sort of decline in price if we were to do that. But that doesn't include two kinds of effects. The first effect is the search value effect. If I'm a domestic buyer and I'm relatively low valuation, you just took out all the high valuation people out of the market, well, my search value has just gone up. That means I'm more likely to walk away from a seller because I can continue searching, which means I will not be willing to offer as much money. So that's a search value component. Moreover, if I buy, the foreign investors won't be in the market anymore. So my sale option goes down too. Both of these things point at an increased reduction in price than what they actually estimate. So what they estimate, you can look at as a kind of a upper bound on that price reaction, but we have to contextualize it because that feedback is missing as far as I understand it from the model. Now, why do they leave that out? I'm guessing because it's really hard to estimate. They do a sequential estimation, first evaluation of the investors, then the meeting model. But if you're going to be faithful to equilibrium, you have to do that simultaneously, and that's incredibly hard. So I'd say that still, there's a lot of room for really cool applications by focusing on what the model predicts and then looking at the residual structure. So let me give you an example again with the foreign capital moving in. So suppose that we're in 2013, we think that foreign capital is starting to move in. What are we going to see? Well, what we're going to see is that the domestic buyers, when they're buying, are probably going to have their residuals be a little bit more positive than we would otherwise think. They're going to cluster a little bit more. So again, we could look at the residuals from their model and infer from that equilibrium dynamics, which I think is really cool. Now, they do look at various bargaining components in their search model. For instance, they use a Nash split when they have the meetings. They also try 40-60 split buyer seller or 60-40 split seller buyer. But this assumes that bargaining power is constant across time and across market. That's not how I believe it's actually distributed. So you have tight or homogeneous markets in some places, and what that's going to do, it's going to make the seller get a larger split. Why? In a tight or homogeneous market, it's going to look more like an auction. What happens in an auction when you have a lot of buyers? Effectively, the seller gets a larger split with whomever they end up transacting. Now, in the thin heterogeneous model, that tends to be more bilateral negotiation model. Well, there, it's going to probably look a little bit more like Nash. And so this is testable. We could look at the residuals from that model and look at whether they're a function of tight versus tight homogeneous market versus thin heterogeneous and see if there's a pattern to the residuals. So there's really cool stuff that we can do with this. How do we take this to the next level? There's some really interesting other applications you could do. You could do event studies around interesting shocks, like a really unexpected low probability entry of Blackstone into a small market and see whether that impacts, again, the residuals, whether we get some clustering there and think about what happens there. We could do cross-sectional studies like real estate private equity self-dealing, right? When they basically sell to themselves, the residuals are going to be higher than you'd expect as well. So there's really cool things you could do with this model, even though some of that equilibrium stuff is left up. Does a KSV, that's the initials of the co-authors, based REIT NAV, does it lag the same way that standard NAV lags REIT prices? Can we use this model to do counterfactuals at the margin where the equilibrium feedback is not as important? For instance, think about highest and best use, zoning, public-private partnerships to ask, gee, would this rezoning change things in a beneficial way for various, in terms of value, et cetera? Anyways, there are other future refinements that can be done for future papers. They can include listing data and time on market because they do talk in the paper about effective probability of listing. They can include that search theoretic feedback, but that's probably going to be a very heavy lift because of the simultaneous estimation that has to happen. And they can also potentially improve counterparty selection a little further, but that's something maybe for offline. I'll say this. This is the kind of paper that has so many tables and so many figures that I kind of want to show to my MBA students. So that it's contributing not only to us, I think it's contributing much more broadly. And it's just lots of great ideas that just pop right out of this thing. So thank you.
All right, we have time for some questions.
Two comments. The first is, in thin markets like this, I think there's good reason to think that market makers are a lot more important. Every time I talk to someone in commercial real estate, they insist to me that brokers play a really, really big role in these markets relative to residential real estate and add a lot more value relative to residential real estate. And I wonder whether the really good job you're doing identifying the buyer is really replicating what the broker is doing in some econometric way. And that might explain why you don't need to sample so many people. And so I would think a little bit harder about brokers, especially because I think random search does break down a little bit. The second thing is, I feel like there's another omitted variable, which is how much capital a buyer has, whether they're doing some sort of tax exchange for a building or able to mortgage one of their other properties or, whatever it is, raising money if they're a REIT. And so I wonder how that kind of omitted variable of capital availability plays into things, but great paper.
I'm very glad that you did this. I mean, this is an amazing asset and it's a fascinating thing. One of the things that's interesting is that whereas from the perspective of normal finance papers, this asset seems really idiosyncratic and sort of kludgy, right? Relative to other forms of physical investment, it's actually pretty homogeneous and it's actually pretty fungible in a way that a factory is not, which is why, of course, real estate is debt financed long before factories are in the general story of economic development. And I wonder, as you think about this, like, should asymmetries of information be playing a larger role? Asymmetries of information, which could be, as Adam suggested, about zoning, or could be something else. And how should I think about management, reallocation of the asset, the division between ownership and control, all of the other things which play out with companies, but may or may not be a big deal here. Last point. In Resi, right, we think that places that have a lot of new buildings, like, you kind of know what the price is because all the buildings are the same, right? You go around like Plano, Texas, and all the houses are the same, and you kind of know what those things should be. Like in New York, you don't know what anything should be. You're certainly not in Boston because, like, they're all idiosyncratic. Is there a version of that which is also true in commercial as well, in the sense of, like, if I built up a massive amount of office buildings in some growing place, are they all kind of the same? And so we don't see the search being a big deal. Whereas in New York, we're like, oh boy, do you have craziness in terms of office, is this particular deal.
Sorry. I had a question about the interpretation of the hedonic when you put in investor characteristics. There's kind of an old literature in urban going back to Yinger telling us basically we shouldn't put buyer and seller characteristics in a hedonic. The Yinger critique is effectively that if you put them in, what you estimate or identify is some sort of weighted average of an equilibrium price function and Hicksian demand functions, and you're getting an average of those, and it's kind of hard to interpret what exactly you have. And maybe it's just as simple as saying what you want to do is make predictions rather than get a kind of a estimated deeper object. But question.
All right. Someone take 2 minutes.
Sure. Thank you. First of all, thanks to Jacob for excellent discussion. Just a few short responses to some of the comments. So I think, Adam, on the role of brokers, I think it's an important point. If we had better brokerage data, we could formally incorporate that somehow. I mean, right now, our meeting model really should be sort of interpreted as the outcome of that whole intermediation process, including the role of brokers. And I mean, obviously, that's a bit reduced form. But again, I think that's an interesting direction to push and to extend this. I'm sympathetic to your point about capital, right? So we're really thinking here of unlevered valuation of these assets, but there's a lot of heterogeneity in financing as well, and different sources of capital. So again, that's, I think, a very interesting direction to go to add a whole other layer of heterogeneity in terms of how are these different types of investors financing their investments. So I think interesting point. Ed, I'm glad you brought up the sort of fungibility of commercial real estate relative to, let's say, private firm assets, because I think, to me, that suggests that this type of framework could be valuable for private firm valuation as well. I think in terms of the management of the asset, I think there's a lot of heterogeneity in the ability to do so. In our little micro foundation, we sort of, that's one of the sources of heterogeneity that we allow for. Blackstone may just be better at converting an office building into residential assets than a REIT might be. So I think there's sort of room to estimate that more structurally in the future. And then in terms of the new supply, I think it's an interesting question. Like, if there's a lot of, we could maybe look at the residuals, look at places where there was additional supply of relatively homogeneous stock, and see whether that shows up in sort of the shape of the residuals that come out of the model. I mean, I think, Alvin, I need to think harder about this critique. I mean, sort of our sense is that we almost came at this from the opposite perspective, which is it seems strange that that there is no role for investor characteristics in the hedonics, and so a lot of our hedonic estimates could be contaminated by investor composition effects. But I will think harder about that question. Thank you so much.
All right. Thanks very much, Stein. We'll be back at 9:25.
Thanks.
All right, please take your seats. We are going to keep this train running on time. All right, thanks. Please take your seats. All right, thank you, everybody. Our next paper is Private Provision of Housing Assistance, Impacts on Targeting, and Hector Blanco is presenting. Thanks.
Great, thank you so much. Hello, everyone. So first, thank to the organizers again for including this paper in the program. I'm very excited to be presenting this joint work with Ellie Lockhead, who is also here in the room with us under the title Private Provision of Housing Assistance, Impacts on Targeting. So this paper starts from the observation that U.S. housing assistance has gradually shifted from public provision towards private provision through private markets. So here in this graph, you can see how public housing used to be the major housing assistance program in the US, and nowadays the two major housing assistance programs are the Housing Choice Voucher Program and the Low-Income Housing Tax Credit Program, which are privately provided. So in this paper, we're going to be interested in studying what is the impact of this shift from public to private provision of housing assistance on program targeting, that is the type of households that are being served under these programs. And here we're going to be focusing on at least two reasons that we may expect this effect on targeting, which are grounded on the public finance literature. The first reason relates to the public versus private provision of government services, which argues that private managers may have incentives to reduce costs along non-contracted aspects of the good, which could negatively affect the quality of the good or service. So in the case of housing assistance, you may be thinking about building quality. However, when we think about public housing is already associated with low building quality, so that may not be the primary concern. However, we may be more concerned about the new private managers considering costs when deciding who to admit, who to retain, and who to remove from the property. And the second type of argument, which is going to prove to be important in our case, is the fact that this shift toward private provision may also impact the self-targeting of households as the service quality changes with this shift. So in the case of housing assistance, these households are going to be taking decisions on whether to apply to housing assistance at all or whether to exit from the program that they are part of. So we're going to be examining these questions in a very specific empirical setting, which is the Rental Assistance Demonstration Program. So this program, which I'm going to call RAD from now on, is part of the most recent stage of this policy shift from public to private. So this happened in the 2010s. And the aim of this program was to address the severe backlog in capital repairs of public housing. So the way this works, and I'm going to provide more details later, is that RAD allows public housing authorities to convert these public housing units to project-based vouchers in order to leverage private funds for the rehabilitation of these units. And an important aspect for our paper is going to be that RAD often involves a change or a transfer in the ownership or management of these properties to private entities, which is going to give this shift to private provision that we're interested in. And we're going to be interested in three main mechanisms through which this RAD program may affect tenant composition and program targeting. One is all of these manager-driven effects that I have explained in the previous slide, which is private managers may cream scheme these households based on their cost. A second type of mechanism is tenant-driven mechanisms, these self-targeting stories. So in this case, RAD improves housing quality. So you may expect the low-need households to remain in these properties potentially. Plus, a specific aspect of this program is that this program offers incumbent tenants the possibility to live with a tenant-based voucher. So we're going to use this to study the preferences of tenant-based versus place-based assistance for these households. And finally, and this is more of a programmatic aspect of this program, is that by shifting people from public housing to project-based vouchers, this is also changing income eligibility thresholds for the new people who moving into these units. So this will automatically be lower income. So we should expect some low income, some shift towards lower income households under this program. So just to clarify ideas, our first research question is going to be, what is the impact of this RAD program on tenant composition and thus program targeting? Our empirical strategy is going to be a stack difference in difference design that uses this quasi-exogenous variation in timing of the conversion of these projects. And we're going to be focusing on those projects that were converted from 2014 to 2023. We're going to have nationwide data from HUD, of these properties and also on characteristics of the households. And our main analyses are going to examine how tenant characteristics evolve around the time of conversion. And then we're going to turn to the second question: what are the mechanisms driving the results that we'll find? And then we're going to try to remove the effects coming from eligibility changes, because these effects are more mechanical by the change of wait lists. And we're going to do so by focusing on incumbent tenants. So by looking at incumbent tenants, we're going to try to provide evidence first on manager-driven effects. So we're going to exploit the fact that some of these properties end up being controlled by PHAs, but others end up being controlled by private entities. So there's some variation along this margin. And then we're going to also look at tenant-driven effects by studying the characteristics of those households that move out from these projects and who takes up the voucher option. So just to give you a preview of the results, the headline result of this paper is that RAD actually leads to lower income households living at the converted developments over time. On average, we observe a decline in average incomes of 5% from baseline. And a perhaps surprising fact is that not all of this is driven by this change in waitlists, that change to waitlists that are with lower income eligibility thresholds under the project-based voucher program. Because when we focus on incumbent tenants, we observe a similar decline in the average income on those tenants that remain in the property over time. So when we look at the mechanisms, we're going to look first at manager-driven effects, as I said, and we observe that these income declines are very similar for those properties that end up being controlled by private entities versus the PHA. So we don't observe any evidence for this. However, when we look at tenant-driven effects, we see that higher income incumbents are the ones that may be driving these income declines, since at the time of the conversion, they are more likely to exit without a voucher, signaling, and we will argue that this will be probably because of rehabilitation disruption. And second, we see that these higher income households are also more likely to take up the voucher option and move to lower poverty neighborhoods. So overall, in this program, tenant composition changes. It is not just mechanical due to the change in wait lists, but also partly behavioral. And we will argue that this is mostly coming from tenant self-targeting rather than manager-driven effects. So we have several contributions to the literature. I've already talked a little bit about the public finance literature on public versus private provision of government goods. And we also contribute to the targeting literature. Here we extend these literatures to the housing assistance case. And also we are particularly focused on program targeting, which is something that has been underexplored in the public versus private provision literature. And then we also contribute to a long list of papers working on the effects of public housing. They mostly focus on neighborhood effects, or what happens when you give a voucher to someone who already lives in public housing. Here, we're going to actually look at the households who remain in these public housing projects after there's a change in management or there's this rehabilitation going on. Okay. Good. So let me start with a little bit of the background for this project. So overall, when we think about the public housing program in the US and targeting, it is important to know that the public housing program started by targeting working families that were very strictly screened, but over the decade, due to eligibility changes, it ended up housing the mostly very low-income households. And this led to this association with poverty being concentrated around the public housing projects, which fueled also this perception that public housing had failed. And at the same time, and due to the gradual disinvestment from the government, there was this backlog of severe capital repairs that built up in the housing stock that is now estimated at $170 billion. And the early response to these challenges from the government was to pass this Hope 6 program that many of you are familiar with and have studied, which demolished over 100,000 public housing units starting in the 90s of some of the worst public housing projects in the country. Now, we're going to look at the later stage, as I said. So this is the rental assistance demonstration program, which kicks in right after Hope 6, which it was authorized by Congress in 2011. And it takes a radically different path. So instead of demolishing these units, what we're going to do is try to address these capital repairs. And we're going to do so again by converting public housing units into project-based Section 8 vouchers in order to be able to leverage funds from private or other public sources for these long-delayed renovations. And just to give you a sense of scope, over 200,000 units have already been converted through RAD, so this is almost twice as much as in the Hope 6 program. Now, again, RAD often involves this change in ownership or management being transferred to private entities. However, there are a lot of protections in place to make sure that all of these units are kept in the affordable housing stock. So PHAs, for example, are required to have a formal stake in the property. This could be by, for example, keeping a long-term lease or also by being involved in day-to-day operations. So in many cases, PHAs may keep this control of the properties, and also contracts must be renewed upon expiration. This program also contemplates very stringent protections for the tenants who lived at these developments before conversions. So they have the right to stay, or if they're temporarily relocated because of this rehabilitation, they have the right to return. They also have guaranteed lease renewals and good cause eviction protections. And finally, something that, again, we're going to use in the mechanism section is that after 1 to 2 years, tenants can request a tenants-based housing choice voucher and leave the property with this tenant-based voucher, okay? So just for you to have some pictures in mind, so these are two examples of RAD conversions, one in Atlanta and one in Chicago. And what I want you to keep in mind is that there are some households that were living here under the public housing program. Now, after the RAD conversion, they might experience some rehabilitation disruption, and then they will be switched, and now they will have a project-based voucher. And potentially, a new manager is going to come in, and this manager may be a private entity manager. Okay. So let me start to talk a little bit about the data. So we use administrative data coming from HUD. There are two main data sets that we're using here. One refers to these RAD conversions. So we have address level information for each specific unit that was converted and also information about their conversion. Now, for today, we're going to be focusing on a subset of 900 developments that did not experience new construction. And this is because for the developments that experience new construction, this usually comes with changes in addresses, which makes it a little bit more difficult to track the original development over time. So just to keep a clean data set, we're going to focus on this subset. However, we have extended the analysis to all of the developments, and we find very similar results. And then we're going to merge this with household level administrative data from HUD as well that contains all of the demographics and programmatic actions for these households. So this is recertifications, moves in, moves out, and these not only for the public housing program. We also have this for the housing choice voucher program and for the project-based rental assistance program. Now, for the purposes of today, we're going to consider that the household has moved out of a development if that move is permanent. That is, if a household temporarily relocates due to rehabilitation, we're just going to keep it as in the original development because they end up coming back, okay? As an empirical strategy, again, we're going to use a stack difference in difference, where we're going to compare the evolution of tenant characteristics over time in earlier converted developments versus later converted developments, which are going to be our control group. The identifying assumption here is that the timing of conversion is quasi-exogenous and is not correlated with development characteristics. We think that this is a reasonable assumption. It usually takes years for PHAs to get approved for conversion. It involves a certain bit of interaction with HUD and presenting financial plans and administrative plans. But to test it more formally, on the right-hand side picture, we regress the year when these developments were converted on several development characteristics. And as you can see, there is no single characteristic that is statistically significant. So we feel reassured that this is a plausible empirical strategy. Now, more formally, we're going to build a stack data set. So for today, we're going to consider as treated those developments that were converted between 2014 and 17. And those that were converted between 2021 and 23, we're going to use as controls. So in all of the pictures that I'm going to show today, this is going to be a balance panel. We're going to have 5 years of pre-treatment and 5 years of post-treatment. And we're going to estimate the usual diff and diff specification. We're going to be interested in the coefficient on the interaction between event years and a dummy for whether a project is treated within the stack. We're going to include development by stack fixed effects and year by stack fixed effects. And then when we use counts like population flows as an outcome, we're going to estimate this equation by Poisson to the maximum likelihood. Great, so let's start with some of our main results. So first, we're going to look at how population changes around the time of conversion. We're going to start by looking at total population. Again, this is the result of a Poisson regression. So here you can see that in the pre-treatment period, there are no visible pre-trends. However, at the time of conversion, there's this sudden drop in population at these developments that persists in year 1. This is plausibly due to relocation. And then it comes back to the original level. And in the long run, it even seems that these developments house even more households than at baseline. This is plausibly because there are some households that are filling units that were previously vacant before conversion. Now we can do the same with the number of moves in and moves out. So if we look at moves in panel A, we see that there's this sudden drop in moves in year 0. Again, this might be because they're rehabilitated in the building, so there's less scope for someone to move in already. Moves in start being positive right after, and then they return to their baseline level afterwards. When we look at moves out, we see these spikes in moves out at year 0. Indicating relocation. Now, here it's important to say that most of these moves are facilitated by PHA. So most of these moves will be to other HUD-assisted programs. Okay, so this is not that they're kicking out people from programs overall in general. Then moves out decrease slightly after the conversion and go back to their natural levels. So one thing that I want to point out here is that when we look specifically at moves out with a voucher, we observe that 2 years after conversion, which is when it becomes available, we observe that voucher moves are 40% more likely to happen. So it means that there are people who are actually taking up this voucher option. Now we're going to go to the type of main graph that we're going to be concerned for in this paper to talk about program targeting, which is using annual income of the households as the outcome variable. We're going to have other outcomes in the paper, but today we're just going to focus on income. So when we look at the average income, we see that there's a sudden decrease in the average income of the households who remain at these properties right after the conversion, and it stabilized at around $800, which is a 5% income decline from the baseline. Now, this is partly driven because part of these households do not earn any wage income, and we also observe changes in other characteristics. Again, these details are in the paper, but we observe that households are more likely to have a member with a disability, or they are less likely to have children over time. We can do the same with moves in and moves out again. So moves in, we look at when we look at moves in, we need to think about this change in wait list to a lower income eligibility wait list. So when we use annual income as the outcome, we see this sharp decrease that is expected in annual income. And then when we look at moves out, it seems that there's not much going on except for year 0, in which we will see that in year 0, there's this increase or the households that are more likely to move out from these developments are households that have higher incomes. I'm going to come back to this effect in moves out at the 0 year afterwards in the mechanisms. Good. So let's turn into talking about the mechanisms. So remember, there are 3 mechanisms that we are interested in talking about to explain this declining income over time. One is manager-driven effects. So this comes from a public versus private public finance literature. Another one is tenant-driven effects. Tenants engaging in self-targeting. And then there's the income eligibility changes that are just mechanical because of how the program is designed. So the next thing that we're gonna do is to try to remove this third effect, because again, this is just mechanical and we're more interested in effects 1 and 2 that are economically more interesting. And we're gonna do so by focusing our analysis on incumbent households. So those who lived at the development before its conversion. And that's what we do in panel A here. So in panel A, we're looking at different incumbent cohorts. So those who lived in the development in year -4, -3, or -2. And we generally see a very similar pattern. For those incumbents that remain over time in these buildings, on average, they have lower income. And it's a very similar quantity as we saw before, so about $800 less. Another question that you may have is that maybe the income of these incumbents is changing itself. So they are making less money over time for whatever reason. So we test this hypothesis in panel B by subsetting the sample to incumbents that also stay for the entire post-treatment period to check that their incomes are not changing. And you see that there's no effect there. So it's not driven by their incomes, it's driven by the fact that some incumbents that are higher income decide to move out of these properties. And then we reach the manager-driven effects. This is the second mechanism that we had in mind. And again, just to refresh you, the RAD program involves often this transfer of management or ownership. We have data from a hat that for each of these RAD converted properties, we know who is running the day-to-day operations, whether it is the PHA themselves or whether it is a private entity. So we run the same analysis using average income in the right-hand side graph to check whether we observe the similar income decline. So in dark blue, you have PHA controlled properties, and in light blue, you have private entity controlled properties. And you see that there's a very similar income decline between the two. And in fact, this is not statistically significant different from zero, the difference. Okay, so this doesn't seem to be driven by managers. Now, one thing that we do observe that is different between the manager type is the number of moves out with a voucher. So in panel A, I'm using the count of voucher moves over time. And you can see that for PHA-controlled properties, there's an increase. So this means that PHAs are encouraging or facilitating more this type of moves for households. And in panel B, another concern that you may have is that potentially private entities are terminating more aggressively these contracts and kicking people out of assistance by, for example, evicting them. And we test this by looking at the number of moves without any HUD assistance, and we see that there is no real difference between both of them, at least in year 0. So it doesn't seem that private entities are more aggressive in terminating individuals. Okay, so manager-driven effects, it doesn't seem to be a big part of the story. Now let's turn to tenant-driven effects. Is it possible that this declining income is explained by tenants that are higher income self-selecting out of these properties? We think that there are two shocks where we may be able to look at this. First is in year 0, higher income households may decide to leave because of the rehabilitation disruption. It often involves relocating while your unit is being renovated. And the second point in time is when the voucher option becomes available, which is in years 2 and after. So to study this, we're going to focus on a set of incumbents who were living at these developments in year -1. And we're going to be looking at what are the characteristics of people who are moving out in, let's say, by year 1, when there's only this rehabilitation disruption, compared to those that are staying. Okay, this will tell us something about rehabilitation disruption. And if we look by year 5, this will tell us something about the voucher option. Okay, so this is going to be a difference in the sense that we're going to be comparing those who exit versus stay across treated versus control developments, okay, at a given point in time. So this is what we see in the table. So in this table, in column 1, we check what are the characteristics of exiters by year 1, when voucher is still not an option. And we see that for those who move out with other HUD assistance that is not a voucher, and those who move out without any HUD assistance, they're on average 20% higher income. So it seems that if our hypothesis is true, and this is due to rehabilitation disruption, this is pushing out people who are higher income. And then by year 5 in the second column, we see that those who are more likely to take out the voucher option when it becomes available are significantly higher income, about 15% higher income. Okay. So overall, this result, together with the stringent tenant protection, makes us think that this is not driven by manager behavior, but by the self-targeting mechanism by households, by which higher income households self-select out of public housing. And there are two reasons why. So first, we think it's this rehabilitation disruption, which may act as an ordeal mechanism in the Nichols-Hauser language in public finance. And the second is that people, these higher income individuals, may have a preference for tenant-based vouchers as opposed to place-based assistance, because, for example, they may perceive this as providing a higher quality good, for example, better neighborhood or schools. And another reason of why high-income households may be taking up these tenant-based vouchers is because they are more likely to successfully lease up a unit, which has been found to be a problem recently since success rates are only 60%. So we look to see where these tenant-based voucher takers are going. We look at the census tract poverty rates, and we see that more than half of them move to census tracts that are at least 5 percentage points lower poverty rates than their origin census tract. So they use it to move to these better neighborhoods. Now, let me just conclude. So in this paper, we started with the question of whether the private provision of housing assistance may change who is served and not just the service or good quality. In RAD, we find that tenants are lower income after conversion, and this is not only due to eligibility changes. We find no direct evidence of manager-driven effects. We think that this is plausibly due to the very stringent tenant protections. And we find some evidence of tenant self-targeting. Higher income households may leave out due to rehabilitation disruption, which may act as an ordeal mechanism to households that are on the margin of living. It pushes them out eventually. And then we find some preference of these higher income households to take up this tenant-based voucher instead of this place-based assistance, which we think has policy relevant implications as we keep moving from this public toward private provision system in the US, especially toward vouchers. So that was all, and thank you so much.
Great, thanks. And our discussant will be Eric.
All right. Thank you to the organizers for inviting me to discuss this interesting new paper by Lockhead and Blanco. I learned a lot about this rental assistance demonstration program, which I think is a relatively understudied program that HUD has been running recently. So with just a little bit of a recap of what Hector just went over, this paper is about RAD conversions, this moving of public housing developments from the traditional public housing financing system over to a project-based Section 8 structure for them, and trying to test whether or not this conversion does it affect tenant composition in these developments. And so they're going to use some nice administrative data and this difference in difference design to try to study this, comparing earlier versus later conversions. And the main result is that average household income declines by about $700, about 5%, in these places that are undergoing the RAD conversions. One of the key strengths of this paper is that it's using this nationwide detailed administrative data, so it's got some external validity here, and the detailed data allows them to separate sort of how changes in tenant competition are being driven by both the exit and entry margins. My main comments, I'm just going to focus on two main things to talk about today. And the first is going to be on the paper's framing and the RAD treatment. And this is just going to relate to the fact that the reduced form exercise in this paper is identifying the broad impact of RAD conversions, which is changing many margins, not just changing whether or not private management is taking over here. And then the second main comment that I'm going to push the authors on and try to encourage them to do more in the paper on is identification and treatment timing. This is a promising empirical design, but I think more needs to be done to support the identification arguments that they're making in the paper. Okay, so just to start with this point about the paper's framing and the RAD treatment. When you read this paper, from the title and the introduction, so much of it is really highlighting this private provision and emphasizing private manager incentives in the paper. And I found it's actually doing. And so again, this RAD program is a very bundled thing, and many things are changing at the same time. So just to recount a little bit of this on this slide here, you have RAD coming in, a conversion is taking place. place. And there's some things that are common across all the different RAD conversions that are happening. They're going from this Section 9 public housing traditional structure to a project-based Section 8 structure. As part of this, they're getting long-term property level subsidy contracts, and then they can now access private funding for these different developments there. So there's all this financing stuff going on there. That's all common within the RAD conversion stuff. They're getting new eligibility, wait lists. Those aspects of how the developments are being run are changing too, and that's happening all over the place. But then there's a lot of idiosyncratic stuff that from my limited sort of reading and up on this program, there's some things that vary across the different RAD conversions here. The scale and amount of rehabilitation is really varying across these different places. And then the level of engagement, how much of this private stuff is actually coming as part of the RAD conversion, it really does vary across these different places. Not all of the conversions that are taking place are resulting in this ownership change. Hector mentioned this a little bit in his presentation, but I'm really focused in on that in terms of the framing. So the paper, just when you read the paper and you think about what the RAD program is, it doesn't come off as providing a clean test of how private provision matters. And so it just seemed a little bit to me like the framing was overdoing it on that part. And I'll talk a little bit about some ways I think that could be changed in a second here. Coming back to this sort of framing thing and how much the paper talks about private operational control, when you read the paper, and this actually did come up also in Hector's presentation, is, private operational control does not seem like it's driving the results here. So when the authors split their RAD conversions into the RAD conversions where there's no ownership change, the local public housing authority is still maintaining control here versus the times where RAD is involving private control of day-to-day operations, you basically see the same event study in this picture here. So this is not saying, my takeaway from this is that private sort of day-to-day operations is not necessary to generate this change in tenant competition going on here. So I think, again, this conflicts a little bit with some of the early parts of the paper in terms of how it's framing and talking about what's at stake when studying RAD. Okay. Now, let me move on to my second point before I talk about sort of suggested directions for changing, especially how the paper is written, is on identification and the treatment timing. There's a lot of potential here with the empirics. This has this intuitive early versus not yet converted comparison of different places. The authors are very aware, as we all are now, of taking care of staggered timing issues with different designs. So they set up everything in a very nice way to handle those things. The key identifying assumption in the paper is just absent a RAD conversion, that the earlier versus later converting developments, they would have been on similar trends. And so you're just concerned about anything that's time varying here. So conversion timing, and then in particular, conversion timing may respond to these development conditions that are affecting tenant competition. One simple story that you could tell yourself is that the PHAs are prioritizing places that have different maintenance shocks or other sort of operational concerns going on here. And so earlier versus later developments might be differing in terms of the extent of maintenance shocks and when they are happening. You could write down a simple model where you're going to get that maintenance type shocks that are arriving idiosyncratically across these different developments is going to generate some bias in the D&D estimates. If, again, maintenance shocks matters for the tenant composition. So pre-trend test, of course, is reassuring, but it doesn't rule out time varying shocks. I think they can do more here in the paper than what is currently being done, and I'll come back to that in the list of suggestions here. Okay, so here are four main things that I'd like to push them to sort of improve as they go forward with this paper. One is just this framing thing and just trying to align the framing better with the evidence that's in the paper. So emphasize the main estimates as this sort of reduced form exercise, testing the whole bundled thing that RAD is. And private provision is one possible mechanism within what's going on with RAD. Make that the framing. Then also sort of elevate the discussion of how the operational control results are sort of this key distinguishing test of whether or not private provision and private operation of day-to-day operations matters. That helps discipline the evidence. So I think that will help with some of these concerns that I had, at least in my read, over how the paper is framed right now. In terms of identification here, I just felt like they needed to have more of a forward-facing institutional discussion of what is going on when the public housing authorities are making these decisions to join the RAD program here. So really what I would try to do, and there's the HUD reports, there's these HUD evaluations where they were writing down a lot of useful information about how the program actually works here, but just take us through as the reader more about how PHAs select and prioritize developments and what determines conversion timing here. And I think concrete examples would be especially helpful. You can look in housing, the sort of housing journal space, and they talk about different developments that are specifically undergoing these RAD conversions. And I think that will help the reader think about what are the possible endogeneity or sort of identification concerns that exist out there. And I think being front forward facing on this will really help maybe alleviate some of the concerns that you could have about these maintenance issues or those driving things, et cetera. And again, this will just help me believe that the timing arguments are really appropriate here about, the early versus late is as good as random here. To conclude, I think this is a really nice paper on this policy that HUD has been doing in the last decade or so. They're using rich national administrative data. It's, this very well-motivated staggered D&D design. The strongest contribution to the paper is evidence that the RAD package changes the composition of residents in these assisted developments. And this builds on, again, like I mentioned, like HUD has their own official reports about what's been going on with the RAD. I mean, they paid people to go out and evaluate these things. And in those reports that you read by HUD, they're focused primarily on the financing considerations. This is all being driven by concern over, how do we get money to actually maintain and have good buildings for people to live in the public housing system. Those focus on, so again, HUD has been focused on financing, preservation, physical conditions. They haven't been talking as much about the tenant composition angle. And so this paper is, really doing something the HUD reports don't do. And I think that there's an important value in having that contribution and the sort of discussion about what this policy is. So I'm really looking forward to seeing how you guys take the paper forward. Thank you.
All right, we have time for some questions. I will go first, and as the holder of the microphone, related to Eric's point, I think it'd be useful to look quite a bit more at the CapEx that's going into this program and understanding the how intensive the rehabilitations are. Some of these results may be a function of kind of the extensive margin. There are some buildings where probably everyone had to move out because of the level of repair, and so comparing empty buildings versus less empty buildings. And there have to be some ex-ante characteristics in the data in terms of the year that the building was built or some of the other attributes where you could get a better sense of the degree of sort of expected need when it comes to CapEx. I'll pass the mic here to Tomek and then we'll take others.
It's an interesting evidence, but I a little bit struggle what we learn more about efficiency of these programs. It would seem to me that, okay, there's some change in composition of folks living in these buildings, but we kind of want to know more, like who is entering, where people go, what is the cost of providing this to get us closer to sort of welfare objective and what we're trying to optimize. It seems to me we kind of have this reduced evidence, but I lack a little bit of a framework. So, I would encourage you to push it more structurally to think what's really going on to inform the policy, because like that, it's very hard, at least to me, to really see what sort of the takeaways to the public policy folks from this.
Waste sector. Sorry. I was really interested in thinking about this through the lens of a disruption. There's a shock and you're forced to move out because of these renovations or whatever. And I think you have super nice variation that everybody is forced to suffer this displacement shock. And you see some people moving out and some people moving back. So that allows you to learn a little bit of the option value or the value of the outside option for different across the income distribution for these people, but also the value of those original places. And we might want to think about that. I don't know, lower income people have like very high attachments to the places where they are because of social networks or because of information. And so I would like to know more about like the bias of like the original location for these low income people. And you have nice variation to do that.
So much of housing policy has its roots in the progressive era attempts to improve the quality of the units as they were once built. And HUD still reflects some of the legacy on this, right? The extremely high levels of attention that are given to like unit quality are part of that. And in fact, like even though it's not the focus of your paper, it's there in the background. It's kind of a lurking thing. I have a strong hunch that like this is kind of stupid. That like, in fact, what really matters for the quality of the unit is who your neighbors are, not whether or not not how bad the physical quality of the unit is in the modern era. Which is not to say like if we go back to 1860 tenements, it would be pretty bad. So I'm not like, but within the variation we have, I would be interested in, and I have no idea. It doesn't sound like it's this paper because this paper does. I kind of think what Eric said you should do. But I do think this is an interesting thing that is paper related, and that I would really like to know more about, and whether or not this hunch of mine is actually correct.
Go ahead, Evan.
This paper reflect on the basic competency of the public housing administrations and maintenance. So, the question is not whether in 5 years, the question is not whether spending $10 million on improving elevators means the elevators run. I think in 10 years or 5 years, we can start to ask, maybe already now for the earliest renovations, if the ones that got handed over to non-governmental organizations still have those new elevators run. Whereas with the public housing agencies, those elevators don't work, 3 or 4 years after replacement. That would be my.
That's great, and great head of names. Like we think some agencies are much better than others. Yes, right.
I'd just say on the like trying to separate the eligibility rules, I appreciate what you can learn from the incumbents. I'm not sure that it's that simple in the sense of like if residents are expecting that the future occupants of this housing are going to be lower income, or there's going to be different types of people that come in because of like new prioritization rules, it seems like that could kind of immediately affect some of the move in or move out behaviors that you're seeing. So I appreciate what you're doing, and it's just not clear to me that you can't like separate that as an important contributor to what's going on too.
The wealthier people moving out kind of reminds me a little bit of the history of public housing in the United States with the high rises, where when they were kind of mixed income, things were going great. But when the higher income people moved out, crime went up. They became more racially homogenous. It became worse places to grow up for the children. You had these kind of Raj Chetty type effects. And so you're finding the tenants get lower income. And I guess that leads to the question of, are we kind of starting down that path? And can you look at some of those types of things like crime and like childhood outcomes?
Yeah, one last quick question. So the population effects, I think one part of that is interesting, but it would be interesting to understand if it's vacancy filling versus crowding of the existing units that are already filled out. Like, is it bigger families moving in or bigger families staying, or is it just the vacancy rate? Private sector improving the lease rate of this building.
I was wondering how much of this has to do with requalification. So this program sort of forces people to requalify. And I was thinking, to the extent that, that's driving this income effect, is potentially a powerful mechanism, for example, in the context of rent stabilization, which has no income qualification. If we could somehow get these people to move out once, then maybe they would never requalify, and we could actually get more targeting.
Two points on the manager effects. I wouldn't want to take away from this, and I don't think you are. I wouldn't want to abuse your results to say like, therefore manager effects don't matter. We don't need source of income protections. And I think that's an important clarification that like, just because in this setting, it didn't really matter when you're thinking about this kind of screening doesn't mean that there aren't frictions. For example, with tenant-based vouchers, people trying to move to low opportunity neighborhoods, there could be manager effects there. And then picking up on what Stein was just saying, I was also thinking about rent control. Rent control is kind of more interesting to think about targeting because it's not means tested. And so you can have millionaires that are living in rent controlled apartments. Here, everything's means tested. So assuming that there's enough income re-verification, the targeting is by like construction and compliance to the law set up how it was supposed to. So I would love to hear more, maybe not like a structural approach like Tomek was saying, but I'd love to hear more about how you're thinking about efficiency. I'm willing to grant that there were compositional changes from the reduced form effects. And so then I'm more interested on the, like, what do you think the value of kind of this targeting could be? Is it that we're really constrained in the units that we can offer? And so even within the means tested thresholds, we would prefer to offer those units to even lower income. And so when we get relatively high income people to move out, these are still in absolute terms very low income people. So I don't think I could take away from this like, oh, public housing projects are poorly targeted because of all of these high income people that are living there. They're still by any measure quite poor.
Great. Hector and Ellie, do you want to take 2 minutes to respond? And then you have a 20-minute break to deal with all the follow-up questions.
No, like, thank you so much for all of this content that I can address all of them, but just like some quick notes about the rehabilitations. Some quick notes about the rehabilitations. We are working on getting some data on the amount of rehabilitation for each single project, and we will be able to look more into this about whether this is driving more versus less moves. Also related to what type of developments are these related to the identification strategy. We actually observed that these developments have similar inspection scores than those that were not converted. So it doesn't seem that it's only the ones that are in the worst potential condition. And actually, like, something that I also need to highlight is that some of these developments actually don't undergo any rehabilitation. It's just public housing authorities wanting to get rid of some of these developments from their portfolio. And yeah, like I feel like there's a lot of comments on the framing. This is something that we'll need like to take more into consideration. And all of these comments are very helpful for that. But yeah, thank you so much. We're back at 10:30.
Please take your seats.
Maybe like how.
All right, please take your seats. We are going to resume. All right, we are going to resume for real. This is the danger of a slightly longer break as everyone gets addicted to the break. All right, our next paper, the effect of LIHTC on housing markets, quantities, rents, and welfare. And we'll hear from Fernando Ferreira.
Thank you, Ben. Good morning, everyone. So this work is with Gillian Mayer. She's a PhD student from Wharton, and Matt Turner. He's drinking coffee outside. Should be here soon. All right. So we study how LIHTC projects affect local housing markets. We're thinking about LIHTC as local supply shocks, which leads to two big consequences. And four questions that we're going to answer. The two consequences are, does this program increase the stock of rental housing? Does it impact neighborhood rent? So quantities and rents, those are the key outcomes that we care about. Third, we'll test for other important externalities and spillovers, changes in demand. And finally, we use all those estimates as inputs in a welfare analysis to figure out who benefited from it. How we do it? First, we collect this comprehensive data on LIHTC applications. That's critical for the design. And what is the design? Is diff and diff that compares block groups. Block groups is our measure of local housing market, that's the geography, with winning and losing LIHTC applications. And with those estimates, we run a very simple welfare analysis. So I'm going to skip this slide because we've seen that today and in many other papers. You know, LIHTC is important, largest housing assistance program that we have. And a quick primer though. So it's a federal tax credit program. So every year, the federal government allocates those credits to states on a per capita basis. Those numbers change over time. Then states allocate those credits through a competitive round. So developers apply. It's a long list of developers applying because those subsidies are really valuable. Some of them are awarded, some of them are not. Then those credits are claimed over a 10-year period, but the developers don't need to wait 10 years. They sell those credits in the secondary market to raise equity early on in order to build those buildings, okay? It's really critical to finance construction. Usually that means 70% of the development costs financed by those LIHTC subsidies. And finally, those buildings, nearly all units are LIHTC units because that's the way that developers maximize the value of those tax credits, okay? Households occupying those units are poor families with income below 60% of AMI, and rents are capped at 30% of that income limit. All right, simple model, no equations. So it's just a simple supply and demand model. And this is an example of a treated market where a LIHTC project was approved. So there was an initial equilibrium, S0, Q0, you know, P0, Q0. And with a LIHTC project, there is a shock in the supply curve, shifts to the right. And under the conditions of this simple example, we have a reduction in rents and an increase in housing units. And a simple assumption as LIHTC, this effect is operating through the shift in local supply and not local demand. All right. Is enough. Now let me add another market. That's a control market, okay? Control market where a LIHTC project was rejected. And in this stylized example, both figures are the same because even in the control market, there was a shift in supply. In this particular case, there is 100% crowd out, which means that in the absence, even in the absence of that LIHTC tax credit in this perfect control market, developers would have built the same number of units anyway. If we find this type of situation in the empirical work, Jesus, what's the point of this program, okay? It's a waste of time and money. Now, there is the opposite of example of zero crowd out, and that's our definition of crowd out. In the absence of those tax credits, developers would not have built the new multifamily units in the control market, okay? Then you have only the supply shock in the treated markets, not in the control markets. That's a better, hopefully, spoiler alert, we're actually going to find in the empirical work a situation more like this, which in practice is good for the success of this program. Now, the literature finds a wide range of estimates. A lot of people here in this room, this group, wrote about LIHTC. Sinai and Waldfogel 57%, Erickson and Rosenthal 100%, Bones, Noah, Marion 20%, Evan Soltis here 75%. Because Evan uses a similar design, he did a great work collecting similar data, 3 years ago. But we use a slightly different definition, okay? In Evan's case, it was really important for him to look at the future LIHTC projects, proposed and approved in those same neighborhoods. We use a slightly different definition where, and you'll see in a second why, which, I think explains this discrepancy between the 75% and our estimates that are much smaller. Now, in all this literature, it's a bit surprising. There's no results and no interest on the impact of LIHTC on market rents. We think that's going to be one of the main benefits of this program. Now, there are many other papers. Again, a lot of people in this room wrote about it on other impacts of this program, such as on prices, quality, externalities, if the residents benefit from moving to those LIHTC units in higher opportunity neighborhoods and so on. We also estimate those effects, but we're not finding evidence of large externalities. So from now on, we're going to focus mostly on those two key variables, quantities and rents, not on those other effects. Okay, research design and data. Our unit of observation is this block group period. We have 6 periods, so it's pretty simple to understand what's going on here. Is the census 1990 and 2000, and the ACS periods 5 to 9, 10 to 14, 15 to 19, 20 to 24. Why block groups? We think that's a good definition of a local market. And again, many papers have shown recently that any type of housing spillovers or effects operate over small geographies, okay? You don't find much, outside that small geography. And given that each LIHTC project is really small relative to the housing stock in an MSA, finding MSA level effects would be unlikely, harder to detect, so we're not going to look at them. Said that, we check for spillovers in nearby block groups. Spoiler alert, again, we find nothing in those spillovers in nearby block groups, both in terms of quantities and prices. The main effects are really happening in the own block groups, okay, where the projects are being built. Now, LIHTC applications are critical. Again, a lot of work, it's more than a year here in one slide of collecting this data, cleaning this data, organizing this data. We got them from state housing authorities, from commercial data aggregator. It has the year of the application, if it was awarded or not, address, rehab, a lot of data about those projects. Our full sample has 43 states, 31,000 applications. About half of them are approved. And the cleanest data that we have, post-geocoding, post many other things, have 17,000 observations, about half of them approved. Now, this application data that starts at state level will define the set of blocks used in the study. Now, how we classify block groups? So a block group with an approved project in a 5-year ACS period enters the treatment group. For example, if in 2010, a developer proposed a project and it's rejected, and then next year, 1 year later, propose the same project and it's approved, that block group is part of the treatment group. So we are avoiding the short-term dynamics of rejected, approved by aggregating in a 5-year period, all right? Now, a block group with only rejected projects will enter the control group. That's our main control group. It's going to be a definitive framework. That's the standard. Now, our results are robust to including not yet approved projects as additional control group. Okay, so that's that. Now, after the project is approved, a HUD starts to track those projects, and it tracks the allocation date of those subsidies and the date that those projects are placed in service, and we're going to follow those outcomes. A final note, we do have lots of missing applications, lack of geocoding, so that's not a big deal if the missing data is more or less random across treatment and control groups, and that's what we find. All right. Research design, that's the staggered adoption diff and diff with state fixed effects. And what's our main sample? Our main sample, because I have 6 periods, I'm listing here all the potential paths that block groups can take. Our main sample is this complicated blue sample where you could have projects approved in 5.9, and then 10.14 you could have an approval or reject, same in 15.19 and so on. And so many possible paths. The results that I'm showing today is for that sample. Now, we do more than that, just don't have time to show. We have this super nice, clean subsample where things are much easier to understand. We also have subsamples with 2 consecutive award paths or 2 non-consecutive award paths. The results, the no crowd out and the same impact on rents are similar across all the subsamples. We are going to recover an average ATT based on weighted average of all the subsamples. We still don't have standard errors. We still don't have that here today. It's coming, but I'll show you the results for the main sample. Everything will hold. All right. First set of results, HUDs units allocated. So the pre-trends look pretty good. And then in time is 0, that first 5-year period, there is a jump in the number of light tech units allocated. And that remains more or less similar over the other 2 periods. And when I say 2 periods, that period number 2, that means 10 to 15 years later, okay? Because I'm talking about the ACS 5-year period. And the effect is similar for the different subsamples, exact geometry, stable block groups, no rehab, and so on. Then you have HUD units placed in service. Now there is a construction lag. It takes a few years for those projects to get developed and placed in service. But by T+2, again, 10 to 15 years later, the placed in service units more or less converge to the allocated units, right? I'll show you the precise numbers in a second. Finally, ACS multifamily units. Again, the parallel trends look pretty nice. There's no jump in year 0. That makes sense. The projects are not built there yet. Those numbers starts to change in period 1, 5 to 10 years later. But again, projects are built, people move in, ACS has to go there, survey, and then ACS is this 5-year weighted average. We really find that the complete results 10 to 15 years later, and it more or less converges to the same number of units that are placed in service. And those are the numbers for that period. We have 89 light tech units allocated, resulted in 87 units placed in service, and 77 ACS multifamily units that we see in ACS occupied. And that means an 11.5% crowd out effect. Very, very little crowd out. The confidence interval is between -6 and 28. So if you remember the literature, that's Nate's estimates of 20%. It's indistinguishable from that, really small. Okay, which again it's good news for the program. Now the same result holds for many other samples. Nice sample, not yet treated control group. We find no effects on single family and owned units, and also no effect on neighboring block groups. But that's conditional on focusing on the stable boundaries, okay? If you don't look at the stable boundaries, there's a little bit of a slippage there, which makes sense. All right, how am I doing on time? 10 minutes, okay. Second most important outcome, that's average gross rent from ACS. Again, the parallel trends are fine. No effect in year 0 makes sense. Very little effect in period 0 and period 1. And then in the final period, a reduction in rents of 73 per month. If you run this in logs, it's 2.5% decline for the average rental unit. And we find similar effects if you use the variable contract rent as opposed to gross rent. Now, a little caveat with these results, okay? The ACS data includes both LIHTC and non-LIHTC units, and there's no way to distinguish that in the ACS. So because around 20 to 25% of the multifamily units in a block group will be LIHTC after construction, there is this chance that this rent decrease is just a mechanical effect of the LIHTC units if the rent of those units are really low. Now, it turns out that in our data, the LIHTC rent cap, which developers tend to charge very close to the cap if they can, is higher than the average monthly rent. It's $1,125 versus $1,093. We haven't done, it's difficult to find this LIHTC rent data in the literature. Evan here, he estimated doing many adjustments, many more than what we did. He found an average 12% discount on those LIHTC units. Using our data or Evan's data, that would mean that the reduction in rents is between 40 and 80 instead of that 73. Okay, still pretty good. Cody will talk a bit more about that, so I'm going to skip the rest. But the rent decline is consistent with a supply response. It's not just mechanical. Oh, and this is another way of saying that those caps are really high. Those are changes in number of people occupying units in those different rent bins. LIHTC is not a program for the super poor. Those LIHTC units are not impact the units for people living in rental units that are really inexpensive because those caps are really high. And as you can see on top is the data on the actual value of the cap. And at the bottom, you see the shift in units in ACS. Those rents are high. They're not mechanically low. That's not how this program works, okay? All right. And I'm going to skip the demand shifters and neighborhood externalities. We look at many of those variables. We find very little in terms of deterioration, neighborhood quality, or a large demand shift. All right, welfare. I have 5 minutes, so I've got to conclude. Again, back to the simplest possible model that we could come up. So the green area there, the dark green area, is the change in consumer surplus from this change in supply of 77 LIHTC units. And if you apply a 30-year present value at 10% discount and divide by the number of units, you have an increase in consumer surplus of 35,000 per unit. Now, where does this come from? The red border rectangle there shows transfers from current landlords to renters because of the market decline in rents, okay? That's $30,000, 30.5, which means that 88%, the vast majority of the increase in consumer surplus coming from this program is due to those local market rent reductions. Not, again, not because of the direct impact of LIHTC on the LIHTC residents. That's the smallest component of the increase in consumer surplus. Now, the second component, that's the yellow vertical rectangle. That's potential revenues for LIHTC developers. If you apply the same present value calculation, that's $115,000. Given that development costs on average are $150,000 per unit, they're still negative. So negative $35,000, not even accounting for other expenses that they may have, which means that LIHTC projects would not have been built, developed without subsidies. Those subsidies are critical for this development. And this is the main mechanism that we're seeing zero crowd out. Because without subsidies, that's not profitable, okay? So what are the subsidies? I think this is my final slide in the conclusion. So if you calculate 70% of no-land costs, it's going to be about $90,000 per unit of LIHTC. That's the magnitude of subsidies. So we're spending this money, and what are we getting in exchange for that? We are getting those transfers from landlords to tenants, 30,000. The total increase in consumer surplus, 35,000. Developer losses of 35 before subsidies. With the subsidies, they gain 55, which is great. And which means in a simple interpretation that even though the program is better than what I was expecting before, my priors before this study is that this is going to be a total disaster because of crowd out and other issues. It's not a total disaster, but it's still not perfect because households would rather have the money rather than the housing, have more subsidies than the consumer surplus. Developers are definitely better off. They want the subsidy. And lenders and landlords probably do not want the program in the same way that landlords do not want competition from your supply. They don't want to change in zoning, densification, and this and that for exactly the same reasons, okay? So which means that there's a simple policy implication coming out of this, is that there's probably room to lower the subsidy per unit. Again, when start this project, we thought that they're going to estimate a super complicated structural model, do something crazy about thinking about a counterfactual simulation for a new design and so on. In practice, the results are so straightforward and simple that how about lowering the subsidy a little bit at a time? How about allowing states flexibility to offer an 8.5% LIHTC, and a 7.5% LIHTC? Let the experiment. Developers will still develop, but you can build more units if at the margin the subsidy is a little bit smaller per unit. Okay. But I think I'm out of time. So the conclusion says exactly the same things that I just told you. So thank you very much. No, I'll give you back 1 minute. Okay. Thank you. Okay.
Thanks, Fernando. Our discussant is Cody.
Okay. I almost wish you had spent time on the conclusion because I was going to start by saying that I'm not going to summarize the paper and I'm going to jump right into discussing some of the paper itself. It's a very nice paper, but I want to start by situating it in the literature on crowd out. So a lot of these papers do more than just measure crowd out, but if you look at their crowd out estimates, they range from basically no crowd out. So you build a LIHTC unit and you get a net increase in the housing stock of whatever you built in the LIHTC. To almost full crowd out, where the market rate developers adjust and they build less, so the net increase in housing stays roughly the same. And so there are a lot of differences across these papers, And I think the first group of them are what I'll call like kind of boring reasons that you could get difference estimates. So they're different samples. They're looking at different time horizons for looking at the market rate response. Some of them are using instruments. Some of them are doing ATTs. But I instead want to start by focusing on this last difference, which is the difference in the geographic level that we're measuring the crowd out at. Which ranges from Evan's paper, which is looking at crowd out at the parcel level. So does a given parcel still get developed? All the way to Sinai and Waldvogel, which is at the MSA level. So how does housing in the entire MSA change? And specifically, I want to ask is like, suppose both of these are true, that at the parcel level, we have very high level crowd out, neighborhood level, very low levels of crowd out. These are two recent papers using similar data of accepted and approved applications for credits. Is there like a model of the world that can rationalize both of these findings? And I'll note, though, that Evan also does look at the neighborhood level crowd out and still finds quite a bit of crowd out there. So there's something to be said for measurement differences, too. But I thought I'd kind of focus some of the discussion on just thinking how to clarify these different notions of crowd out that are floating around there. So let's start with like a simple model that we can do some simulations on. So there's one neighborhood, a bunch of parcels, there's 15 vacant parcels, there's some market rate and some light tech developers. All the parcels charge the same rent, which is set according to this like constant elasticity inverse demand function. On the supply side, there's some value of developing each of these vacant parcels. There's a cost that you have to pay if you want to develop it. You might get some subsidy, and then you get some discounted stream of rents. And I'll say the decision to develop is just some nested logit. It doesn't really matter too much what you model for that. Timing is as follows. Government is going to choose one parcel to subsidize. And so they'll offer a subsidy that's large enough. They'll set it so it's large enough that it will definitely get developed as LIHTC. And the probability that any subsidy gets developed is this PJ. And then LIHTC developers are going to choose whether or not to build. And then the market rate developers are going to choose whether and which parcels to build. And all these decisions are going to be consistent with some equilibrium rents. And so there's more going on in the background to like make this simulation well behaved, but I want to highlight that there's kind of three key parameters here. So first is how elastic is demand. So how much will rents change if we toss on a bunch of new housing supply to the neighborhood? Second is what's the targeting of the subsidy? What's the correlation between the value of parcels that we offer LIHTC to and the probability that we actually give them LIHTC? So does the government give subsidies to parcels that are already really valuable to develop, or do they give it to parcels that the market rate developers wouldn't be that interested in developing? And then lastly, what's the availability of substitutes within this neighborhood? If there's only one vacant parcel, this kind of collapses to parcel level, and neighborhood level crowd out is the same. So this last thing I'm just going to set so that there's plenty of substitutes in the neighborhood. And I want to show how these two notions of crowd outs differ when you vary the demand elasticity as well as the targeting of the LIHTC subsidies. So this is showing crowd out at the neighborhood level, where the dark green is where there's very little crowd out. So we build a unit of LIHTC, we still get 1 unit increase in the net housing stock. It's not offset by changes in the market rate development. And you can see that it's going to be highest, they're going to be less crowd out in this bottom right corner where the demand elasticity is very high. So you can add units to the rental stock without really dramatically decreasing the rents that the other developers would be facing in equilibrium. And the government is not targeting subsidies to the highest value parcels. They're targeting ones to maybe parcels that developers didn't really want to build anyways without a subsidy. And so that's where we'd see very little crowd out. Other quadrant is where we'd see more crowd out. Adding units to the housing stock decreases equilibrium rents. For other developers, there's less value in building there now. Or we're targeting parcels that we're cherry picking or cream skimming the best parcels to build and giving those additional subsidies. At the parcel level, it's in some ways more simple. Like it depends less on the demand elasticity and just what parcels are we giving these subsidies to? Do we give the subsidies to the high value parcels to develop anyways, in which case we'd expect a lot of crowd out, or do we give it to parcels that wouldn't generally be developed? And so there's one corner of the world where we start to the empirical results we see of low neighborhood level crowd out and high parcel level crowd out would hold. And that's where the demand elasticity is quite high, and we're offering subsidies to parcels that would probably already be developed anyways. And so I'm not saying this is like the right model of the world, and certainly these aren't like the right structural parameters that describe people's decision. I picked these out of a hat to make a nice example. but it highlights that like these notions of crowd out are not necessarily in conflict. These could be both true. It's not that the literature just has crazy estimates that go from 0 to 100 and that they are necessarily like one of them has to be right and one has to be wrong. And second, that this simple model has a little bit of empirical content in that we can kind of try and see which world we're in. So on demand elasticity, this paper finds about a 2.5% decrease for a really large increase in the number of units. Adding a LIHTC building to a block group is a big increase in the total number of rental units there. And so that implies that demand here is pretty elastic. We can add all those units without dramatically affecting rents. So check we're in that half of the plot that I was just showing. The second is like, what's the correlation? What's the targeting of these subsidies to parcels? And this is also testable, and you could think of different ways to do it. One would just be, are the parcels that we're approving for LIHTC subsidies ones that look like parcels that get developed by market rate developers anyways? Or are they parcels that are just totally different looking, very unique? We never really see market rate developers building on those types of parcels. And then last, just the part that I kind of just assumed is, are there substitute parcels available? Are there other vacant parcels in the area that we could move around where exactly people are building if we take one of them and set it aside for LIHTC? And so I think there's an opportunity for this paper to be like the paper that tries to clarify some of these notions of crowd out and show like under what states of the world we might expect to see these different empirical results that we're seeing in the literature. And so that's like my first suggestion for the paper is to try and push on that a little bit. Instead of chalking it up to just necessarily being differences in measurement, it could just be we're measuring different notions of crowd out. Okay, so stepping back, second point is about what's the relevant definition of a market. So if we go back to 2005, it's the ideal unit of observation would be a market area. It's a narrow geographic unit like a tract would be inappropriate because private housing adjustment would likely be outside the tract. Fast forward 20 years and we're now focusing on a housing market that's very small. And so we've traded off some of the big market area for the areas where we have variation, where we can estimate more potentially credible causal effects on the housing market at that level. But now we're using a block group. And the usual test is to look for effects in neighboring markets, in this case, neighboring block groups. And so this paper finds, like, if anything, positive spillovers on the number of units in neighboring block groups, no real effects on rents in those neighboring block groups. And in general, there's some other evidence that these spatial spillovers are going to be very local in these sorts of markets. But it's difficult to separate like whether the spillovers are truly local or whether whenever they're not local, we just don't have the statistical power to actually detect that they're there. And so there's two reasons that you might expect that they're actually quite diffuse. So one is that developers cover really large areas. I think if you ask the developer that's building a given parcel, like, hey, if that one didn't work out, what was your second choice? They would probably name a parcel that's very far away. It's not like one block group over, it might be in a different city, even what their second choice site was. And then second, LIHTC households also move from pretty far away. And so it depends where the LIHTC developments are built. But in general, they're moving from 6 to 8 miles away when they move into this LIHTC development. Very few of them are coming from within 1 mile of the development. And so that means that the rent spillovers are going to be pretty diffuse too. Like, what are the units that they're leaving in the origin tract that might have a reduced rent to attract that next tenant? And so this is a bit of an unconstructive comment to make because it's unrealistic to say like, okay, well, now go and detect all these really diffuse tiny spillovers at the 6,000 block groups that are in the Chicago metro area. They're likely individually small, but like it doesn't necessarily mean that they don't exist. So my suggestion here was just if there's like some simple model that can kind of teach us like when we should expect them to be more or less diffuse and when it's more okay to focus on just the local area. So one thing that would make it fine to focus just on the local area for construction is if all of the construction we think is just coming from outside option versus of not building, not from substituting from other areas. And so, perhaps some simple model would tell us like what parameters we could look at that would tell us whether it's okay to try and focus on just these narrow areas. Okay, so last very quickly, two specific comments on implementation here. As Fernando mentioned, the ACS average rent is going to include LIHTC units. In theory, like you can do we observe everything here that you can do the like adjustment for this mechanical effect if you just kind of write it out. And so I was excited about this and I wrote it down. I was like, oh, cool, I can just try and like see what the corrected change would be, taking out the LIHTC share. But if you compute the above, you actually get a larger drop in non-LIHTC rents. And this is driven by the fact that the LIHTC rent caps are higher than the average ACS rents in the neighborhoods. This comes up a lot in LIHTC papers that ACS rents are not that comparable to LIHTC cap rents. Many things could be going on. There could be differences in quality, could be that there are different unit sizes and the cap depends on unit size. The caps could be non-binding. But the final result about rent spillovers is going to be sensitive to what we think the LIHTC rents are. If we thought that LIHTC rents were 20% below ACS rents, then we'd say that there'd be no effect on the non-LIHTC units rents in this neighborhood. Okay. I have one more comment on defining the control group, but I'll set that aside. Mostly, I just think that there's some more power to be squeezed out of the sample, all the data that they've built that would let them test for more heterogeneity across different neighborhood types, for example. But wrapping up, I think this is a great contribution to literature on LIHTC's equilibrium effects. It's really impressive data collection. It's one of few papers I could think of that tells us anything about effects on the neighborhood rents. And it turns out they add up to be larger than I would have expected. And so relative to my priors, I'd say this paper has taught me that neighborhood level crowd out is probably lower than I would have guessed. And the effects on rents are going to be higher than I would have guessed. And the two areas I see is just teaching us more about reconciling these different notions of crowd out. And then a little bit more on heterogeneity by the where are we building, what's the type of LIHTC development, and so forth. But yeah, thanks so much.
And the first thing is that I kind of want to echo a little bit of what Cody said. Where is Fernando? So Fernando, one thing that I would love to see in the paper is to think what are the different economics that we see by thinking about these different control groups. So the comparison that you're doing here, the decisions that you can make not only at the geography level, different levels of aggregation of geography, but also temporal variation. Because I think Evan, for example, uses yearly variation, whether you use blocks of 5 years. So a little bit of not only we have a different control group, but what are the different economics that we have in these different control groups? And also, even though you might not find spillover effects, local spillover effects, there could be a GE effect that is happening there. I don't know if you can do anything about that by comparing different metros that had more or less LIHTC. And I have more comments that I'll talk to you offline because I don't want to monopolize the mic.
I'm all about heterogeneity on this. I just can't imagine that building in Houston isn't going to have crowd out of some form, but maybe it isn't. And I certainly can't imagine that there's any crowd out going on in Detroit, right? And so I would be entirely focused on what else we know about the supply of affordable units in the area and be very focused on that in terms of this stuff. And I don't know anything about prices. I'm just talking about quantities.
Take the moving mic. Yeah, so really interesting and much more detailed than what we could do when Justin and I were doing this 20 years ago. One thing, yeah, so heterogeneity is super important. I mean, there's certain neighborhoods, and we know this from Diamond and McQuaid too, right? Where these units are very different from the typical unit in a neighborhood. They're going to have much bigger kind of effects and probably the crowd out effects are going to be different there. And the rent effects might be different, partly because of negative amenities. And then you get and those are in rich neighborhoods, and in poor neighborhoods, you get exactly the reverse, right? So I think going for the heterogeneity is going to be super important to really understand what's going on here. And then the other thing is that a lot of times these LIHTC developments are kind of part of bigger neighborhood revitalization initiatives. And so you kind of get this cocktail of treatments of, they get a new grocery store and they've repaved the roads and they've got a LIHTC development. And, we know in these poor neighborhoods that these tend to be positive amenities. And then you might get some other investment going on in neighboring apartment buildings where, because the neighborhood's getting better and actually finding the negative rent effects, I really wondered how much of that is coming from the assumptions about what the LIHTC rents are, because I know that in these poor neighborhoods, the rent caps are not binding. And so the LIHTC units might actually be renting for more than the market rent in these poor neighborhoods. And so it just goes back to heterogeneity again, that I think looking, at these different types of neighborhoods and looking for those heterogeneous effects is going to be super important.
Thank you, Cody. Those are great comments. We had a lot of conversation about the rents. We're gonna work on that. Oh, thanks. We do have some individual level rent data we're discussing yesterday night that we'll probe that result. We think the result is correct given everything that we know. And part of it is because it doesn't really make sense for light tech renters to rent like at units at a much higher price than the market price. So almost just because of that, it's those rents are quite similar. G effects, that was our original goal. We are happy to show that even without the G effects, the most important economic effects of light tech are those market effects. So in a way, by not measuring what's happening in the other parts of the MSA, we may be underestimating a little bit the importance of that rent reduction. If we have to live with that, we are fine if we live in that, given this is the first paper showing that the most important contribution of light tech is that the local reduction in rents. Nobody has done that before. So moving the literature in that direction, I think you're okay, but if needed, we can do a simple model under some assumptions, but it's going to be model driven, not by data driven, by necessity. That's the caveat there. Heterogeneity, I agree. It's just a question mark if I have a power to properly estimate those things, but I fully agree with that. Thank you.
Take a quick break. We'll be back at 11:25. All right, hi, everybody. We're going to get started. Please find a seat. All right. Our next paper is Evicted from Opportunity, Labor Market Effects of Housing Loss in High Productivity Cities, and Charlie will be presenting.
Okay, thank you very much for the opportunity to present this work. It is joined with Brian Asquith and Kate Pennington, who are also here. And let me just say to begin with that the data that we're going to talk about today has been reviewed for disclosure avoidance protection. So the motivation for this project is that economic opportunity is increasingly concentrated in these large, dense, productive cities. And at the same time, housing in these cities is becoming increasingly difficult to secure. And so even if people know where the good jobs are, reaching them may require a stable housing foothold in the labor markets that offer these opportunities. And so what we're going to ask in this paper is, how important is that stable housing near high-paying jobs for long-term career growth? Can it be that workers, if they are sort of pushed outside a little bit of the hypercenter, can they do just as well? Or does losing a stable housing access also disrupt careers? So we're going to study this question in San Francisco using mass evictions from the city center under California's Ellis Act, through which landlords withdraw entire buildings from the rent-controlled rental market. So one way to see this is on this map. You can see about 1,300 such Ellis withdrawals between 1998 and 2019. And you can see that they, are concentrated in the more central areas, but they occur throughout the city. But for any individual renter, it's a relatively rare event that's kind of difficult to anticipate. And importantly for us, an Ellis withdrawal clears the entire building rather than targeting a particular tenant. And so for us, it gives a very unusually useful housing displacement shock. So what do we do and what do we find? Let me give you a preview. We're going to link these Ellis withdrawals to about 3,000 displaced tenants and compare them to other residents of other rent-controlled buildings within 200 meters. And our main finding is that 6 years after eviction, the displaced tenants earn about $6,000 less per year. And that's roughly 13% of their pre-eviction income. These losses are, in fact, more than twice as large for the subgroup of younger workers whose next residence is outside the city center. And we're going to find that among that group of younger workers, they're going to transition to, they're going to see job separation rates that are higher. They have longer commutes, and they're going to gradually transition to lower paying firm and smaller establishments. Okay. So in the second part of the paper, we basically ask, does that make sense with how we understand, the structure of urban super productive cities? We're going to ask whether a one-time housing shock can produce these long-lasting earnings effects, and we're going to develop a model with job search, with costly commuting, with frictional housing, and wage growth that depends on varies across space. We're going to calibrate it to the Bay Area and find that, in fact, when we simulate evictions from the center in this calibrated model, we actually get effects that are very similar to what we estimated. Then we're going to use the model to ask whether we could think about pairing the evictions with policies that would alleviate these adverse effects. So we're going to compare rent subsidies, commuting subsidies, and housing search assistance and investigate whether we could sort of make these evictions less costly for the treated people. Okay, so let me place the paper in the literature very briefly. Definitely, this is a paper about evictions, but an important difference relative to the recent literature is that we're looking here at tenants that are not selected for non-payment or for any sort of individual distress, but we're still going to find that they experience large income and persistent income losses. We're also related to the literature on what makes cities special, the sort of agglomeration and earnings growth. And the results that we're going to find seem to indicate that to access urban opportunities, you also need to know where people live within the city, right? And that access to opportunities is not only sufficient to understand it as with being located in the metropolitan area, for example. And that connects directly to the literature on spatial labor frictions, where it seems that in this context of a sort of a superstar city, the labor market access is really hyper-local. And finally, we're definitely connected to the literature on housing and housing regulations in general that has emphasized how housing regulation, housing constraints can act as a barrier, right, for people outside of the city from accessing opportunity inside the city. And here we have a bit of a flip side where we're saying that for the incumbents, if they lose some of the protections that guaranteed them housing, they also then suffer some long-term consequences in terms of income. Okay, so one important word about the data, this project is possible because we are able to link housing and work inside the census data repository. We begin with the dates and the addresses of the Ellis filings from the city of San Francisco, and we match them to, we actually link those parcels to assessor data. And then we identify the treated and controlled people from an annual address panel that was assembled inside the census data using tax records, USPS change of address records, and various program participation data. Then we bring in employment and earnings outcomes from the tax records and from the LEHD. And then we also look at neighborhood and building level variables from the assessor data and from other public data. Okay, so once we have this data set, let me just say a word about the identification and the institutional context and why we think that these Ellis eviction bring some interesting variation for identification. So in San Francisco, about 70% of the units that are rented are covered by rent control. The Ellis Act allows landlords to withdraw, to leave the rental market from this rent control. But the key, again, the key restrictions is that the entire building has to be cleared and all units must be vacated. And that is this building-wide rule that is crucial for us because it means that a landlord cannot select a particular tenant as being undesirable. Okay, and so tenants, they receive a number of protections. They are, get some advance notice. They have some relocation payment, and they also are protected if the owner puts some of those units back on the rental market. They get some sort of privilege for returning to those units if that happens. In practice, it's actually very rare that this happens because the main sort of fate of the buildings that we can see in the data is that those buildings tend to be sold. They're converted into condos or some private ownership, and they truly exit the rental market at some point. Now, of course, the buildings themselves are not selected randomly, right? And I just showed you how they those evictions, those Ellis filings are more likely to happen in central neighborhoods where property values have risen and where the incentive to leave the rental market is stronger. That's why we're going to define our control group as being residents of other rent-controlled buildings within 200 meters, right? And that way, we can really say that the control group is experiencing the same neighborhood conditions and the same housing regime. Okay? Now, the identification assumption is the usual parallel trends, where the idea is that absent an Ellis withdrawal, the treated tenants would have followed parallel earnings trajectories to the control group. And so we're going to be able to assess, some of that assumption by looking at pre-baseline balance and looking at the raw pre-trends. Okay, so let me actually get there. If we look at the balance table, what we can see is that it's pretty reassuring that the treated tenants and the controls have similar demographics, they have similar income, industry, firm average wage, establishment size, commuting distance, housing tenure, building value, and neighborhood characteristics. And the normalized differences are small throughout. So we're feeling confident that we've identified a control group that is a useful one. And in fact, we can look and see much of the effects of these evictions just by looking at the raw pre-trends. So on this slide, I'm showing you 3 important outcomes for the treated and the control group. The first left panel shows that immediately at the time of the Ellis filing, there is a large increase in residential move that's consistent with these people having to find another place to live. And then the income effects are visible also in the raw trends. You can see on the middle panel that before the treatment, the control and treated groups have very similar income trends. And then the treated path slows down and the gap gradually opens. On the rent side, it's a pretty different picture where you can see that immediately upon being evicted, the treated group moves to tracts that have lower median rents, right? And that sort of remains lower throughout. So the event studies are going to confirm that pattern. I'm showing you now the results from our stacked event study. So let me just briefly tell you what we do, right? We do a stacked event study where we're going to be comparing the 2 groups, and we're going to be using event by year fixed effects and individual by event fixed effects. Okay, so first, we don't see any evidence of differential pre-trends among the treated and control group. You can see again this elevated mobility right after the eviction, and this pattern of a gradual decline in income that sort of accumulates over time and reaches the $6,000 that I mentioned at the beginning after year 6, whereas the effect on rents is more immediate. And you can see, if you look at the numbers, that it's about an $80 discount on rents per month that we measure. Now, we don't measure the actual rents that people pay. That's not in our data. But if we assume that this is a good estimate of the actual change in rents for the treated group, then that would translate into maximum of $1,000 savings on rents per year for the treated group, which is far smaller than the income effects that we see accumulating over time. All right. Now, the big question that we want to ask next is, who is really being affected by these evictions? What is the heterogeneity that seems to matter? So this is the next slide that I think reveals much of that. What we do here on this slide is that we're going to estimate the average post-treatment effect on income across different groups. And the left panel is looking at heterogeneity by baseline income. So we're grouping people based on which terciles of the income distribution they belong to pre-treatment. And we don't see a very strong gradient here. The absolute effects range from about $3,000 to $5,000. But if you move to the next panel, the middle one, you see a very strong age effect, right? workers that are evicted when they are younger than 30 years old experience on average a decline in earnings of about $9,000. Those that are aged 30 to 45 have about $4,000 decline, and those above 45 years old basically have zero effect. Okay. And then the third panel combines age with distance from the original building to the next first residence that the person moves to. So just to be clear, this is actually a distance moved is an outcome. It's a post-treatment outcome. So this is a descriptive decomposition. It's not telling us the causal effect of moving farther, but the pattern is really striking, right? So what you can see, we're using 3 distance bins, 0 to 5 kilometers, 5 to 25 kilometers, and more than 25 kilometers. And you see that if people don't move farther away than 5 kilometers, there are no detectable earnings effects at any age. But the younger individuals who move 5 to 25 kilometers lose on average $15,000 per year. Okay. And that number is $13,000 for those who move beyond 25 kilometers. The losses are somewhat smaller for the middle age group, and they're close to zero for, again, the older group. Okay. So the next sort of empirical exercise that we do is try to understand the mechanisms through which this is happening in terms of labor market outcomes. So we look particularly at 4 labor market outcomes for zooming in on these younger workers, and particularly on the 3 years at the end of the event window, so years 4 through 6, and we ask whether we can detect measurable changes in the types of jobs that they hold. And what you can see on the left column, the people who move less than 5 kilometers, that's about half of our young evictees. We don't detect any measurable change in job separation or employment, establishment size, or log or firm average wages, although they have somewhat longer commutes. But where we start detecting really strong effects are for that group of the sort of movers from 5 to 25 kilometers, right? Where we see higher separation rates, about 11 percentage points higher. We measure that they work at establishments that have 38 fewer employees, and firms that pay $19,000 less per year. And their commutes are 8 kilometers longer. And so this is sort of the group that to us is the sort of most surprising. Moving further to 25 kilometers, we actually don't detect very strong effects, which could reveal part of the geography of the Bay Area, right? Like once you get further than 25 kilometers, then you can reach other productive centers that are basically the Silicon Valley, right? With like Palo Alto, Mountain View, and even San Jose. But the sort of key finding from this is that people who move to a medium some range of distance seem to be transitioning to a different segment of the employer distribution gradually, rather than this sort of a one mechanical change in job immediately after the eviction. Okay, so let me just sort of transition to the second part of the paper, which is can this make sense in a sort of a urban model? Can a one-time housing shock generate these long-term earnings declines? And if so, do we think the model sort of needs important or unusual ingredients to sort of match the data? And then can we use the model to think about policies that would help alleviate those adverse effects of the evictions? So we're going to do that, we're going to represent the Bay Area as a set of rings around the San Francisco CBD. Travel is going to be costly, so we're going to think that residence and workplace can differ. And what matters geographically is going to be the radial distance from the center. Okay. And then we're going to think that there are firms in every ring, but there are going to be more of them near the center, and those firms are going to tend to be more productive on average. The households in this economy are going to be forward-looking. They're going to age over their careers and going to make repeated decisions about where to live and where to work. But they're going to do that in a frictional environment, right? Housing is going to be frictional in the sense that housing offers arrive sporadically. So you can't necessarily get an offer where you would prefer. And then labor markets are also frictional, and people are going to have to search for jobs, and that could be spatially, restricted because of the cost of commuting. And so there's a sense of a spatial job ladder that people can take advantage of by transitioning across jobs, but that is not fully in their control. And then careers are going to be dynamic, where workers are going to accumulate human capital on the job, more so and faster early in their careers, and faster in some places than others. Okay, so with that setup, the sort of key maintained assumption that we're going to keep to make our work possible is that we're going to think of the productivity advantages and the learning advantages of different places as fixed, as exogenous, right? We're thinking here about doing counterfactuals, where we want to think about simulations on a small group of people that would keep these regional advantages that would keep them fixed. Okay, and so the mechanism that we're going to be looking at here is relatively simple. We think that an eviction can push some workers outside of those central rings where both wage levels and wage growth could be smaller, and therefore will translate into long-term earnings losses. So once we put all of these ingredients together, we find that we're going to be able to match 9 spatial features of the Bay Area. The population density and job density is almost matched by construction, because we observe it in the data, and so we can sort of calibrate the stock of housing and of firms to make sure we do a good job there. We have, we can calibrate productivity of firms and amenities to make sure we also match rents and earnings. And the model is also going to capture the patterns of unemployment, of residential mobility, and of commuting in that region. And note, by the way, this sort of second wave, right, of rents and of earnings around 50 kilometers that's driven by the Silicon Valley that I was kind of mentioning before. But really the key panel that kind of holds the answer to whether the model can succeed is the last one. The last one is the next year average growth of earnings by residence location. So to compute this, we form cohorts of people based on where they live in a given year, and we follow them regardless of where they move or whether they become unemployed, and we ask what is their average change in earnings over that year. And the gradient of that object is extremely steep in the San Francisco area. In the central ring, the average growth is 8%, more than 8%. But as soon as you move to the second ring, it drops to about 4% and then 3% in the third ring. And so once you see both the schedule of wage levels and of wage growth, our eviction results are actually less mysterious. We see that if you push workers outside of these central rings, you're going to see a large long-term effects on earnings growth. But I want to point out that in order to match these patterns, the model actually cannot maintain that wage growth is entirely determined by workplace location, because a lot of those residents of ring number 2 actually work in the central ring, and yet their wage growth is much slower. And so the model is telling us that we need some sort of residence-specific contributor to wage growth that could capture some sort of network effects, or we don't take a stand on what it is, but it's a finding that we thought was interesting. So then we simulate evictions in the model, start from the steady state, and we identify a group of treated and control groups that are from the central ring. We're going to give the treated group 1 year to move outside of their current housing. We're going to give them a sort of an accelerated housing offer schedule to make sure they have options to leave, whereas the control group stays in the ordinary housing market. And the evictions are going to have effects that are kind of similar to what we see in the data, right? You have immediate residence distance that goes up and remains elevated. Housing is going to decline, earnings are declining smoothly to reach about $6,000 after year 6. Rents go down, but by much less. And commuting distance is going to go up at the beginning and then gradually decline as workers start finding jobs closer to their new residence. Okay. The model also predicts pretty well the heterogeneity that I showed you across income and age. Clearly, a very strong age gradient that we find, and the effects being driven almost entirely by people who leave the central ring. So once we have that, the last thing that we do, and I'm going to use my remaining minutes to describe this exercise, is, well, could we think about policies that would alleviate those adverse effects? So we think about housing search assistance, rent subsidies for people who find a housing in the center, and commuting subsidies to potentially help people continue to commute into the center if they live farther away. And the main punchline of these results very quickly is that really housing search assistance is the most effective by far, because the key margin that matters is, can people actually find another housing unit in the city center? And that is what will, help them secure and continue to stay on the high growth. Whereas, rent subsidies only are effective if people do actually get an offer and find another housing unit in the center, and it's not necessarily going to help them with that. So let me conclude. In the paper, what we ask is how important stable housing near high-paying job is for long-term career growth. And our answer is it's very important. Okay, if you lose central housing from one of these cities, you're going to see long-lasting and large declines in earnings trajectories, particularly for younger workers who move outside of the core. And the model is telling us that this could be true because of the extreme concentration of high wage level and high wage growth in the central rings, combined with that frictional and labor and housing markets that we think are happening. And so the broader conclusion is that in these high opportunity cities, a stable housing access is really a form of labor market access. And I think I'm out of time, so I'm going to stop here, and thank you. And I look forward to Boaz's comments.
Great, thanks. And our discussant will be Boaz.
All right, great. Thanks, Ben. Thanks for the organizers for inviting me. So the sort of starting point for this paper is this well-documented observation that economic opportunity is increasingly concentrated in dense hyperactivity cities, and that accessing these opportunities typically hinges on living in these hyperactivity cities. So with this motivation in mind, the paper asks, how do evictions from these hyperactivity cities impact tenants' labor market trajectories, and what can be done to alleviate the negative consequences of these types of evictions? To identify the effects of evictions from hyperactivity cities, the authors use event study regressions around Ellis Act evictions in San Francisco, which are plausibly exogenous events from renters' perspective, together with quite impressive administrative panel data that tracks individuals' labor market trajectories and mobility outcomes. In the second part of the paper, the authors develop a spatial equilibrium model of housing and labor markets to study the mechanism that underlie the main empirical results, and to study counterfactual policies that might alleviate these negative consequences. The key finding is that Ellis Act evictions have a negative effect on tenants' earnings, especially so for young renters who move away from the San Francisco CBD. The mechanism the authors point out to is that being evicted degrades access to markets with high wages and with career growth opportunities. In terms of policies, the finding is that helping evicted tenants search for alternative housing near the San Francisco CBD is better than subsidizing their rents or commuting costs, because that's more effective in keeping these households close to opportunity. So overall, I think this is a great paper, a very important paper. I think the empirical analysis is extremely carefully done and quite convincing. I do think that the theory still needs some work, and that's what I'm going to focus on my discussion. Let me, though, start with the empirical part of the paper. As I said, I think the identification assumption, the identification strategy, and the results are quite convincing. The identification assumption, which is that evicted and non-evicted tenants follow parallel trends prior to an eviction, does seem to hold in the data. Initially, this is surprising, but the key idea here is that since Ellis Act evictions require multifamily landlords to evict all tenants at once, this limits selection based on tenant characteristics. And overall, I find the research designed to be to credibly identify the effects of Ellis Act evictions on labor market outcomes. That being said, I think we do need to be a bit careful with how we interpret the treatment effects in the data. In particular, I'm going to argue that the treatment effect in the paper conflates the effect of an eviction with the effect of losing the benefits of rent control. And to see this, it's useful to note that all buildings in San Francisco that undergo an Ellis Act eviction are essentially rent-controlled buildings. And the reason for this is that the regulatory environment in San Francisco is such that as a multifamily landlord, you have an incentive to invoke an Ellis Act eviction only if your building is rent-controlled. Basically, as Tim and Rebecca show in their paper or discuss in their paper, an Ellis eviction is basically a pathway for landlords to exempt their building from rent control. And so this is important because from the perspective of the tenant, this means that being Ellised or being treated doesn't only mean that you get evicted, but also that you lose the benefits of rent control, which can be quite meaningful. And so it could be the case that the treatment effect in the paper reflects the effect of losing the benefits of rent control rather than the effect of an eviction per se. And there's good reason to actually think that a lot of the observed treatment effect is coming from loss of rent control. For example, there's empirical work showing that loss of rent control lowers tenants' earning, for example, by pricing them out of expensive high opportunity areas or by lowering their likelihood to attend college. Now, I do think that this distinction between evictions versus loss of benefits of rent control as a key driver of the observed treatment effect is not a cosmetic distinction. It's actually important for policy design. For example, if we think that the observed negative effects of Ellis Act evictions are due to the loss of rent control, then probably alleviating these effects requires us to sustain rent control. But if the effects are driven by an eviction per se, which is kind of what the paper argues, then a kind of promising policy solution is to basically allow landlords to decontrol their units, but prohibit no-fault eviction. So I think that the policy implications are quite different. I'll talk a little bit in the next slide, but I think there's a way to use the model to kind of tease out the relative importance of loss of rent control versus evictions in driving the overall negative effect. My last comment on the empirical part is that I would really like to know more. In particular, I would like to know more about who moves into Ellis buildings after evicted tenants move out and what happens to property values. Now, identification here is much more tricky because buildings are selected into Ellis Act evictions, but I still think that descriptive evidence would be quite useful here. For example, if Ellis Act evictions allow high productivity workers to move into city centers and increase property values, then that is consistent with Ellis Act evictions actually being overall effective, maybe, or efficient, maybe mitigating the negative consequences of rent control, which we know are plenty. And so I think you can actually use your great data to document not only who moves out and what happens to them, but also who moves in and what happens to property values. It's going to be important for kind of equilibrium effects. All right, so then in the second part of the paper, the authors propose a spatial equilibrium model of housing and labor markets, where the two goals of the model is to study the mechanism underlying the main empirical results and counterfactual policies that are designed to alleviate these negative consequences. My general worry with the theory is that I think the results rely on strong assumptions that, to me at least, to some extent seem inconsistent with the data. So let me discuss this. I'll first discuss the mechanism, then the counterfactual policies. So starting with the mechanism, based on the model, the paper argues that the reason Ellis Act evictions lower tenants' earnings is because being evicted degrades access to high-wage labor markets. Now, this is definitely a plausible mechanism. The problem is that this is the only mechanism that the model incorporates. It abstracts from a lot of other mechanisms that can also plausibly explain the observed treatment effect. And so, in a sense, if you write down a model with only one mechanism, it's maybe not that surprising that you find that mechanism explains the observed treatment effect. In reality, there might be other mechanisms that can explain the observed treatment effects. In particular, as I argued, the loss of rent control can be such one important mechanism. Currently, this is ruled out because the model assumes there is no rent control, so there's no kind of chance for this mechanism to play a role. I think given the setting, the San Francisco setting that you're studying, and in particular, given the nature of the treatment that you're studying, my suggestion is to add rent control to the model, for example, following Stein's work. I think this will allow you to potentially identify which of the two mechanisms is more important in driving the observed treatment effect. As I said, I think this distinction is important for policy design. All right, so then moving on to the counterfactual policies. The second goal is to kind of ask and answer which policies can alleviate the negative effects of LS Act evictions. My worry here is that the model abstracts from all of the equilibrium effects of these counterfactual policies that it evaluates. In particular, it assumes that prices and quantities are unaffected by these counterfactual policies. Now, of course, in reality, when you subsidize rents or commuting costs, this can impact demand for housing, it can impact supply of labor, and it can, when implemented at scale, it can affect residential sorting, rents, housing supply, wages, and so on and so forth. Currently, the model sort of abstracts from these equilibrium effects. It also abstracts from the fiscal cost of these policies and their implications on taxpayers, which can be quite important. And so I think by abstracting from these G effects, you're limiting the usefulness of the model as a laboratory for studying the effects of these counterfactual policies. And my suggestion is pretty straightforward. If I would suggest taking these equilibrium effects more seriously, incorporate the fiscal costs associated with these policies, and analyze how housing and labor markets equilibrate when these policies are implemented at scale. I think this will substantially enhance the credibility of your analysis. And it's actually not, as far as I understand it, not that difficult to do without any large changes in your model. Then finally, my last comment is that I want to encourage you guys to use your model to speak to a very active, ongoing public debate in California about the future of the LS Act. So, and I think kind of the elephant in the room, or a natural question given your findings, is should LS evictions be prohibited, right? If they're so bad, should they be prohibited? And there's in fact quite a active public debate around this question in California. For example, in recent years, a few state bills were proposed to prohibit or restrict LS Act evictions. All of them were ultimately struck down. Now, when you think about the equilibrium effects of LS Act evictions, they're kind of not ex ante obvious. So on the one hand, as you guys show, LS Act evictions harm evicted tenants. On the other hand, to the extent that LS Act evictions allow landlords to decontrol their units, they might help mitigate some of the unintended consequences of rent control that are very widely documented by people in this room. And so I think currently your model is sort of too stripped down to actually answer this important question, in particular because there is no rent control. So there's essentially no benefit of LS Act evictions in the model. But modifying the model to incorporate rent control, I think, would allow you to evaluate this economic trade-off and to inform what I think is quite an important public debate in California. I think there's a very useful application of your model. So let me just conclude. I think this is a very important paper. I encourage everyone to take a look. I find the empirical results to be very convincing. I think the paper does clearly identify the negative effects of LS evictions. I'm not sure whether this is a paper about evictions or the loss of rent control. And I have some suggestions on how to improve the model that hopefully are useful. Thank you.
We have time for some questions.
So I guess I'm pushing to taking the other direction, which is I think these are really interesting, papers showing the employment effects of location, in which the key is to actually get rid of the rent control effect and to try and focus on it. In some sense, I mean, LS evictions are an interesting policy, but they're a pretty specific one. And I think that you face that problem in general in asking about the location of a place. Whereas having really causal evidence on what moving guys around exogenously does to their employment stuff, that's really a pretty good thing. And it elevates the paper. It makes it, instead of being about a very San Francisco specific policy, it makes it about a much larger scientific question. And I think you have evidence to do on that. That requires you thinking a little bit more about, generalizability, which you can learn from different neighborhoods, and really focusing on exactly what was made Latin, which is how much of this is just the rent control thing.
Yeah, I agree with the rent control point. In particular, I think there might be an effect through how volatile your housing expenditures are, right? If you have rent control, it's kind of smoother. You know what your rent is, you know how it's going to grow. When you hit the market, it's going to be much more volatile. And you might think that if your required expenditure becomes more volatile, you might take actions in the labor market to kind of insure against that and not take as much labor market risk, especially if you're young. So this really relates to Gregor Jarosh's job market paper on, the job ladder with where they're also choosing how risky of a job to choose. And so I'd encourage you to kind of think about this risk thing, because I think you can fit a lot of your facts about the life cycle and about moving out and stuff with a kind of risk story.
Let me go here first. Yeah, so I kind of actually came at Boaz's point, but from a different perspective. I was wondering if you could look at the what would be the market rent if they stayed, and look at the rent they're paying in the new home and see if their after rent income has gone up or down. Like, presumably you can get some sort of, you can back out why they're doing what we know why they're doing what they're doing, but to measure the costs of open market housing if they'd stayed versus if they moved. So I think it's basically kind of Boaz's point, just in a different way.
I had a question about the sort of the role of search frictions, which seem to be sort of the most powerful channel in the model. I mean, in an economy with very low vacancy rates, it's not obvious that these people that get displaced, have access to another rental if only they searched a little harder. Instead, what seems to happen is these properties get converted from rentership to ownership. These are young households that cannot afford the down payment. So, I mean, that points to thinking about home ownership as an important margin in the model, which I think is currently absent.
Very cool paper. It brings to my mind the migration cost literature, thinking about why, some households, don't move. For me, it'd be very interesting to think about whether this is an important margin contributing to that. And I am a big fan of the monocentric city model, but I don't think you're doing yourselves favors by treating distance to the CBD as like a sufficient statistic here. Moving 50 miles south of San Francisco is very different from moving 50 miles east, and I would urge you to kind of like separate those out.
Just one comment, even setting the boss point on the rent control. If I'm sort of leaving the city center, I'm currently matched with some housing and I randomly lose it, right? I'm going to be looking for another place. And I'm going to be balancing, the earnings versus risk versus the cost of living, the amenity value. So I could imagine if randomly you break matches in the very city center, some people will move a little bit away and they will have lower earnings, but not necessarily lower quality of life. And vice versa, if I would do the same experiment in the outer region, some people will move into the city center. So if you could comment a little bit on this, how you think about cost of living, amenity value, because I could easily generate these patterns without anything necessarily harming these folks.
Yeah, so I know this is a real estate session, but I think understanding what's going on in the labor market side is really key to sort of understanding the mechanisms here. In particular, San Francisco is probably full of what Claudia Golden refers to as greedy jobs, right? Jobs where you just have to work ridiculously long hours. And so this extra commute is really going to eat into your ability to get greedy jobs, as opposed to, you hypothesize that maybe it's a network effect of like, figuring out which good jobs to switch to, or as opposed to like, is it the low education people who are sort of, working service jobs, the high education people who are working startup jobs, like those things seem super important. And I think between firm age and firm size and industry, you can get at some of those things.
Yeah, I think the data is really fabulous. I really like it. I think the data exploration is stopping a bit too early, and then you jump into this reasonably open model. So I think I would like the discussant, I would like to know more about what's going on. Like there might be a gender dimension. I want to know about the intensive, extensive margin on the labor market. I want to know the sort of industries where those guys are on, those that actually stay and still work in the old workplace. Are they actually behaving like their co-workers or not? I mean, all those things so that we know a little bit more, because maybe actually the real channel is indeed some network effect of people who live in the neighborhood and refer to jobs and stuff. But that could be only maybe for a certain sort of job, like people making, say, less than $50,000 a year. So, like trying to understand really what goes on in terms of jobs, industries, levels of skills. I mean, I know you don't observe that, but you can infer it and really try to think more about that. then that will help you actually have a narrower and maybe more targeted model.
This is both about ex-ante characteristics and about what happens to the next post. Yeah, please do.
So I'm going to echo what Jeff said, which is we saw a bunch of stuff on commuting distance, but maybe commuting time is what matters in Bay Area, like 5 kilometers in East Bay versus West Coast, West Side. I mean, completely different. So I think some of the nonlinear effects you're seeing, but also what's happening in your counterfactual, maybe if you look at commute time, commute type, transportation subsidies or faster transport may end up not looking so bad.
Great. Well, you got a comment about what happens to the units where these people are moving out. I'm curious about where these people are moving and what are the characteristics of those dwellings. And what I'm thinking about is the life cycle. I don't know if you have anything in mind, but it could be a network effect. If you're 45 or more, then you might have some kids or you can get some help from other people. I'm just wondering about the life cycle.
One small institutional question. I think under ELIS Act evictions, you're required to make cash payments to the households that move out. So part of the response, especially for younger households for which these cash payments are quite large relative to their net worth, is kind of a marginal propensity to earn out of wealth. So maybe they just feel richer and take a year off or 6 months off. And if you could identify some variation in that, that would be super interesting.
So very nice paper. I wish we had this great data when we wrote our rent control paper in San Francisco to have the LEHD data. That's amazing. So one of the results that we found that was actually surprising when we wrote our paper is that for rent control people, you would think that on average, they actually get less displaced. But when you look at their neighborhood quality, actually the neighborhood quality is worse for the rent controlled people than the non-rent controlled people. And what that's driven by is that, as you say, in these high rent appreciation areas, you actually get more displacement, right? So there's like selected displacement of these rent controlled tenants in these high rent appreciation areas. And then they are sort of displaced basically to these low neighborhood neighborhoods with low quality. We show they have higher unemployment, less college share, low median income, et cetera, et cetera. Very consistent with what you find. But I think but then it does raise, and we talk about in the paper how this could potentially be driven by these ELIS Act evictions, which especially early post-1994 were much easier to do than they are now, basically. But I think it does raise the question of, is this rent control, right? That they basically had rent control protections versus is this some treatment of the ELIS Act eviction itself? I lean towards it's probably rent control, but I'm not wedded to that. And to the extent that you can tease that out, I think that would be very interesting. And then on the empirical front, I think doing much more on heterogeneity would be very interesting here, because that was actually part of what we did in our paper as well. One of the interesting things that we found when we did our rent control study was that if you actually look at whites, they are more likely to be displaced out of their property, right? If they're not protected by rent control, but you're not more likely to be displaced out of the city, right? So these city displacement effects we found were actually quite concentrated among minorities. And that's why we said in terms of the rent control law, it actually did achieve one of the stated goals of the law, which was to limit minority displacement out of the city. And so when you look at minority displacement out of the city, which is very related to, having to move out of the city center, that actually seemed to be particularly concentrated among certain demographics. So I think the extent to which you can really tease out, what was the incidence of this on particular demographics would really strengthen the message. But very nice paper.
All right, speed round.
Okay.
2 final questions.
So this is a simple alternative mechanism that strikes me as a little bit more plausible. And that is the framing seems to be, we have evidence that these evictions are really horrible for people because they have lower income afterwards. I think the lower income is not something that happens to them as a consequence of not being in the right San Francisco neighborhood to know about jobs that have higher growth, but it's a choice they make when they endogenously move farther away, that they want to take a job that is closer and they're happy for that trade-off. They could have kept the San Francisco job and the hour-and-a-half commute over the Bay Bridge or BART or whatever, but they choose to say, I'll happily take a pay cut. And if that's the case, that changes the policy prescriptions, the mechanism's not in the model, all of that.
Thank you. And to put perhaps that thought
more pithily, who are these people who manage to find an affordable apartment within 5 miles of their original apartment? How do they manage it? What are they doing?
And that is the question that will take us to lunch. So, Charlie, we'll let you just say thank you, and then you can answer a very impressively long list of questions. And then we will resume lunch with after lunch at 1:10. The food should be right outside. You can either eat in here or across the way at the round tables. Thanks very much, Charlie.
Thank you, 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 thank you.
All right, we're going to get started. If everyone could find their seats. We are going to get started. Please find a seat. All right, thanks everyone. We have two shorter papers. The format for these papers is 20 minutes of presentation and then 5 minutes for discussion. And our first paper is the redistributive and efficiency effects of property taxes by Zong. Take it away.
Awesome. Thanks so much for having me on the program. So the high-level motivation for this project is that in the US, funding for local public goods, so think law enforcement and K-12 education, heavily rely on property taxes. So here I have data from the Census of Governments going back to the 1980s, and we can see that historically, about 1/3 of all local government revenue derives from property taxes, with the vast majority of the remainder coming from state and federal transfers. And in fact, in 2022, state and local governments collected $650 billion of property taxes, making property taxes actually the single largest source of tax revenue for state and local governments. So more than other commonly studied taxes, such as state corporate taxes or state income taxes. And despite the fact that property taxes are ubiquitous, traditionally in the local public finance literature, economists argue against property taxes. And so property taxes are actually a second best tax instrument because they distort consumption in two ways. So first, property taxes distort consumption away from housing. If I'm a homeowner, I decide to renovate my house and make it bigger, the value of the house goes up and so does my tax bill. And so this is sort of classic public finance 101. You tax the good, you distort demand for the good downwards, and that generates deadweight loss. Second, property taxes distort location choice because they're implicitly redistributionary. So in the same neighborhood, high-income households and low-income households have access to the same bundle of public services, but high-income households typically consume more housing and therefore pay more in taxes. And so kind of the cheeky example I like to give is I lived in Palo Alto with Mark Zuckerberg. We could both send our kids to gun high school. He lives in a $100 million bunker. I lived in student housing. And so he was paying a lot more in property taxes than I was. And it turns out we know very little, even just descriptively, how much redistribution is actually occurring through property taxes. So for example, in a world where we have perfect income segregation, that redistribution could actually be zero. And so this project tries to quantify exactly that equity efficiency trade-off inherent to property taxation. And so in order to think about that trade-off, I compare property taxes to two alternative tax regimes. And so first, I compare property taxes to head taxes, which are going to be this non-distortionary benchmark. So in sort of the classic TIBU 1956 model, local governments are supposed to charge head taxes or lump sum taxes per capita because the amount that a household pays then corresponds exactly to the cost of providing them public services. And so head taxes aren't just, this pie in the sky kind of tax. The United Kingdom has actually experimented a lot with head taxes. And so sort of the infamous example is in 1989, Prime Minister Margaret Thatcher converted the property tax system in the UK to a head tax system, though this did lead to a revolt and she had to resign 2 years later. And so as a more policy counterfactual, I'm going to think about, can we actually make property taxes more progressive? So in countries like, say, Denmark or Mexico, property taxes are nonlinear. When your housing value is above a certain threshold, you actually pay a higher marginal tax rate. And in fact, in 2024, Washington, D.C. became the first municipality in the US to implement a nonlinear property tax system. So there's going to be 3 sets of results in this paper. So first, I'm going to present you just some novel descriptive facts about property taxes. And here, crucially, I'm going to be able to measure what I call statutory intra-jurisdictional redistribution. So how much more do households pay relative to the average household in their tax jurisdiction? And so here, I'm going to find that households in the top income quartile pay about $2,000 more than the average household in their tax jurisdiction, whereas households in the bottom income quartile pay about $1,000 less than the average household in their tax jurisdiction. So this is going to suggest that, nominally at least, high-income households are subsidizing public goods for low-income households. To think about what this actually means in terms of welfare, I'm then going to develop a spatial equilibrium model of housing supply and housing demand. And I'm going to try my best to causally estimate reduced form parameters that are going to be sort of key parameters to the model. So here, one elasticity I want to highlight is I estimate that for every 1% increase in housing prices, households increase their housing expenditure share by 0.54%. So I reject sort of this common assumption in the literature of unit elastic demand for housing. And finally, I'm going to use my model to simulate counterfactual welfare under alternative tax regimes. And I'm going to find that compared to a non-distortionary benchmark, property taxes decrease housing quantity by 2.4%. So that's going to be that distortion. But it also decreases income segregation by 1 standard deviation. And so this is coming from redistribution, where households that make more than $250,000 a year implicitly pay transfers about $4,000, whereas households that make less than $25,000 a year implicitly receive subsidies about $1,500 a year. And finally, I'm going to find that high-income household mobility is going to heavily constrain any additional redistribution you can get by trying to make property taxes more progressive, because unless local governments could coordinate, high-income households vote with their feet to avoid redistribution. So where do I fit into the literature? There's a very large sort of theoretical literature going back to sort of 1970s, so with Oates 1972, that's argued that property taxes are distortionary. But this literature has been primarily theoretical, and so sort of my contribution is actually bring that theory to the data and empirically quantifying the redistributive and efficiency effects of property taxes. So what data am I going to actually use? I'm going to rely on 3 primary data sources. So first, I'm going to use the CoreLogic tax data, and that's going to give me parcel level property taxes from 2007 to 2021. So this is going to allow me to observe property tax burden by household. I'm going to use the CoreLogic deeds data, which is going to give me property transactions from 2000 to 2021. And this is going to give me some measure of housing consumption where I convert sort of property transactions to owner's equivalent rent using a pretty standard imputation process. I don't have anything about household demographics in CoreLogic. And so in order to get some measure of income, I'm going to merge the CoreLogic data to the Home Mortgage Disclosure Act, or HMDA, which is going to give me mortgage level income data from 1990 to 2021. And so one thing I do want to highlight is that my paper only allows me to observe income for homeowners. And so while in the US, that is about 70% of all households, homeowners typically skew richer than renters. And so to sort of partially address that sample selection, I'm going to reweight income that I observe to match the national distribution of income in the American Community Survey. I'm also going to use a variety of other supplementary data sets, but I won't get into today in detail what exactly those data sets are. Great. So how do property taxes work in the US? So for the renters in the room, basically how much you pay every year in property tax is going to equal your property value times some assessment ratio times some tax rate. And so county governments are in charge of assessing property values, collecting property taxes, and then distributing them to local governments. And so in most states, though there are some exceptions, that property value is supposed to reflect some notion of fair market value. So how much your house would sell on the market. State governments set assessment ratios, and don't think too hard about them. I basically just use these assessment ratios to calculate effective tax rates that allow me to compare then tax rates across states to make sure that I'm doing an apple-to-apple comparison. And then finally, local governments set tax rates. And so what is a local government in the US is actually quite complicated because it's sort of a combination of what county you live in, as well as the city and any sort of special districts, so school districts, fire districts, etc. But to a first order approximation for this paper, at least, you can think of local governments in this context as being school districts because the vast majority of property taxes go directly towards school districts, and school districts can independently levy property taxes. And so in my paper, I do a lot of descriptive work, but I just wanted to highlight 2 sort of descriptive facts that suggest that property taxes are indeed distortionary. And so the first is that households purchase smaller houses in areas with higher property taxes. So here, these are going to be bin scatters using transactions in 2021. I would focus on the bin scatter to the right, where the x-axis I have effective tax rate, and the y-axis I have log square feet of house purchases. So here I'm going to residualize for household income as well as local housing prices. And this is a descriptive exercise, but sort of taking these the bin scatter at face value suggests that a 1 percentage point increase in property tax rates is correlated with households buying sort of 5% smaller homes. And so this is suggestive of potentially that sort of deadweight loss that property taxes generate. Second, I find that within the school districts, richer households typically pay a lot more in property taxes. So here I'm giving you that measure of statutory intra-jurisdictional redistribution, where for every household where I observe sort of their income and property tax bill, I residualize the property tax bill by the average tax bill in their school district, and I aggregate households by income percentile, where here sort of the income percentile is going to be percentile according to the national distribution from the ACS. So that's where I'm getting those numbers in the introduction, where households at the bottom income quartile are paying about $1,000 less than the average household in their school district, whereas households in the top income quartile are paying about $2,000 more. So nominally, this is going to suggest that richer households subsidize local public goods for poor households. And so why do richer households pay more in taxes? They typically consume more housing as measured by square feet, as well as higher quality housing as measured by price per square feet. And in order to actually think about what this is going to mean in terms of welfare, then we're going to need a structural model to account for sort of GE effects. And so, when we potentially change the property tax system, this is going to cause households to potentially resort as well as consume different amounts of housing. And sort of modeling out that sorting is actually going to be first order when we think about redistribution, because that sorting directly determines the magnitude of the redistribution. And so with the model, on the housing demand side, we're going to have a pretty sort of classic kind of rows and rowback setup where we're going to have a unit mass of households that choose between J neighborhoods, where here neighborhoods are going to be school districts. Households are going to have heterogeneity in terms of their type. That type is going to sort of represent kind of their income group. And if a household chooses to live in a specific neighborhood, they're going to receive neighborhood-specific public goods, amenities, as well as an idiosyncratic preference shock. Well, here I'm going to model this as being a nested logit, where households first choose a commuting zone to live in, and then choose to live in a school district from that commuting zone. And so households are going to have nested CS utility preferences, where they consume high quality housing, low quality housing, and sort of non-housing consumption. Where here, eta is going to be that elasticity of substitution. And I'm also going to have two preference shifters, alpha theta and alpha j. Where here alpha theta is going to be kind of like a reduced form way to capture non-homothetic preferences. And then alpha j is going to capture unobservable quality differences between neighborhoods. So alpha j sort of represents the fact that people might just consume more housing in Menlo Park because houses in Menlo Park are a lot nicer than, say, houses in San Francisco. And this is going to be a subject to a budget constraint where how much a household consumes net of tax has to equal their neighborhood-specific wage. On the housing supply side, I'm going to sort of assume a kind of pretty standard setup again, where I'm going to assume some marginal cost function that gives me isoelastic housing supply curves. In terms of labor supply and labor demand, households of a specific type are going to produce type-specific labor. I'm going to have firms produce a tradable intermediate good that's sold nationally at a price of 1. And so free entry conditioning gives us that then their neighborhood-specific wage is going to depend on their type, as well as a neighborhood-specific productivity shock. So this is allowing for potentially some labor misallocation. Sort of empirically, that's not very important because most of the migration that I'm going to observe is actually going to be within commuting zone as opposed to being across commuting zone. And finally, just to sort of close out the model, I'm going to have a local government budget constraint. Where sort of in the full model, I'm going to have kind of a Tibu with politics set up, where the level of the public good is going to be determined by the median voter. I'm going to assume that governments produce public goods according to sort of a constant returns to scale. So each additional household is going to cost the local government the same amount. And so finally, I'm going to have a balanced budget constraint, which basically is just going to say like the amount that the local government raises in taxes needs to equal exactly the cost of providing them public services. So sort of the tax rate is kind of set endogenously to meet that balanced budget constraint. And so market clearing and balanced budget is then going to give us equilibrium. Great. So I'm not going to sort of have enough time to kind of talk about how I estimate each parameter, but sort of one parameter I want to highlight is that elasticity of substitution and sort of what I get when I do estimate it. So I apologize, there's like very little context here, but I want you to just focus on the last column where when I estimate eta using a wall focal instrument, I find that for every 1% increase in housing prices, housing censorship shares actually increased by 0.5%. So I sort of reject this common assumption in the literature that households have Cobb-Douglas preferences for housing, which say that that estimate should be 0. And so kind of just like benchmarking that relative to the existing literature, there's actually, we don't actually have a lot of work estimating what that elasticity should be like. And so there's really two that do that in the US, the Albu et al. 2016 paper and the Finlay and Williams 2022 paper. And they do get something that's sort of within the ballpark of what I estimated. Great. And so I put all my estimates together with my model. And so here on the demand parameters, I'm going to basically just take the estimates that I estimate. On the supply parameters, I'm going to use the housing supply elasticities from the Baum, Snow, and Hahn 2024 paper to get sort of those productivity parameters that are specific to each neighborhood. I use commuting zone wage effects from the Card, Rothstein, and Yi 2024 paper to basically model out kind of how much local governments have to spend. I calculate mean per residential parcel using CoreLogic tax data. I'm going to get sort of the distribution of household shares by income. I'm using data from the IRS. And finally, I'm going to convert those sort of income to actually budgets, sort of using basically the NBER tax stamp. And so you might, wonder like, okay, great. There's a lot of moving parts of this model. How much should we actually trust the model? One thing I do is I validate the model by trying to replicate quasi-experimental literature. So there's this Lutz 2015 paper that looks at a policy reform to property taxes in New Jersey. And when I use my models to sort of simulate what that policy would do, I actually get effects that look very similar to what the Lutz 2015 paper gets. So to think about counterfactual welfare, I'm going to evaluate sort of counterfactual welfare under 3 different tax regimes. So first it's going to be status quo. This is just going to be ad valorem property taxes. I'm also going to simulate head taxes, or just lump sum taxes per household. And then finally, I'm going to simulate progressive property taxes, and I'm going to sort of, structure this sort of similar to how Washington, D.C. does it. And so the way I'm going to implement this is I'm going to set a county level kink at the 75th percentile of housing consumption in the status quo world. And I'm going to allow the marginal tax rate then to jump at this kink. So this might, double, triple. This is something that I sort of set. And then I'm also going to simulate 2 cases. In the first case, I'm going to simulate a world in which all school districts implement a progressive property tax. So this is going to be kind of a centralized world. And then I'm going to also simulate a case in which only the largest school district in each commuting zone actually implements a progressive property tax. And so this is going to be a decentralized world that lets me think about high-income household mobility and whether high-income households can vote with their feet. Great. So here, I'm going to plot then what happens when I sort of go from property taxes to different tax regimes. Where on the left, this is going to look at property taxes to head taxes. And on the right, I'm going to look at property taxes to progressive property taxes, where at the kink, I'm going to allow the marginal tax rate to triple. And so this is going to be the world in which only the largest school district in each commuting zone actually implements progressive property taxes. So this is going to be the decentralized world. So here, the distribution is going to be what happens in each neighborhood, and the dashed line is going to reflect sort of the aggregate average. And we can see that going from property taxes to head taxes, we're going to sort of reduce, we're going to get rid of that distortion that's going to push up demand, and we're going to see sort of increase in housing prices by about 3%. In the progressive world, we're sort of increasing kind of the amount of distortions that we're doing because we're increasing redistribution, so that's going to push prices down by 1%. And we're going to see corresponding changes in housing supply, where in the property tax world, going from property taxes to head taxes, that's going to increase housing demand and housing quantity by 2.4%. But going from property taxes to sort of progressive tax, that's going to push down demand and decrease then housing quantity by about 1%. And so then we can think about what this does to income segregation. And so going from property taxes to head taxes, that's going to increase income segregation because under head tax world, we don't have that redistribution. And so we're going to price low-income households out of expensive neighborhoods. And we're going to see about a 1 standard deviation increase in income segregation under the head tax world. And going from property taxes to progressive taxes has more of a kind of a nuanced effect in terms of income segregation, because we're going to see that high income household sort of mobility resort, and we're going to get this kind of bimodal distribution where some neighborhoods are going to become a lot more segregated as sort of the high income people concentrate together, whereas other neighborhoods we're going to see a decrease in income segregation as we get more redistribution. And then we can think about what this does in terms of welfare. And so here I'm going to translate changes in welfare. I'm going to convert that to dollar terms by thinking about compensating variation. So how much more additional income would I need to give a household in order to make them as better off as before? So here, this is where I'm getting that households that make less than $25,000 a year, they sort of implicitly are receiving subsidies about $1,500 in the property tax regime, whereas high-income households, so households that make more than $200,000 a year, are for making more than are sort of paying transfers about $4,000. And so I kind of abstract away from sort of welfare aggregation in paper, but that's sort of something I'm currently working more on. And then finally, we can look at what happens when we make property taxes more and more progressive. And so here, this multiplier is going to be how much the tax rate sort of increases at the kink. And then here, you can look at the top left, that's going to be welfare for low-income households. And you can see that in the decentralized world, where only the largest school district implements a progressive property tax, you don't actually get that much more redistribution. You get about $70 more. And there's sort of a Laffer curve situation where it's a little bit hard to see here, but that actually their utility goes down after a while because the distortions sort of outweigh that redistribution. And so if you actually want to get a lot more sort of redistribution, you need progressive taxes to be implemented by all governments. Great. And so since I have 1 minute left, just to conclude, so in this paper, I first measure statutory intrajurisdictional redistribution from property taxes. So here I find that households in the bottom income quartile pay about $1,000 less per year, whereas households in the top income quartile pay about $2,000 more per year. I then estimate general equilibrium model of like housing supply and housing demand, and I find that a 1% increase in housing prices increases housing expenditure share by 0.54%. And finally, I simulate counterfactual welfare under different tax regimes. And I find that in the status quo, low-income households receive implicit transfers of $1,500 at a cost of 2.4% housing quantity, and that high-income household mobility is going to severely constrain how much additional redistribution we can get. Right, thanks so much.
All right, we have a few minutes for questions and comments. I'm holding the microphone. So one question I had was about the measurement of income and thinking about income of cash buyers, where cash buyers are very bimodal. So you have very small dollar homes are often bought with cash, but also many multi-million-dollar homes are bought with cash, and that's going to have differential effects in different locations. And also if you're using income at the time of mortgage origination, income growth, 20 years later, it might look very different for different groups over time.
So there are things like housing transaction taxes in other places that might be worth saying something else about if you can. My sense would be that it's probably fairly harmful, but it's and I think thinking a little bit more about, the Henry Georgist in me sort of like wants more on like land taxes versus taxes that scale with property. And obviously like thinking about how that distortion works, like it differs is also valuable.
I was gonna suggest kind of a political economy exercise, which is that, can you tell me the Pareto weights on different groups, K, that makes the current tax system the one that maximizes welfare?
Could you tell us a little about jurisdictions? So current jurisdictions are conditional on the existing tax system. And while I agree that there's redistribution within a jurisdiction, I don't think that redistribution within Palo Alto is doing too much for poor people. Yeah.
All right. Thank you so much. We only have time to give questions and comments, but no time to respond to them in these shorter sessions. So we will encourage you to follow up over the breaks and at dinner. Our next speaker is Sean McCullough, who is presenting Valuing Neighborhood Amenities with Continuous Spatial Difference and Differences.
Okay, thank you for that introduction. So the motivation for this project is that many important events occur at a particular location in space and time. So as a running example throughout this talk, you can imagine an industrial plant opens at a particular address and it spews chemical pollutants into the air. We expect the strength of those pollutants to be stronger closer to the plant and then to dissipate as you get farther and farther away. But many different kinds of treatment event can be framed as taking this sort of a structure. So the opening of a bus station or the construction of a low-income housing development may have externalities like traffic or noise that we'd also expect to dissipate with distance from the treatment site. At the same time, we have this idea that house prices capture information about what people like or dislike. So if we see that prices are lower, closer to one of these industrial plants, we take that as evidence that people don't like the plant, and in some sense, it's bad for those nearby homeowners' welfare. A common research design to try to evaluate these price effects is a ring difference in differences. So typically researchers specify a binary threshold, like say 500 meters from one of these industrial plants. They're then going to compare trends in houses that are within 500 meters to the trends in prices for houses that are a little bit farther away. It could be 500 meters to a kilometer away before and after that plant opens. Now, there are many different applications of this design, but keeping with this industrial plant example, Curry, Davis, Greenstone, Walker look at plants that are known to emit chemical pollutants and find that the opening of one of these plants lowers prices by about 2% over 800 meters. Now, in this project, I want to tackle two overarching questions. So the first is an econometric question. What are we really estimating when we're doing these kind of ring DID designs? So I think typically researchers have specified a binary threshold or maybe a few discrete thresholds, but that's largely out of convenience so that they can fit this setting into a more standard binary DID framework. But it's probably more natural to think of this setting as having a continuous treatment that's continuous in distance to the treatment site. The second question is an economic modeling question. So given you have some reduced form price effect estimate, how do we translate that into statements about homeowners' preferences or homeowner welfare? So in this project, to start, first I develop an econometric framework for these kind of spatial settings that's up to date with some of the recent applied econometrics literature on DID with a continuous treatment. And in particular, I'm going to adapt the framework from this recent Callaway et al. Article. It's a potential outcomes framework that allows for heterogeneous treatment effects. And here, the potential outcomes in this setting are going to follow a continuous price function. And importantly, that lets us start thinking about the price derivative. So why are we going to this extra trouble to think about continuous effects as illustrated by and exploited previously by Don McQuaid? A continuous effect is what you really want if you want to relate this to the standard hedonic model, where the key equilibrium condition is that the derivative of a continuous price function equals homeowners' marginal willingness to pay to be farther away from a treatment site. So in that polluting plant example, the hedonic theory would say more specifically that if the slope of price is positive with distance away from the plant, then homeowners are willing to pay to be farther away from that source of pollution. However, a central contribution in this paper is showing that once you have this framework that allows for heterogeneous treatment effects, you almost immediately have an identification issue where the derivative of your difference in difference estimate is not going to identify the hedonic price derivative, so you're not going to identify homeowner preferences through this key marginal equilibrium condition. But I'm going to argue it's still possible to derive bounds on homeowners' preferences under an alternative assumption of treatment and effect concavity, which I argue in many of these ring DID applications is a natural shape restriction that's consistent with how we'd expect spillovers to decay over space. I then revisit a few of the key hedonic applications in the literature and compute those preference bounds. Today, I'm just going to focus on one application, polluting industrial plants. And I'm going to estimate that the homeowners surrounding a polluting plant would be willing to pay between $13.1 and $19.5 million in total to avoid the utility loss that they're suffering from that plant. So as an outline for how this talk is going to go, I'm going to start out with a graphical intuition for what we're trying to estimate and how it works out cleanly when you have homogeneous treatment effects. I'm then going to introduce treatment effect heterogeneity by distance to a polluting plant, and we'll see that leads to loss of identification on the price derivative, but then I'll provide an alternative argument that gives a conservative lower bound on that derivative. I'm then going to propose an estimating procedure and apply it by revisiting this Curry et al. Application to polluting industrial plants. And then I'll translate the reduced form price effect estimate into bounds on preferences using a model that's similar to Don McQuaid, but again, focused on relaxing that treatment effect homogeneity assumption. So in this figure on the right, I've plotted average house prices as a function of distance to a polluting plant. The blue line shows the pricing gradient in the pre-period. And with the way I've drawn it, you can see that prices are lower, closer to the plant, even before it opens. This is reflecting the fact that these plants tend to be sited selectively into locations that have lower housing values. The orange line shows the pricing gradient in the post-period. With the way I've drawn this example, house prices have depreciated everywhere, but they've depreciated more for those houses that are located closer to the plant, reflecting the additional contribution of pollution onto housing values. The two black vertical braces show the time trend at two locations, D prime and D bar, where D bar indicates the location that's far enough away from the plant that houses' values are no longer affected by the spillovers from the plant. We can construct a 2x2 difference in difference comparison by subtracting off the time trend at D bar from the time trend at D prime, and that gives you a price effect estimate for being D prime away from the polluting plant. But you can also imagine constructing a similar estimate at every point along that interval from 0 to D bar, and that's going to give you a continuous difference in difference estimator. So in this next figure, the red line represents the output of that continuous difference in differences along that interval. And let's, for the moment, assume that that is the hedonic price function. So that captures the true relationship between price and proximity to a polluting plant. Well, in that case, homeowners' indifference curves or bid curves are going to lie tangent to the price function at every point along that interval. And here at D prime, I've shown one homeowner's bid curve lying tangent to your DID estimate, or the red line at that point. And the importance of this tangency condition is that the derivative of the red line, evaluated at D prime, is going to give that homeowner's marginal willingness to pay to live farther away from the polluting plant. Now, just the key takeaway that I want you to get from this slide right now is that if we're interested in estimating preferences through this equilibrium condition, then it's not a level treatment effect that we're interested in per se, it's really this price derivative. So now I'm going to introduce treatment effect heterogeneity by distance to a polluting plant, and we'll see that leads to loss of identification on that hedonic price derivative. So now instead of thinking of our continuous difference in differences as this one-dimensional function, we're going to think of it as an average treatment effect on the treated that takes two arguments. So the first argument is, again, treatment intensity, that's pollution exposure as indexed by distance to the plant. And the second argument is going to be the treatment group subpopulation. So as an example, we can observe the average treatment effect for being 3 kilometers away from a plant among housing units that are actually 3 kilometers away from the plant. But we can't observe the average effect for being 1 kilometer away from a plant among housing units that are 3 kilometers away. And this is the direct generalization of the concept of an ATT to this continuous setting. Now, what's the problem with this heterogeneity? If we take the derivative of our ATT function with respect to D, we're going to move both of these arguments. So we're going to mix together both that change in treatment intensity with the change in the composition of housing units that tend to be located at these various distances from a plant. For evaluating the hedonic derivative, we want just the change in treatment intensity. So in response, as in Callaway et al., I'm going to introduce this new estimand. It's the average causal response, or in this context, that would be the average price derivative, which is going to be the derivative of the ATT function, but where we've imagined we can hold fixed that second argument, the treatment group subpopulation. We're going to walk through a graphical example on the next slide of exactly what I said in this slide. So in this figure, the red line is, again, the output of the continuous DIDs. This is what you observe by doing difference in differences. The two gray dotted lines are new, and they show counterfactual average treatment effects, but where we've imagined we can hold fixed that treatment group subpopulation. So the top left line holds it fixed to those housing units that are actually 1 kilometer away from a plant, and the middle gray line holds it fixed to the units that are 3 kilometers away. Now, in this example, those units that are actually 1 kilometer away would have had smaller negative effects on average at any given pollution exposure level compared to those units that are actually 3 kilometers away. Now, to make this example a bit more concrete, if you imagine that industrial plants tend to be sited in locations that have fewer trees, and pollution from a plant kills trees, and homeowners like trees, so when a plant opens up and kills more trees in a geographic area, then the houses there lose more value. Well, in this example, those housing units that are actually 1 kilometer away from a plant would have had smaller negative effects on average at any given pollution exposure level compared to those units that are 3 kilometers away because of their difference in baseline characteristics. In this specific example, that was the amount of trees in their neighborhood, but it could be any other housing characteristic or neighborhood characteristic that would be correlated with distance and interact with the price effect. Now, what's the problem with this? If we take the derivative of our difference in difference estimate, the red line is often negative, but the derivative of those two gray dotted lines is always positive. Now, viewed through the hedonic model, our difference in difference estimate is suggesting that many homeowners prefer to live closer to the plant, despite the fact that in this example, every homeowner prefers to live farther away. So it's at least conceptually possible to come up with these kind of scenarios where if there's severe selection bias, your difference in difference derivative can not only not identify the price derivative, it can even have the wrong side. So what's an alternative assumption or alternative argument we can make to try to get traction back on this price derivative? So we're going to maintain that we have these heterogeneous response curves. In this figure, it's the same figure from before, but I'm just focusing on that middle gray line. Well, we're going to impose that we're going to impose that these counterfactual curves have a concave form. So here you can see the gray curve is concave. Now, this is also an assumption, but I'd argue in many of these ring DID applications, we're ex ante motivated by the expectation that the spillovers would take this shape. So as an example, if your house is several kilometers away from a polluting plant and we counterfactually moved it a few blocks closer to your house, maybe that doesn't have such a large impact on your house's price. On the other hand, if your house is just a few blocks away from a plant and we moved it right next door, that could potentially have a large negative impact. So say we make this assumption, what does that buy us? Well, we have that there's zero treatment effect at some control distance, d bar, and we observe the ATT in this example at 3 kilometers away, and we can connect the dots between those 2 points, and given our concavity assumption, our linear extrapolation to the price derivative is going to be less than the slope of that counterfactual gray curve that we can't observe. And you can see that because the diagonal blue line is going to be flatter than any concave function that passes through those same 2 points. Now, viewed through the hedonic model, simply using the rise over the run relative to your control distance is going to be a conservative underestimate of homeowners' marginal willingness to pay to be farther away from the plant. And I'll use this result in the empirical application to put bounds on homeowners' preferences. So now I'm going to propose an estimating procedure and apply it by revisiting this Curry et al. Application to polluting industrial plants. So if you remembered this figure from the beginning of the talk, we had these pre and post period pricing gradients, and we wanted to construct difference and difference comparisons along that distance interval. This next figure is still hypothetical, but trying to get closer to how we do it with housing sale microdata. So in the figure on the left, each X represents an individual house sale, and I've plotted them as following those pre and post period pricing gradients with some additional noise. In the figure on the right, I've grouped each housing sale into different rings or bins by distance to the treatment site. And then I've calculated an average house price within each ring indicated by the constant fit lines. These averages form repeated cross sections over time, and I can construct 2 by 2 DID comparisons exactly like in the previous slide. So I'm going to subtract off the time trend or vertical distance at D bar from the time trend at D prime. And that gives me a price effect estimate for being D prime away from a plant among housing units that are actually D prime away. In this example, I have 6 of these rings, so I'm going to have 6 comparisons, 1 for each ring, where the rightmost ring is zero by construction. So now turning towards some actual data, there are 2 main data sources for this analysis. The first is a set of treatment events. In this application, that's going to be the address of an industrial plant and a proxy for when it opened by the first year that it appears in the EPA's toxic release inventory database. I'm going to find a little under 12,000 of these plants that opened during my study time period. The second data source is the outcome variable, it's housing sales. And here I'm going to have the relative universe of single-family house sales in the US covering a time span of roughly 1990 to 2020. I'm then going to find those sales that occurred within 6 kilometers of one of these industrial plants and aggregate them to one of those plant by distance bins in those hypothetical figures. So in everything you see today, unit of observation, it's going to be a plant by distance bin with an average house price in the pre and post periods. So these next 2 figures show an example of the binning procedure for just one plant in my sample. So in the figure on the left, the blue dots show average prices in the 5 years before a plant opens. The orange dots show average prices in the 5 years after. And I can construct 2 by 2 difference and differences exactly like in those hypothetical diagrams. So I'm going to subtract off the vertical distance in the rightmost bin from the vertical distance at each bin along the x-axis. In the figure on the right, I've plotted these comparisons, 1 for each bin. And you can see that for just one treatment site, the estimates are fairly noisy, but at least for this one plant, they look like they get more negative closer to the plant. I'm then going to repeat this process for the remaining 11,848 plants in my sample. That gives me about 300,000 of these price effect estimates at various distances from a polluting plant. And so I now have a large number of these difference and difference estimates, and I've tagged them with the distance D. So I've reduced my problem to just a one-dimensional regression where I want to trace out the relationship between price and distance. Now, in principle, this could be any kind of regression. In practice, I'm going to follow a suggestion in Callaway et al. And use non-parametric sieve regression. So these 2 figures are my main price effect estimates. In the interest of time, I'm going to focus on the figure on the right. It compares average prices in the 6 to 10 years after a plant opens to the 5 years before. The red line is the continuous DID estimate, and you can see that house prices depreciate in value by about 3% if a house is directly next to a polluting plant. That price effect decays over space to 0 at about 4 kilometers. Now, this red line in the figure on the right, I'm going to take as my main price effect estimate, and now I'm going to consider using it as an input into the hedonic model to get estimates or bounds on homeowner preferences. So as a very brief overview of the model in this paper, it follows Dine-McQuaid closely. The main difference, again, is that I'm focusing on relaxing one assumption, the treatment effect homogeneity assumption, but that's important because it relates to this equilibrium condition where the derivative gets marginal willingness to pay to live farther away from the plant. If you impose additional parametric assumptions on homeowners' utility functions, that buys you a lot of tractability. You can solve for an aggregate welfare measure in one relatively simple estimating equation, where the key input is really those marginal willingness to pay as estimated by a price derivative. I'm then going to compare using either the ATT derivative, which imposes treatment effect homogeneity as my estimator, or the rise over the run, which I argued we should expect to be a conservative lower bound. In the hedonic context, it's also possible to construct an upper bound in this setting by just totaling the reduced form price changes, and that relies on previous arguments from the hedonic literature. So here I've written the estimating equation that I take to the data. The total amount that homeowners in the affected area would be willing to pay to avoid the utility loss from the plant equals the number of affected homeowners multiplied by a measure of their average willingness to pay over the affected area. So if we look within this integral, that first term is that average price derivative capturing marginal willingness to pay. Y bar is the average house price. That's just to convert from log scale back to levels. And then we have some additional terms, which are clearly coming from our parametric assumptions on the utility functions. And then F of D is just the PDF of housing units to make this an average. Now, this is a one-dimensional numerical integration problem. You can solve it with standard methods. If I evaluate this equation using the ATT derivative, which imposes treatment effect homogeneity, I get a point estimate that homeowners would be willing to pay $16.4 million to avoid the plant. If I instead evaluate this equation using the rise over the run as my estimator, I find that homeowners would be willing to pay at least $13.1 million to avoid the plant, and then I can complete the bounds by totaling the price changes. So this is just one application. It's anecdotal, but the way I would interpret these results is maybe a homogeneous treatment effect assumption doesn't lead to that much bias. It does lie within these bounds, but you can also get a conservative lower bound that's heterogeneity robust under the concavity assumption using a relatively simple estimator. So just to wrap up, in this project, I'm adapting some of the recent applied econometrics literature on DID with a continuous treatment to this setting. We care about continuous effects if we want to relate this to the hedonic model's equilibrium condition where the derivative gives marginal willingness to pay. However, that derivative is going to have econometric identification issues unless you impose additional assumptions beyond the standard DID assumptions. I then argued for a partial identification approach using a shape restriction I think is natural in many of these settings, and then I revisit a few key hedonic applications and computed those preference bounds. There's a number of other results that I think are interesting from an applied perspective. Unfortunately, I don't have time to go through them today. Thank you.
All right, great. Thanks, Sean. Questions and comments?
There you go. Fabulous. You're making some of us really, really proud. Can we use your approach to solve, I think, what is a very similar problem conceptually, which is whenever you have an equilibrium with assignment for housing, you also have a whole bunch of conditions satisfied by very different people. And when there's a shock, trying to understand the effect of the shock is really hard. So I think well, your problem is conceptually well similar to that one.
Can I respond sequentially? So I think a lot of assignment models are, as you point out, very similar to the hedonic model, and I would imagine there are marginal conditions like that. I'd say the concavity restriction is a little bit specific to these ring DID applications, but maybe it also applies in the settings you're imagining.
Or maybe you could use your approach to try to solve those models because we know how they work in theory. In practice, it's much harder.
Okay.
Just to say, I think it's obviously really important to get a better estimate of the average like you're doing. But I think a lot of settings, we want to understand heterogeneity. And so I was wondering if you thought about either like how to bake in limited heterogeneity ex ante, essentially like on observed dimensions, and then you assume homogeneity conditional on those observables, or could what like the building blocks that you're estimating be used kind of after the fact to decompose heterogeneity? And then if so, I guess I have questions about like inference and power and things like that.
Yeah, great. So for the first question is essentially, can we use observables to try to better understand the heterogeneity? And I think in this paper, I've really just come from the starting point where all you have is that distance, and I haven't really taken advantage of, I think there's various ways you can imagine using observables to deal with the affected heterogeneity or explain it, but that's not really an avenue I've looked down. I've mainly been focused on there's some unobserved heterogeneity, and that's what I'm working with. In terms of inference and estimation, I would say, the primary focus in this paper is on that identification of the causal parameter. I've focused a lot less on inference, but so I think that would be a fair point in an area for more research.
I share Gilles' I share Gilles' extremely positive view of this. I think it's really great. I do wonder, and I also want to echo just the last thing. I don't think like controlling for observables makes any sense. I think your approach makes more sense. I do think just pedagogically in terms of showing your trees, if you could actually show a real thing where like the trees do go down more, there is something like that to make that I think that would be effective in terms of presenting things. And I really just wanted to throw out a different type of heterogeneity, which is I have long thought that the biggest problem with every hedonic model is that the people change with the amenities. And so you're always estimating a compound treatment, which is like I'm getting different neighbors if I'm getting a toxic waste plant nearby. And when I'm throwing those things together, I'm getting the full treatment effect on the property value, and you're estimating that with your stuff, but I'm not getting the full social cost of that because like poor guys moved away from there, but maybe they moved, poor guys might move toward there, but maybe they moved away from some other, and then there's the whole accounting. And so I just wanted to put that in. That is not a thing for you to think about in the next 6 months other than like, but like that is very big game that's out there and very important game.
Yeah, great presentation. Actually, I worry you almost undersold it a little bit there in that, I mean, I get the point obviously about the derivatives lining up to marginal ones to pay, but the derivative is just the limit of the finite difference, right? And with the finite differences, we get indifference conditions instead of first order conditions, but that's not really a big deal. It seems like the problem you describe isn't one that only exists at the limit. It actually should apply for like when you have these rings as well. And that's to that extent that I think the paper has even more application.
Should I try to respond to those? We out of time?
I think we're out of time.
Okay.
Nice job, Tom. So now that people have had a chance to trickle in this morning with various travel challenges, we thought this would be a good time to very quickly go around the room and do some introductions. It's a big room, and so I'm going to encourage people to shout their name and their affiliation. And Tomek, why don't you go first?
Tomek Piskorski from Columbia.
Ben Keys from Wharton.
Stan Vanny-Ruper, Columbia.
Ed Glazer and Harvard. I'm here in Boston University.
Milena Marro, Chicago.
Hector Blanco, Rutgers.
Evan Soltis, Princeton. Renan Ferreira, Wharton. Gigi Otto,
Alison Schutzer, the Philly Met.
Juan de Rutte, Columbia.
Honguti, UK.
Doug Davis, Columbia. Cody Beck, Yale.
Brad Ross, Wharton. Long Paul, Stanford.
Laura Weiwu, Berkeley.
Naomi Hausman, the University of Houston.
Arjun Vayati, Notre Dame. Roman Lyons, Trinity College Dublin. Keith King, Boston College.
Nate Bell Snow, Charles Hopkins.
Brian Stewart, Philly Fed. Jonathan Jingle, Columbia.
Jack Linderson, UC Irvine. Jake Victor, University of Washington.
Cameron LaPointe, Yale.
Carlos Hurtado, University of Richmond. Neil Shop, Eastern Columbia. Marco Gonzalez Navarro, Berkeley. Olivia Wooden,
Francesco J, Virginia. Rodney Rancheron, USC.
Hotel Wolf, Vermont.
University of Wisconsin, College.
Mapaz de Chinese Dallas. Vinícius Santana, Cal Poly. Amy Schwartz, University of Delaware.
Cornelico, Geneva.
David Clancy, Bedford. John Warren Medina, University of Texas San Antonio. Tom Holmes, Minnesota.
Kate Bennington, USC Fitzgerald.
Matt Turner, Brown.
Alvin Murphy, Arizona State.
Christopher Palmer, MIT. Rob Collinson, Notre Dame.
Bill Wheaton, MIT. Baldwin, Philly.
Wei Liu from Northeastern. Heidi R.T. Wharton. Jillian Meyer, also Wharton. Lee Martin from Georgia. Abby Ostraker, Boston University.
Sean McCullough, from Brown.
Joe Jerko, Wharton.
Sinai, Wharton.
Dan Hartley, Chicago Fed. Vincent Hurley, Stanford. Steve Bellis, University of Colorado. Jeff Lynn, Felipe.
Leah Brooks, George Washington University.
Anna Schneider, the
Antoine Moody,
Aradia City, University of Toronto.
everyone. All right, excellent. Let's take a 10-minute break and we'll be back at 2:10. So,
All right, we are really going to get started now. Please find a seat. All right, we are going to get started. The next paper is the fiscal externalities of transaction taxes, evidence from the Los Angeles mansion tax. And we have Jack Lieberson presenting.
Thank you. So to start off with, I'm going to talk about property taxes, which are highly salient and very unpopular. People in many places have to actually make the payment sometimes multiple times a year and pressure local governments to reduce the tax liability in various ways. Most prominently, many places, and in particular California, have enacted various limits or caps on their property taxes. So California's famous example, which I'll describe more in a second, is Proposition 13, which caps reassessment of properties between sale. Other states either have similar types of rules or are considering something similar. Florida has the Save Our Homes program, and there's a similar program in Michigan. And right now, in fact, property taxes are under discussion around the country in various ways to limit them. Another type of tax, which exists in California and elsewhere, are property transfer taxes, also known as stamp taxes, or I don't know, they have various names in different places. In many places, and in particular in California, they reflect a desire for some sort of way of taxing property that is not an ordinary property tax. Basically, they impose a percentage sale tax on properties, sometimes above a certain threshold, sometimes limiting the extent of taxes to certain categories of real estate. What we describe in this paper is a fiscal externality of transfer taxes onto ordinary property taxes when they're capped the way I just described. We evaluate the fiscal externality in the setting of a new property transfer tax in Los Angeles called the LA Mansion Tax. Now, when I say fiscal externality, this is from one tax base onto another, not necessarily across jurisdictions, which is how sometimes people think about fiscal externalities. What we show here is that because of this fiscal externality, the amount of tax revenue that's raised from the new transfer tax is actually only a small fraction of the headline number that's being collected. Let me say a little bit more about the setting. Measure ULA, or the LA Mansion Tax, is a up to 4.5% tax on property transactions above $5 million. It was passed by voters in a local referendum in November of 2022, and it came into effect of April 2023. In brief, what we show is that high value transactions, that is above that $5 million, fall by around 50%. The exact number depends a little bit on how we estimate it. 26% on an unweighted basis, 50% weighted, and the responses are much larger for commercial property. What that means is that properties are transacted less often. And in California, as in other states with reassessment caps, the value of tax assessment depends on how often they're transacted. Every time the property is transacted, it gets reassessed. And so any law which limits the number of transactions will therefore limit the amount of reassessment, with the resulting effect that the amount of revenue raised is lower. And in a slide or two, I'll show you precisely how that works. Our headline number is that something like 80% of the tax revenue is lost, and under assumptions that we consider fairly realistic, potentially over 100% of the revenue from the new tax is lost in present value terms because of lower future property tax collections. Let me say a little bit more about how Prop 13 works and Measure ULA so that you understand the context and how this fiscal externality comes about. So Prop 13 has various components. The important one is that properties are only assessed, fully reassessed when they're sold. And between sales, there's a cap on the amount by which assessment can grow, and that's up to 2% per year. Beyond that, the level of property taxes is capped at 1% throughout the state of California. This law was passed as a ballot measure that amended the state constitution in 1978 as part of the famous tax revolt, and has since affected and distorted the entire tax system of the state of California in various ways. What it's led to most recently in Los Angeles is a desire to enact some sort of progressive taxation that somehow gets around the limits created by Prop 13. A ballot measure introduced in 2022 proposed just such a way of trying to progressively tax housing. Measure ULA is called the LA Mansion Tax, applies a 4% transfer tax to sales between $5 and $10 million and 5.5% above $10 million. So it's called the LA Mansion Tax, but actually it applies to all types of property. So that means multifamily, commercial, office buildings, industrial, everything that's sold. And it's very hard to find ways to either avoid it or to legally evade it, in part because there's a sophisticated system for measuring tax rules and tax assessments created by Prop 13. The revenue from it is earmarked for affordable housing in California, where basically the county would set aside the money to build multifamily housing. And the proponents of it said that it would create affordable housing and it would create jobs, union jobs, and as many as possible. So in practice, that means hiring workers for short periods of time, and then they leave the job site and then they hire another one to maximize the number of jobs created. So the supporters emphasized mega mansions and wealthy sellers earning high capital gains from their home sales, given the recent price increases in California. Critics of the law at the time warned that it would lead to fewer sales and less construction. In this paper, we don't focus so much on the construction channels, but there are recent reports from UCLA and from RAND that suggest that construction has declined since then, validating that concern. The framing of the law was really focused on residential, and as far as we could tell, either proponents or opponents of the tax never discussed the potential fiscal externality that we show can happen in the paper. So I'm going to start by talking about the amount of revenue that was actually raised by the tax, and then describe the mechanism for thinking about the amount of money that's lost due to lower property tax collections. So there was a forecast of $672 million, I believe, in the first year. Only half as much revenue was raised. Now, part of that was because of the behavioral response to the tax that wasn't taken into account. After the tax came into effect, transaction volumes fell, and that meant that there was less money to raise. Another reason is that the law unfortunately passed at just the same time that interest rates increased, which also independently reduced the transaction volume. And so for both those reasons, the tax hasn't raised nearly as much money as proponents had hoped it would. Now let me talk about the mechanism that we have in mind, which is related to the interaction between the mansion tax and Prop 13. I'd like you to consider a mansion or potentially an office building that, absent the tax, would sell at time t0. You can see in the figure here, time is the x-axis, the y-axis is the annual property assessment on the property. If it sold without ULA, the tax assessment would jump up upon sale and up to where the green dot is. And from then on, it would raise higher revenue going forward. With the tax, we want to imagine that the sale doesn't happen at time t0, but is delayed perhaps until time t plus 5. When it's delayed, the property is then reassessed, potentially to a higher amount than it would have been otherwise. But it means that there are 5 years of missing tax revenue due to the delayed reassessment. Okay. Our goal is to take the intuition from this figure to generalize it using a very simple model, which basically amounts to a present value calculation, complicated present value calculation. And then estimate its effects using the data on foregone sales in the city of Los Angeles. So we're going to begin with showing the raw data and the estimation strategy to show how many sales were discouraged. Then I'll describe the model. The model has the convenient feature that the object needed to identify it is precisely the estimate of the Poisson diff and diff. Okay, the data we're using is core logic data on assessments and deeds through 2023. Unfortunately, the data quality degrades a little bit at the end of 2023 because people take time to register their sales. But we've since gotten new data, which has extended it and shown that the results continue to hold. Besides that, we measure receipts and transactions on commercial properties from CoStar and assessments from the LA Office of Finance, which conveniently makes assessment data for the entire county publicly available. Our basic strategy for the difference in differences design is to compare parcels above 4.9 million to below 4.9 million, and within the city of Los Angeles to outside the city of Los Angeles. So for those of you who don't live in Southern California, LA is both a county and a city. LA County includes a large number of municipalities like Long Beach, Santa Monica, and West Hollywood that are not included in the city of LA. The largest of those is unincorporated parts of LA, or of LA County, that have roughly the same population as the city of Los Angeles itself. So the control region is going to be non-city parts of LA, excluding a few areas that also have transaction taxes. The treated region is going to be the city of Los Angeles. And then we're going to think about, validation exercises looking below 5 million and so forth. The basic specification is plain vanilla Poisson diff and diff. And the coefficient of interest is the treat times post indicator. Now, in addition to the treat times post indicator, you'll see a treat times anticipation indicator here. That's because the tax was passed in October 2022, but only came into effect of April 2023. And so there are a large number of transactions that happened in that short window of time when people knew the law was coming, but it hadn't come into effect yet. And we want to account for those transactions, both show them graphically and think about how that might distort the estimates of the long run effect. Okay. We weigh by lagged assessed values and do various robustness checks on that. Okay, so let's start with the raw data. What this figure shows is the quarterly reassessment amounts in LA compared to outside of LA. So let's start with the figure on the left, showing properties above $5 million. The We indexed the values to 100 in October of 2022. So what this means, for example, is that in 2023, as the law was about to come into effect, in the months immediately preceding it, see this spike in the blue line? That means that a large number of properties were becoming reassessed. And so the total reassessment amounts jumped in LA. Okay? Then immediately after the law passed, comparing LA to outside of the city of LA, the dollar value of reassessments that occurred each month fell substantially. And you can see it looks like there's a little bit of reversion towards the end of the period. As I'll show you in the next figure, I think that's actually a temporary sort of recording delay in the data because it doesn't seem to persist once we add newer data to it and look further out. Turning to the figure on the right, we can again compare LA to outside of LA, and you can see that the annual reassessments line up perfectly for properties below 5 million. And so it looks like overall LA and non-LA seem like reasonable comparison groups to each other. Okay. We can also look at just the number of transactions. Here I wanted to show you a longer series. This series shows the number of transactions each quarter using data from CoStar. We like this because commercial property overall shows very large effects and quantitatively drives a lot of the response. And because we're able to collect CoStar data for a longer time period since our CoreLogic subscription ran out. And we can extend the data this way. What you see again is that the sort of the reverse that you saw seems to be there, but then the series actually seems to be persistently apart, even going up to 2025. Doesn't look like there's very much rebound. You also see this tremendous spike here of property selling immediately in the weeks right before the law came into effect. Okay. We can translate this into event studies. So this is going back to the CoreLogic data. The event studies don't show any sort of statistically significant trends beforehand. Then there's this fantastic spike right before the law comes into effect, and then long-term persistent decline. Okay, so what does this translate into? If we pool the coefficients and estimate a regression, sort of our baseline estimate is 0.683 Poisson coefficient. That's about a 50% decline, not accounting for the anticipation period. Unweighted, the effect is smaller. If we use different cutoffs or we sort of weight it in different ways, the effects are around 50%. Now, I'm not going to go into the details of how we think about this. You can see the paper. We think there are sort of three concerns with these reduced form effects alone. One has to do with retiming. There are these anticipation effects. If all of those anticipated effects would occur in the year or two right after the law came into effect, then our estimated effect might be too large relative to what we expect in the long run. We try to quantify that by sort of smoothing out those anticipation sales, those sort of sales that bunched right before the law came into effect, smoothing them out using the data and using a model. Overall, we think that the raw numbers might be overstated by something like a third or less. But the coefficients don't change that much. And in fact, we've continued to track the numbers month by month, and we haven't seen any sort of meaningful reversion. So despite that anticipation, it doesn't really seem like in the long run, as far as we've been able to measure it, the effects are going back to zero or anything close. The second question is whether property owners are somehow substituting to sales outside of LA. This would have to be, people own a home, it's in LA. They would have to somehow be selling a different home that's outside of LA. It's a little tricky to see how that happens. But nonetheless, we can imagine that happens with sort of commercial real estate companies that have a large portfolio that might choose to sell a property in one place or a different place. Using CoStar data, we track the individual identities of the property owners, and we don't see much evidence that they're doing that. Finally, we might think that there are various types of avoidance mechanisms by splitting property to avoid the cutoff or selling only partial interests in the land. Again, we measure that using the official LA assessor data, using the CoStar data and so forth. And there doesn't seem to be much evidence that any of that is happening either. Finally, as I mentioned at the beginning, the response to the mansion tax is much larger for commercial property. Okay? We estimate something like a 78% decline. Presumably, commercial landlords have more flexibility in terms of when they sell or when they don't sell. And it looks like they just are foregoing sales that residential owners don't. So what does this mean? I've given you the intuition using that picture that says that delayed sales mean foregone reassessments, and that results in a loss of property tax revenue. We use what amounts to a fancy present value calculation to figure out what the loss in present value terms is. The first key object that we think about is what we call phi of P. So P is the annual rate of sale for properties, which is also the annual rate of reassessment. Phi is the ratio of the assessed value to the market value of properties. That's always below 1. And the closer it is to 1, the closer the assessments are to market value, and the more money that the assessor office is earning. If we assume that sales occur as sort of random Poisson events that may change due to the law, so we're going to consider what happens when P changes. We're going to let the market growth of property prices be G, and GS is the assessment cap. So that's 2% in the data, roughly. We can show that phi of P equals P over P plus G minus GS. So we basically have, using a few lines of algebra, a simple formula for the ratio of the market to the assessed value of properties in LA. Given that ratio, a few more lines of algebra allow us to take the present value of all future property tax assessments as a function of phi of P. What we show is that they're equal to the tax rate times the market value of all property times the assessment ratio of phi, discounted by R minus G. So that's basically like a Gordon growth type formula for the present value of all future tax assessments. What this means is that a lower turnover, little p, will lower the ratio of assessed value to market value for LA housing, and therefore lowers the present value of property tax receipts. There are transition dynamics in the sense that as soon as the law is passed, the stock of existing assessments doesn't change that day. As the law discourages more and more sales, the assessed value of all properties in LA slowly converges to its long-run level. What we consider in the model is sort of how to think about those transition dynamics. We quantify them, and then we use both the transition dynamics and the long-run steady state to calibrate the results. The key calibration parameters are just the cap rate on California housing, R minus G, the value of California housing, which we measure from sales data, the assessed value, and the Poisson coefficient that we get from the reduced form estimates. Plugging them into the formula I just showed you, we find something like an 80% offset for our benchmark numbers. We can apply a slightly higher discount rate than our sort of benchmark cap rate, and we get slightly lower offset of 73%. We can also consider higher or lower baseline turnover rates of property. In the period we're considering, property wasn't selling very much anyways because of the Fed rate hikes. If interest rate changes lowered or raised the sort of no tax sale probability, that would also affect the results somewhere. Overall, the sort of reasonable estimates we think are between 50% and 130% of the revenue raised from the mansion tax. Okay, so right now, the city of LA is considering changes to the mansion tax, and the California state legislature is considering various overrides of the tax. So there's about to be a LA mayoral election, Nitya Raman versus Karen Bass, and both of them have different ideas about how to change it. Sort of mend it, don't end it is the slogan for Nitya Raman. Karen Bass is more pro-mansion tax and wants sort of certain small exemptions so that new multifamily property isn't discouraged. The California State Legislature just, I think last week, shelved a plan to override the tax altogether. I was happy to see that in the sort of latest report, the city legislative analyst saw our working paper and said, oh, this might also be a problem. Interestingly, the teachers union in California is apparently supportive of the mansion tax, even though the receipts of it ultimately will reduce funding for LA public schools. So we'll see what happens. It's also worth noting that our focus here is the fiscal externality of one tax base onto another in the same area. But the property tax receipts are collected by LA County and partially shared across municipalities in LA County. So we might think that part of the reason this is popular in the city of LA is that it raised funds for one use, controlled by one municipality, but the losses are shared over a larger region and come from other sorts of uses that might be less politically popular for various reasons. There was also recently a potential ballot measure to overhaul this. So far, nothing has passed. A question for us is whether property owners expected this to be in effect in the long run. Our reading of industry materials and newspaper reports at the time was that people did believe the tax was permanent. Of course, that's uncertain now, but so far it looks like at least many elements of the tax will continue to stay in effect for a long time. So thanks a lot for your comments in advance, and turn it over to the discussant.
Great, thanks. Our discussant is John.
Thanks so much. It's great to be here. Indeed, you may be asking, why the hell am I here? And the answer is quite simple, which is that it was a fantastic grad student at MIT, Evan Soltis, who invited me to co-author with him on a project you'll hear tomorrow. And because of that, they somehow thought I was qualified to discuss a paper. So here I am. Let's discuss this paper. This is a really neat point. Okay, this is like classic PF. Okay, classic economics. Basically, when's economics at its best? When it's pointing out an unintended consequence. And there's a classic example of that of the theory of the second best. What's the problem? Too little revenue to Proposition 13. What's the solution? Let's get around it with a mansion tax. What's the problem that raises is that Proposition 13 has a lock-in effect because houses are only reassessed upon sales. So as a result, if you put in this tax and it delays people selling expensive houses, that is going to further reduce the property taxes you collect because you can't reassess. This is so interesting that it actually passed what I call the wife test, which is I have the benefit of a non-economist wife. So if papers are particularly interesting, I run them by her and see if she gets it and likes it. And she liked this one. This passed the wife test. Okay, now, but the long run effect isn't obvious, as the presenter made clear. There's short run gains, and that will offset the long run losses. So this is very much parallel to the capital gains taxation debate. We saw when capital gains taxes were raised in 1986, a huge spike in capital gains realizations right before the rate was raised and declined afterwards. Basically, in that debate, people have largely given up trying to figure out from the time series what the effect of capital gains tax rates are and have gone to more cross-sectional, cross-state approaches. So that's the challenge this paper faces. The number one challenge, I think, is the timing effects. The second challenge is the control group isn't obvious. So one option is houses outside LA City. The problem is there could be relocation of transactions. People who want mansions may buy them outside the city, leading to an understatement of the impact. The other option for control group is lower value properties inside LA. The problem is those are very different markets. So those are the two problems. And once again, this paper is very transparent and very clear. There's nothing hidden in this paper. It's very well written. It's very clear about these two problems. The results are striking. There's a huge anticipation effect and a huge reduction in volume. I shouldn't say long run in the observed period. About a 50% reduction in transactions. That's a monster effect. Okay. They then put this in a model of fiscal externalities, and they estimate the long run loss in property taxes, I should say, for LA County, not city. I'll come back to that. For LA County, may be as large as the revenue gains for LA City. And that difference actually matters. This is, I think, a pretty striking condemnation of this tax. But, and you knew this was coming, there's problems. There's never a paper without problems. And maybe in the day of AI, some time we'll write one. But the big issue is the timing issue, which is that essentially these results come from extrapolating a very short period of time after the tax is in place. So the tax, the main data set, they only have data through December 2023, and we'll come back to the CoStar data, but the overall sales data through 2023, the tax was passed in April 2023. So there's 7 months post-tax to learn from. Now, I'm sorry, the tax took effect in April 2023. It was passed in November 2022. So you have a clear anticipation period, but the period after is very unclear, and we can actually see this in the graph. So if you see, the first thing notice this graph is, of course, the huge anticipation effect. Okay. The second thing you notice, if you look to the right of 2023, is that the lines kind of converge by the end of the period. So you can't really say whether there was a long run impact of this tax or not from this graph. This could indeed, if this holds in the long run, this tax almost certainly made money, right? If this only for 7 months led to reduced sales, this tax made a ton of money. Okay. So basically, there's a lot of extrapolation of a very short sample. You can see this more clearly, and once again, the paper is very upfront about this. You see this more clearly in their diff and diff graphs. You see that basically there's this huge anticipation and then a slowly falling effect afterwards. It's even more clear in the unweighted data, and that's why the effects are small in the unweighted data. Huge anticipation, and then effect that's big, but then is reducing. Now, the authors are very upfront about this. They take a bunch of approaches that ultimately I don't find, a bunch of sort of modeling approaches I don't find so convincing. The more convincing approach is that they have CoStar data, which is just commercial transactions, but does cover a longer time period. And that looks better. Indeed, you see that same convergence at the end of 2023, but then it separates again, but then it converges again. So basically, I think the authors need to take a stronger stand than they do in the paper, and it's already accepted, so what do they care? But I think they should take a smaller stand than they do in the paper about the role of the CoStar paper. The CoStar results are kind of buried. They're in an appendix. But I think this is pretty important because I think the timing criticism is a very valid one. And I think they need to lean pretty heavily on this, I think, if they really want to argue that their estimates are longer run effects. So the bottom line, the empirical issues, the first, the control group, I think the control group is fine. I like the control group using outside LA City as a control group. If anything, I think this understates the effect. And they don't see any shifting. They use big companies, don't see any shifting. The second is timing. And I think that is a bigger concern. But it's more fun to talk about policy issues. So let's spend our remaining 5 minutes talking about that. Now, the original sin here, of course, is the strictness of Proposition 13. Compare that to Proposition 2.5 here in Massachusetts. Two differences. One is we can override. Towns can vote to override. Second, and I didn't appreciate that to this paper, is that we can reassess. We don't have to wait till sales to reassess. So I really like this future research, I guess, to take a larger nationwide lens on this and talk about the different, really lay out the different features of different property tax. I just thought property tax limits are property tax limits. But this paper highlights the devil's really in the details. I'd like to see them talk more about that. And maybe there's some interesting cross-area work that could be done based on the different 30 cities, I think you said. Well, those ones, the mansion tax. Many more have property tax limitations. So I'd love, maybe there's some interesting cross-sectional variation that can be used there. The jurisdictional spillovers are fascinating. The tax only applies to LA City, but the revenues are countywide. So if the mansion tax reduces transactions, there's a spillover, as was mentioned, to other cities. This leads to the classic free rider problem, which is a city that imposes a mansion tax gets all the benefits, but only bears part of the costs. This could lead to sort of a reverse race to the bottom. In corporate taxation, we worry about a race to the bottom of tax rates. That everyone's trying to run. I'm a liberal guy, so I worry about a rate. Maybe if you're conservative, it's a race to the top. I call it a race to the bottom of corporate tax rates falling through the floor because of international competition. Here you have sort of the opposite. This is incentive for transaction tax to race to the top because you spread the fiscal damage to others. Indeed, in LA County, it should be the guys outside LA City who are jacking up their mansion taxes because LA City is going to bear most of the burden of that, and they're going to get all the benefits. Surprisingly, I didn't see in the paper that they actually measured the impact. I'd like to see the impact on LA City and the rest of LA County. That seems like a relevant calculation. You do sort of the offset for LA County. What's the offset for LA City? LA City certainly made more money than you're saying here, and that's a relevant fact. But more generally, I think there's an interesting paper. Why don't more small cities do this? If this is really true, the city gets the transaction tax revenues, but the county bears the property tax loss. Why don't this? Indeed, Santa Monica did. Santa Monica has a 5.6% tax above 8 million. What was the impact for Santa Monica? And are we going to start to see sort of a race to the top of mansion taxes given this jurisdictional spillover? The second thing is, can we do better? Okay. So the problem here is that Proposition 13 is imposing not just a limit on how much you can collect, but this distortion of lock-in, which is well known. I knew the lock-in effect, but it's creating this assessment distortion because you can only assess when things sell. And so you have this problem that you don't want to deter sales, because if you deter sales, you deter property tax revenues. And so the argument here is the problem with the mansion tax is you're deterring sales, okay? And as a result, lowering long-run property tax revenues. But in fact, the issue here isn't the house price, it's the embedded capital gain, right? If a house that was worth 4.9 million doesn't sell at 5 million, that doesn't really much affect if it's already worth 4.9 million, doesn't sell 5 million, doesn't affect your property taxes much. It's the one some old person moves into $200,000 35 years ago that's worth 5 million now that you're worried about. So could we deal with this by actually adding another tool to tax policy? What if we offered a one-time rebate based on the fiscal externality? What if we said at the time of the law, or it has to be one time because we want to avoid long-run lock-in, that we're going to compute the reassessment losses that you're imposing by not selling your house and rebate the mansion tax according to those losses? We're basically going to say, for the ones where we're really worried about them not selling, we're going to lower the tax so that they actually sell. Now, in 1996, I would have stopped there and I would have had transparencies and I would have stopped there, but it's not 1996 anymore. Okay. And I now get to use ChatGPT. So instead of just making the clever point, I get to actually run this alternative policy. Not only that, I literally did it in the car. Like I was driving here this morning, realized this point. At the first stoplight, I fed in the paper. By the end of the drive, they'd produce tables for me. This is just astounding. In fact, I felt like I'd become young. I felt like, wow, ChatGPT did that too. I felt like, wow, this is cool. Look at what I can do with this. So what do we get? So what I did is I created a policy where essentially you get rebated a fraction of the PDV of the property tax loss that's imposed by your not selling. Okay, so essentially we say, if you're someone who got your house for 100,000, it's worth 5 million. That's a $4.9 million a year gain we have from you selling that house in property taxes. We're going to rebate you to account for that. So essentially we have a parameter, which is what I call a reassessment credit. What share of the lost property taxes from you not selling are we going to give back to you, offsetting your mansion tax? Your mansion tax can never go below zero. We're not going to go negative, but it can go to zero. And what we see here is under the current, under the assumptions made in this paper, this reassessment benefit raises net revenues. Okay. In other words, the transfer tax revenue goes down, but the property losses go down faster. So actually, at a 75% rebate, you make more money than at no rebate. Now, what's fascinating, of course, is this interacts with the elasticity. The paper estimated elasticity, which, as I said, I think is a little too big, probably. At that one, you want a bigger reassessment credit. But as you reduce the elasticity, you want a smaller reassessment credit. Because if you reduce elasticity, you're not losing as much property tax revenues, the reassessment credit becomes inframarginal. So you want less of it. So actually, it turns out this elasticity becomes central. So as the city's rethinking this policy, if it feels like it has a good estimate of the elasticity, could do better on this policy by having this kind of reassessment credit. Now, you might ask yourself, that's a cool point, but these tables are really ugly. Well, I had a big fight about Chad about exporting them and would export it, so I feel old again. Okay, last thing. Can communities find another way around Proposition 13? Now, California did have a mechanism for specific overrides, assessment districts, but this was effectively killed in 1998. Basically, used to be able to say, I'm going to have a special assessment for sidewalks or a new park. That was effectively killed in 1996. Now, but there are community facility districts, essentially special assessments for new developments. So you can basically get around Prop 13 with new building. You can essentially front load your foregone property taxes with an assessment when you build the development. Okay? So the answer is We need new cities. Let's stop fighting town. Let's stop fighting City Hall and let's start building City Hall. So basically California Forever. You all know about California Forever. One of my former MIT students is one of the people involved in setting that up, which is kind of cool. 70,000 acres, 50 miles northeast of San Francisco. Could be a game changer, but currently I don't think it's going to be. And why is that? Because it's just going to be a bunch of giant houses for rich people. Okay, and that doesn't solve the problem. We have Fort Devens in Massachusetts. It's closer to Boston than California Forever City is to San Francisco. It's 4,400 acres of prime real estate that is a discontinued military base. So far, after years of fighting, we agreed to build 500 houses on it. Okay, that's what's going to happen to California Forever unless we take the next step. And that's what Jake Auchincloss and I have written about in an article that we had in a magazine called State Forum, which is basically we think 4 steps. We need an independent commission. Jim's not here, right? I'm doing policy recommendations. Good. Okay. We need an independent commission at the state level to oversee and provide political cover for the necessary reforms. Sort of like a base closing commission, but transformed to a city opening commission. We need some kind of public backstop to help de-risk investment, like upfront financing of public services or an idea borrowed from health economics. Can you do risk corridors where states provide reinsurance on property tax collections? We need methods to reroute the spillover benefits from building, the fact that the state's going to raise more labor revenue, the state's going to raise more other revenue. We need to reroute them. And finally, we need more experimentation. So the bottom line is, and this is finding some success in the UK. And I think the UK offers a very important lesson politically, which is that there's a great video of the labor minister wearing a Build Baby Build hat, rallying labor's not necessarily a natural constituency for ending regulation and building, but the labor minister around labor's constituency around how important this is. Okay. And basically building the link the American public does not appreciate between supply and prices. Okay. We've got to convince people that more supply lowers prices. Don't convince this room, but you do have to convince people who are in the way of building. And the UK is in the middle of doing that. And that could be a good model for us to follow. Anyway, great paper, really interesting point, and I think we can think a lot more about what to do with policy here.
Thank you very much, John. And it goes without saying, please don't chat GPT and drive. We want you to stick around, John. Questions, comments? Yep, do you want to grab the mic there? Oh, look at that.
Have it right there. 3 observations. The first one is that in this group, we seem to be running a contest between the really bad effects of rent control and the really bad effects of land transaction taxation. And we're trying to see which one is the worst. So this is another nail in the coffin of the LTTs, and we had rent control earlier, but the debate is not completely settled. Slightly more seriously, we did some calculation with Lujan and Matt Turner from Massachusetts a couple of years ago because there was a proposal of that sort on the table. And we found that the big fiscal action was actually between different levels of government. If people sell a lot less, they're going to be subject to capital gain with taxation a lot less as well. And that's actually, in our calculation, that was quantitatively really, really important. So that could be added to the tally. And then I could only echo the discussants. We really want to know about the long-term effects of those taxes. And I think our usual preferred well-diff and diff approaches no longer work. So we need to find a new way to do that.
I was wondering about what happens to home prices here. It seems like even if you had continuously updated, in a world where you had continuously updated assessments, you would still have substantial sort of tax base shifting as a result of this policy. Thanks.
So ideally, when there's a revenue shortfall at the local government, the mills rate compensates. So, when you have lower assessment values, you can have a higher tax rate. What about your setting that makes it so that the tax rate doesn't really compensate for the revenue loss from the reassessments?
So this is great. I just wanted to echo John's point on tax limitations in other places, right? I think there is I was spending some time going through a Lincoln Land Institute report on that right now and trying to figure out what we know. And I think clearly, things that put caps on the total rate that you can charge are just wildly different than taxes say the same home pays a wildly different value based on when it was bought, right? Which is just wildly more distortionary. And I mean, it also distorts who lives in the houses. I mean, it's sort of like the same with rent control does in terms of misallocating units. And I don't know fully which other states. There are other states that have assessment limitations. I don't know anything that's in the same level of Prop 13 because, of course, there's the interaction between the assessment limitation and just how crazy California's housing market has been since Proposition 13. But as you think about post your JPUB paper, like that would feel like a great way for you to think about moving on.
Do you want to take 30 seconds to say thanks? There's a mic there.
Thanks to John and thanks to everyone. Fantastic comments. And yeah, we're writing follow-up papers about the same and similar settings. So these will all be incorporated and well taken. I think it's a great question thinking about the sort of long run effects. That was a theme. I mean, one thing that I think we're going to do is just update the figures as the data comes in, and we'll see, how right we were, how wrong we were. Hopefully I think what I view as a big part of our contribution is the sort of conceptual point and also the formulas and sort of very simple model that we provide. And we provide calibration with different betas where we say, okay, look, if this is overestimated, you can use a smaller effect, and this is what you'll find. So hopefully the sort of results will have some longevity from that perspective. But thanks again to all the comments and all the questions.
Take a break. 15-minute break. We'll be back at 3:15 sharp. Please take your seats. We are going to get started. Please find a seat. We are going to get started. All right. For our next paper, we have Chandler Lutz presenting highly disaggregated land availability. Take it away.
Great.
Unavailability. Take it away.
It's all right, just small difference. So thank you for having me. My name is Chandler Lutz. This presentation is titled Highly Disaggregated Land Unavailability, and this is joint work with Ben Sand. So standard housing and urban theory posits that building constraints steepen the housing supply curve so that there's higher house price growth in response to elevated demand growth. Now, this standard core theory has important implications for both researchers and policymakers as they both advocate for lower supply constraints to reduce prices and improve home affordability. But according to existing supply constraint proxies, supply constraints don't explain house price growth across cities, and looser constraints, according to these proxies, don't mitigate the price impacts of demand growth. These results contradict this standard theory and imply that supply constraints explain little of the heterogeneous house price growth across cities, that demand shocks have similar price impacts regardless of supply elasticities, and that the extensive literature that uses these supply constraint proxies to sort housing markets or for identification is unfounded. So what we're going to do in this paper is we're going to use high-resolution satellite imagery at multiple levels of spatial aggregation to develop new estimates for the land unavailable for housing construction. We're going to combine these highly disaggregated land unavailability estimates with modern machine learning techniques to develop the land unavailability machine learning indices. These LUML indices provide new and robust validation for this core housing and urban theory, and also a deeper understanding of how supply constraints impact housing markets. So let's first take a look at the limitations of existing supply constraint proxies. So we're going to focus on two of the most prominent supply constraint proxies in the literature, those from Baumsnow and Hahn 2024 and SIZE 2010. Panel 1 on the left shows instrument relevance tests for house prices using the SIZE and Baumsnow and Hahn proxies. As you can see, neither the Baumsnow and Hahn nor the SIZE proxies explains house price growth across cities over the plotted sample periods. These supply constraint proxies are especially underpowered compared to modern weak instrument thresholds, such as the threshold of 50, as proposed by Keen and Neal 2024. Not only do these existing supply constraint proxies not explain house price growth across cities, but when you sort housing markets based on these supply constraint proxies, you find no difference in the income elasticity of house prices across more or less constrained cities. So in other words, with an increase in income, there's no difference in the price response between cities classified as more or less constrained according to these existing proxies. You can see this in panel 2B, where we find that existing proxies have no mitigation of the price effects of demand growth with looser constraints. So how exactly do SIZE and Baumsnow and Hahn measure land unavailability? Well, what they do is they take an equal weighted sum of the land unavailable due to steep slopes, water, and wetlands within a 50 km circle around each city's principal city or central city centroid. That's the red circle on these maps. And here we have three cases for Los Angeles, Chicago, and Las Vegas. As you can see for the case for Los Angeles, the red circle, the 50 km circle around the principal city centroid, vastly undercovers the CBSA polygon. It misses the cities of Lancaster and Palmdale in the north. It misses the cities of Long Beach, Irvine and Anaheim in the south, and it misses the eastern part of the CBSA. In Los Angeles, these are the exact areas where much of the housing unit growth happens. In the case of Chicago versus Las Vegas, it's actually quite interesting. So if you use the SIZE and Baumsnow and Hahn method, you get almost the exact same land unavailability estimate for Chicago versus Las Vegas at around 38, 39%. But as you can see, Chicago, for example, is constrained on one side via Lake Michigan, but it's free to grow to the west and to the south. Las Vegas, on the other hand, is constrained on all sides by mountains. So note that first, that Birchfield et al. 2006 find that when there's a single-sided constraint with just water, that this does not limit housing development or sprawl. So even though these two cities have drastically different types of land unavailability and the direction of the constraint differs, the Sias-Baumstow-Hahn method is going to assign the same land unavailability estimate. So what we're going to do instead in this paper is develop a topographical map for each city. We are going to measure land unavailability due to steep slopes, water, and wetlands across 30 different spatial definitions for each city to create 90 features for each city. Starting with the CBSA polygon in blue on the left for the Los Angeles CBSA, we're going to measure land unavailability due to steep slopes, water, and wetlands within this blue polygon. Then we're going to buffer the polygon by 5% and then measure land unavailability again due to steep slopes, water, and wetlands. We're going to continue to do this in 5 percentage point increments until we reach 20% of the CBSA's polygon area, measuring land unavailability due to steep slope, water, and wetlands within each of those polygons. Then we're going to move on to the first principal city polygon in panel B, which for Los Angeles is just the Los Angeles Central City. For this orange polygon in panel B, we're again going to measure land unavailability due to steep slopes, water, and wetlands. Then we're going to increment that polygon, buffer that polygon by 10%, measure land unavailability again due to steep slope, water, and wetlands. We're going to continue to do that in 10 percentage point increments until we reach 150% of the principal city's area. In panel C, we're going to build on the approach from Sias 2010 and measure land unavailability within concentric circles around each city's principal city centroid. As you can see, what we're going to do is we're going to measure land unavailability due to steep slope, water, and wetlands within circles with radii around the principal city centroid from 20 km to 100 km in 10 km increments. So we're going to try and measure land unavailability both at a city's urban core and at its periphery, wherever housing unit growth occurs. Using these land unavailability features, we're going to build two land unavailability machine learning indices, the LUML price pressure index and the LUML supply index. The LUML price pressure index, for example, will target year-over-year city level house price growth and measures the expected value of house price growth given land unavailability. It measures how tightly constraints bind for prices over time. The LUML supply index, on the other hand, is going to measure, for example, target decadal city level housing growth and measure the expected value of housing unit growth given land unavailability. It's going to measure how tightly geographic constraints restrict housing expansion over time. We're going to combine these land unavailability features using the XGBoost algorithm, targeting either house price growth or housing unit growth for the price pressure index and the supply index, respectively. The advantage of the XGBoost algorithm over traditional and standard techniques is it captures the nonlinear and heterogeneous impacts of geography. We're also going to use out-of-sample cross-fitting to prevent contamination from other local idiosyncratic supply and demand factors. We're also going to employ several different empirical specifications as well as novel controls, for example, for natural amenity demand via Google Maps reviews to further isolate the LUML index from housing demand. We find that the LUML indices are largely uncorrelated with housing demand, especially compared to existing proxies. So, for example, regression of the LUML supply index on our natural amenity demand index and standard housing demand factors yields an R-squared of 0.079. That same regression yields an R-squared on the Baumstow and Hahn proxy of 0.2 and on the Sias proxy of 0.29. The LUML indices are also highly flexible. They adapt to panels and long difference specifications and can easily constructed for all spatial definitions from CBSAs and counties down to census tracts and zip codes. So unlike existing measures, the LUML indices capture supply constraints in housing markets. So panel 1 on the left shows those same instrument relevance tests for house prices. As you can see, only the LUML price pressure index captures the differences in house price growth across cities in the plotted sample periods. With regard to the income elasticities in panel 2A, you can see, again, only when we sort cities based on the LUML supply index is there a differential response to house prices with income growth. Or more specifically, for a 1% increase in income, less constrained CBSAs have a price increase of 0.4% versus 0.86% for more constrained CBSAs. As you can see in panel 2B, this result is only statistically different for the LUML supply index, where that index finds that looser constraints mitigate the price impacts of demand growth. So turning to some of the key results for the LUML price pressure index. Recall that the LUML price pressure index is the expected value of housing growth given land unavailability. We first find that the impact of various land unavailability constraints is heterogeneous and differs across cities. However, on average, steep slopes are the most important predictor. Interactions between land unavailability constraints also matter, especially the interaction between steep slopes and water. We find that the LUML price pressure index captures supply and not amenities or housing demand, and this result persists even under extreme simulated cases of unobserved demand confounding. So let's take a closer look at what's driving the LUML price pressure index. So in panel 1, we're going to look at the contributions of the land unavailability features to the LUML price pressure index, again for that case of Chicago versus Las Vegas. So recall if you use the Baumsnow and Hahn or Saiz method, you get about the same land unavailability estimate for Chicago versus Las Vegas, even though the type of land unavailability differs drastically across the two cities and the direction of the constraint differs as well. What we can see here first in red is that steep slopes are the dominant predictor in both cities. So the lack of steep slopes in Chicago pulls the expected house price growth down below the national average by about 24 percentage points. On the other hand, the voluminous steep slopes in Las Vegas push up the expected house price growth by about 22 percentage points. If you recall that map of Chicago, you would have noticed that Chicago is constrained on one side by water, where it's free to grow to the west and to the south. Okay, Birchfield et al. 2006 find that such single-sided constraints don't impact development. The LUML price pressure index uncovers this as well, while even though there's substantial land unavailability due to water at the 96th percentile of the distribution across cities for Chicago, it has almost no impact on expected house price growth for Chicago or the LUML price pressure index. Finally, you notice that Chicago is in the 50th percentile for wetlands due to land unavailability, and that drags down its expected house price growth by about 9 percentage points. Wetlands are easily overcome by land improvement technologies, validating that result. In panel 2A, we look at the average marginal impact on the LUML price pressure index. It shows that steep slopes are the most important predictor by far. Water is the second most predictor. After that, interactions, especially between steep slopes and water and slopes and wetlands, matter. Again, wetlands is the least important predictor, in line with the idea that they're easily overcome by land improvement technologies. Panel 2B shows the marginal contribution of steep slopes to the LUML price pressure index for each CBSA. As you can see, early part in the distribution, an increase in the amount of land unavailable due to steep slopes pushes up expected house price growth. Then that effect eventually tapers off and subtly reverses once you get to extreme levels of land unavailable due to steep slopes. This last result is in line with the idea that extreme slopes limit market access or agglomeration effects. So the LUML price pressure index captures supply, not amenities or housing demand. So the table on the left runs regressions of year-over-year house price growth on the LUML price pressure index and controls. So in column 1, we're just going to control only for CBSA fixed effects and census division by date fixed effects. Column 2 includes a control for city-level total income growth, a broad-based proxy for housing demand. As expected, the coefficient on total income growth is highly significant, as total income growth explains house price growth across cities. However, if you look at the LUML price pressure index coefficient, moving from columns 1 to 2, you see that it's actually quite stable. This indicates that the LUML price pressure index is actually uncorrelated with this broad proxy of housing demand. In column 3, we control for our for quintiles of our natural amenity demand index. As you can see, there's a gradient across these quintiles, but for the cities with the most attractive natural amenities, those in quintile 5, they have higher house price growth even after controlling for total income growth. Again, the coefficient on the LUML price pressure index is largely stable, indicating that the LUML price pressure index is unrelated to this natural amenity factor. Column 4 is our kitchen sink regression, where we control for total income growth in addition to amenity quintiles initial college share, initial median income, initial housing density, and initial employment shares all interacted with date fixed effects. Not surprisingly, there is attenuation in the coefficient given the large amount of controls, but the coefficient is still large in magnitude and highly significant with a t-statistic near 12. Now, there's always the concern that there is some unobserved amenity or housing demand factor that would further attenuate the coefficient on the LUML price pressure index in column 4. So we explore this in the graphs on the right, where we look at the sensitivity of the coefficient on the LUML price pressure index in column 4 to potential or hypothetical emitted variables. So the graph on the top is going to look at, and I'm going to try and show you, the graph on the top is going to look at the attenuation in the coefficient on the LUML price pressure index for a potential emitted confounder with explanatory power equal to the observed amenities, that's the 1x on the graph, or twice the explanatory power of the observed amenities, or even the extreme case where a potential emitted confounder has 3 times the explanatory power of the observed amenities, natural amenity demand. In all cases, the coefficient on the LUML price pressure index remains large in magnitude and highly significant. Panel B runs these same simulations using initial college share. Again, even in the extreme case where initial college share, or even in the extreme case where there's some hypothetical emitted variable with 3 times the explanatory power of initial college share, the coefficient on the LUML price pressure index remains large in magnitude and highly significant. So moving on to some key results for the LUML supply index. First, recall that the LUML supply index is the expected value of housing unit growth given land unavailability. We first find in response to demand growth that looser constraints facilitate supply, but the price impacts are nonlinear. Only in the least constrained cities do looser constraints mitigate the price effects of demand growth. Within cities, looser constraints facilitate supply for both counties and zip codes, but they only mitigate the price effects for counties. This suggests that counties act as integrated housing or labor markets while there's spatial arbitrage across zip codes. Finally, and for point 3, we find that effective supply constraints have evolved dramatically over time, where the mitigation effects of looser constraints is largely confined to the 2000s. So first, to show the idea that looser constraints facilitate supply, but the effects are nonlinear. First, look at panel A, where we plot the income elasticity of housing units across LUML constraint quintiles. In quintile 1, we have the most constrained cities, and in quintile 5, we have the least constrained cities. In line with what you'd expect for a housing constraint measure, you can see as we decrease constraints, the income elasticity of housing units monotonically increases. However, when you look at the income elasticity of house prices in panel B, you see the nonlinearity. So starting with quintile 1, those most constrained cities, a 1% increase in income using only time fixed effects corresponds to about a 0.7% increase in house prices. For quintiles 2, 3, and 4, there is some attenuation, but it's not statistically different from column 1 from the most constrained cities. Only in column 5, where you have the least constrained cities, you find that a 1% increase in income corresponds to a 0.5% increase in prices. This price differential relative to column 1 is only statistically different for quintile 5, highlighting the nonlinearity across the distribution of cities. Within cities, counties mitigate the house price effects of income growth, zip codes do not. So in panel 1 on the top, we show the income elasticity of housing units for a 1 standard deviation loosening of supply constraints. In response to income growth, both counties and zip codes expand supply with looser constraints. However, the price mitigation effects are confined only to counties in panel 2A and not for zip codes in panel 2B, suggesting that there's spatial arbitrage across zip codes within cities. Moving to time varying effects, here we're going to document or examine the time varying effects across decades, the 1990s, the 2000s, and the 2010s. Panel 1A is going to examine the income elasticity of housing units for the typical city evaluated at the average value, the mean value for the LUML supply index. For the typical city with average constraints, you can see that in response to an increase in demand growth, that the supply response has weakened dramatically over time. In panel 2A, you can see that this has directly been capitalized into higher house prices. And then finally, in panel 1B, you can see that the mitigation effect of looser constraints for an increase in income is largely confined to the 2000s, as that's the only period where such increases in income have led to larger construction with with looser constraints. So just to finish up, in this paper, we develop a new methodological framework to measure supply constraints in housing markets. We construct two new supply constraint indicators, the LUML supply index, which measures the expected value of housing unit growth given land unavailability, and the expected value of, and the LUML price pressure index, which measures the expected value of house price growth given land unavailability. We find that the LUML indices isolate physical constraints from amenities and local demand. And unlike existing proxies, the LUML indices explain house price growth across cities and show that looser constraints mitigate the impacts of demand growth. But these effects are nonlinear, spatial, and time varying, ultimately highlighting how researchers must shift away from just static linear constraints when studying housing markets and affordability. Thank you.
Great, thanks so much. And representing the defense, we have Albert.
Thank you very, very much. It is a pleasure to be here. And no, I mean, I don't think there's anything to defend, honestly. I like this paper quite a lot. It's a nice project. It uses several definitions of city boundaries and its corresponding buffers to measure a geographic constraint for most urban US flat, mostly focusing on flat area that's not underwater. I think my number one comment on this project is it was about time. It was about time, and I appreciate all the sites, but it was about time that someone actually put the work to do a better estimator than what we did. It's already 16 years ago.
It me 10 years.
And obviously, you have many more metro areas. You produce the data at the county level, at the CBSA level. So it's really, really something to be proud of for you guys, and let those sites move away from that paper. However, the other aspect that you guys do is really look at combinations of rather than using ad hoc, sort of an ad hoc functional form for sort of fixing the supply function. You really look at machine learning combinations to actually improve the predictions that you do. So that's the second issue, is my biggest issue with the paper. The first issue, though, is why would you use just a fixed rank to actually sort of look at the availability of land around the city? And the answer is very simple, because otherwise you might find really quickly endogeneity issues. So for instance, compare these two, one where you're really drawing buffers around the CBSA of Los Angeles, and the other where you're drawing rents. And as you can see, because of the endogeneity of the shape of the city is constrained by the ocean, is constrained by the mountains. So it's going to look a little bit like that, more rectangular. If you draw the buffers around that, you're going to underestimate the sort of lack of availability, because the shape itself is actually forced by the land. So again, if you just draw equidistant circles, you're going to find really quickly that a lot of these areas actually constrained by the ocean. Okay, whereas again, the shape of the county, the shape of the CBSA, the shape of anything that sort of that's based on actual population today is actually endogenous to the shape of the city. But even if you did the radiuses, and you guys do the radiuses, you'd like to fix a kind of radius, because we do find also that the shape of the extent, even conditioning on using radiuses, circular areas, the extent of the city is also going to be endogenous to anything that affects housing supply. So if it's very easy to build further away in the suburbs, then the city is going to expand further away to the suburbs, and you're going to need a bigger ring. So when people think about, oh, we need a bigger ring to incorporate the fact that LA is more slow. Well, LA is more slow because the land use policies in LA. Okay, whereas New York is different because of land use policies, among other things, including the geography itself. So that indigeneity problem is really complicated and rationalizes using a single circle for different metro areas. The alternative, which I use in another paper, is actually using random circles. And by the way, all the correlations, if you use random circles, because indigeneity is very clear, as you see the circle growing on, you tend to see higher, sort of lower densities and so on and so forth. To be fair, you use all these things into a machine learning algorithm, so you can argue, well, it doesn't matter. Now, one of the great things about your paper is that you have very strong predictive strength. So machine learning are better predictors in panel setting comparing to previous obsolete, admittedly obsolete sort of measures. Now, the issue, this is a bit tautological because obviously machine learning is geared to predicting. So you're optimizing the level of prediction that you can possibly get from these geography constraints. So, it is not complicated to believe that you're going to get a stronger prediction if you're just maximizing predictive power. Comparing with the fixed elasticities like Nate's and mine or other sort of measures like the Wharton Index, Joe and others, you then interact to just look at the changes by year or by decade. You interact the level of elasticity by the national housing shock. What's the percentage growth in housing prices across different decades? Now, the problem is that the right, in theory, we'd like to control for local demand shocks. No, LA might have a different local demand shock than any other city. So why would you use the national prices? In other words, that makes me think about what's the real beta. There's two things going on. What's the beta of the housing demand to national housing prices? And then what is the actual other sources of demand that are specific to that city? Now, the most important thing in my discussion is that machine learning learns a lot. Okay, machine learning learns. Okay, it doesn't only learn about long-run housing supply side, or sort of geographic constraints, but it's going to learn about inefficiencies in housing price adjustments. We know housing prices are not efficient, so they adjust very slowly. Differences between short-term and long-term supply, a combination of long-run and short-run supply responses, because you're using these predictions at the yearly level. And then changes in the slope of the AMM bit rent curve. These are going to be learned by your algorithm, and shocks to city demand on the extensive margin. Why is that? Do this at home. And sometimes people tell you, don't do this at home. Do this at home. Try this. And I've tried with a number of projects. If you have two types of variables, a vector of variables x1 to x10 and another vector x11 to x20, you want to predict variable y. And you believe, or theory tells you, that the real predictors, the important predictors, are x1 to x10 using machine learning. You run the regression and you find, yes, I can do very well predicting this variable y by using these variables. And therefore, you tend to believe, well, there's only 4% to predict. This other set of variables is not going to be that predictive. But unfortunately, you run the same algorithm with the other predictors, and you find that the R square is also almost as big as the other R square. What's going on? No, you have like these theoretically sound predictors and these completely bogus predictors. They do almost as good a job as the real ones. Why this happens in machine learning? Well, remember that you can use these bogus variables or sort of irrelevant variables to predict y, and they're going to be good in as much as these variables themselves are good predictors of the actual set of other variables. Okay, so if you have a set of variables to predict that predicts well the actual explanatory variables, then you're going to have very good explanation in these machine learning techniques, which makes it very difficult using machine learning to sort of assert causality or knowing which set of variables is better. Because again, if this set of variables on the right predicts very well all of the demand side variables, in this case on the left, they're actually going to predict very well housing prices. So there's no deep sense in which these supply variables are not actually capturing demand variables. As a matter of fact, we do know from work from Jill Duranton and myself that if you look at city topography, you find that more constrained cities tend to be taller, they tend to be denser with less sprawl, they tend to have higher transportation costs, they have more green areas, they have higher baseline housing prices. So that already is implicit in the fact that you have more constraints. And these are demand-side things that correlate with demand-side shocks. But the ML also is smart and going to learn about the micro region. If you have tall mountains without the ocean, it might be the Utah. Whereas if you have lower mountains without the ocean, it's probably West Virginia. If you have mountains and the ocean, it's got to be California. So the algorithm is actually going to learn all of these demand sort of variables that you don't want to be there, but they're going to be there by looking at the shape of the different rings. You're going to learn about how big is the county, the definitions, the initial population. And therefore, once you have those, you really can predict almost everything in the United States and all around the world in terms of the demand characteristics of the city, the characteristics that drive the sort of the productivity and growth in the city and amenities. Now, you're using forecasts that at the annual level. So every year you're looking at sort of predicting prices. In my view, if you use a supply parameter, it's got to have a deep, it's got to be sort of like long-term parameters that change every year that don't correspond, I think, to something that we think is a deep parameter. So you'd need, I think, the paper a bridge between these forecast parameters and deep parameters. The most egregious problem is that on one year, you might have mountains predicting positively prices. On the other, the mountains predict negative prices. On the other, positive again. So if you, at the very least, I'd like to make sure that you impose constraints so that the cumulative impact of the year predictions adds up to the long-term prediction. So if I know that in 20 years, mountains mean higher prices, it cannot be that the coefficients every year add up to zero. So some constraints there. The other issue is that we separate predictions in housing prices to predictions in housing quantities, and obviously they should be related by economic theory. There's a section on demand controls, and forget that I believe that these quote-unquote supply side proxies are actually proxying for demand shocks. But even if I took at face value that these are supply constraints, they should be interacting with supply functions. As a matter of fact, demand side factors should not matter unless there's a supply constraint. If you have plenty of land and there's no differentiation in the quality of land, there shouldn't be any impact of increased demand on supply. So there's got to be an interaction there. There's no interactions. You're just flagging in both the supply and demand functions there. But you can look at it from the other way around. Supply should not matter. Why does supply matter? If you have in West Virginia, we have plenty of cities with a lot of constraints, but they're not growing. They're not growing. Quantities not growing in prices. Why is that? Because there's not. So why should supply matter without any bearing on the demand shocks? You gotta have some kind of interaction there for these things to make sense. Okay. I would go to the Louis paper. It would take me another 15 minutes. Suffices to say that a proper specification for housing supply has to relate to changing the law of housing prices, changing the law of quantities. It is fine to sort of like to instrument quantities with income or something like that. The problem with income is that it's completely endogenous to housing prices in equilibrium, especially because of sorting of highly skilled individuals on more expensive cities. But you could still do it. But at the very least, if you do use a reduced form, at least use some kind of instrument for income. Something like a Bartik or sort of the initial share of people with bachelor's degree. And then the problem remains that how do you interpret B2 here? If you have that interaction, and then what is the coefficient of why is positive? Why you have cities with more constraints have higher prices or lower quantities, unless the national shock in quantities is more relevant than local shocks, in which case it still validates the current measures. Shapley values, I'm not going to go, again, the fact that these variables are very likely capturing other demand variables makes interpretation of Shapley values a little bit complicated, because Shapley values tell you whether you're a good predictor, not whether you're a causally right predictor. You can be a very bad predictor because you're easily predicted in turn by other variables. So overall, it's a great paper. My only really concern is it's less is more in this case. It seems to me that you have a very nice paper with different measurements. It updates sort of well-used sort of measurements. And I'm wondering whether you really want to engage in all of these sort of more descriptive sort of regressions. And so there's two ways to go. I think you'd rather keep it as a smaller sort of descriptive paper that's going to be super used and going to make you famous, or I would encourage you to work on a model that really nests a structural supply-demand sort of equations with proper identification, where you have intensive margin that's sort of driven by transportation costs, like the AMM, the bit rent curve, and extensive margin where you have people moving across cities. But again, very useful paper. I really appreciate it. Thank you.
All right, we have time for questions.
So I agree with almost everything that Albert said, and I urge you to take that seriously. I would think, particularly on the construction of the measure, that the ML is dangerous, and that what you're doing with the leave out thing satisfies very little of us in terms of convincing us that this is clean, because of the nature of the correlation between different American housing markets and what happens with them. I think the right way forward on this, and if you want to think of what we're contributing with this, is you have better measures of the geography. So we've got much better stuff than Albert did when he did his thing. And then you want us to think a little bit about like why the nature of the geography might matter depending on how it's shaped. And like the AML is adding to that. And I would start, instead of throwing it at like a fancy algorithm, I would start with the economics. I would start with like a couple of hypotheses about why certain shapes of slopes are going to be different than certain other shapes of slope. And then I would be testing that off of one time period. I'd be focused on predicting quantities, not prices. Quantities in general are much easier to predict with this stuff. And then if you establish, 3 or 4 things that you think are really important things to add, which is like, just don't do the 50-mile radius thing. Do it if you're, do it this way in the 1960s, then you can start rolling it forward. And something that sort of is we understand the physics of why this matters in this way, and then you can roll with it. But something where you're just going to sort of train like heck on something, I think that's going to be very hard to satisfy anyone, quite honestly.
So I want to say congratulations to Chandler and to Ben for, the literature should move toward this direction. And it's also nice to see how this paper moves across different stages. I also want to echo Ed's comment on the caution on the using the machine learning in this case. We know that using machine learning can increase the prediction precision, but there is also a classical trade-off between the bias and the noise, right? So I would like to push you to do a side-by-side analysis to see, how much able to use R-square, how high I-square can be improved by using machine learning, but also very importantly, how much more bias it introduced, because that's the necessary trade-off, right? So, going back to Ed's comments on thinking about the nature of those, the water and amenities and how that could be correlated, with those demand shocks. I think one potential danger is that we are going to see these machine learning predictions is going to give you the under bias systematically in high or lower income area. And that's going to cause the issue in terms of identification and causal analysis. So, in the paper Nate, Abdullah, and I had on the rental mobility, we face the same challenge. And there is a way to control for that, which is using de-bias methods. But in order to use that, we have to see where the bias come from and, from what direction. So that's what I would like to push you. And maybe one more word on Bomb, Snow, and Han. I think the strength of that paper is try to explore the within city variation. So when we think about Chicago, it's not about Chicago city as a whole, but more importantly, different neighborhoods, right? How that responds to the same shock. Thanks.
Okay, let me also say that I second a lot of what's been said so far. There's also something that really got me confused at the beginning of the paper. My understanding of Albert's work back in the day was that we need some exogenous supply changes to estimate the housing supply elasticity. But to estimate the effects of regulation, we need to know how those regulations affect the amount of land that would be otherwise available that is made unavailable. And then we multiply by the coefficient, well, assuming there's no heterogeneity. So I don't think this was done very, very clearly. So this is what we need to do. And actually, this is where your data contribution could come really into the picture by showing us what is the amount of land that is truly unavailable versus the amount of land that should have been built, assuming it's not too far inside the city, whatever, you look at the shape, that has not been built. And in that case, that would be, well, a residual that we could potentially attribute to regulations in a plausible way.
Yeah. Well, I'll send it back.
Yeah, I also think that there might be some scope to use some sort of other country as as a way to instrument. It seems like a lot of Albert's criticism is this kind of like circularity of the prediction, and it feels like some of the literature where you can instrument imports to the US with imports to the UK, and they're kind of similar countries, and that might neutralize some of this. But
shaking his head.
Albert disagrees.
No, unfortunately, we did this for 14,000 cities in the world, and you find these patterns. Actually, these are deep parameters. You can, like, these geographic constraints do predict a lot of the shape of the city's density, income, so on and so forth.
Defer to you.
All right, do you want to take 3 minutes to respond?
No, I thank you, everybody, for the feedback, and Albert for the comments. I know that the paper is quite provocative. On the machine learning stuff, obviously, we thought a lot about this. And, I do think that the out-of-sample cross-fitting has more to it than you all think. And also, when we do spatial permutation tests, we find that the t-statistics are actually still quite large. So, like, the other thing is we can control for a lot of things in these regressions for whatever housing amenity demand factor you want. And when we do that, we essentially find that, the coefficients still hold. If I do, like, one of the things that we didn't mention in the presentation that's in the paper is that all of the construction of the LUMO indices is based on out of sample of the housing market itself, not necessarily even just like the polygon itself. So when we do the zip code and census tract level results, it's out of the housing market. So if the results all go through there, as you'd expect, it's kind of validation for the approach. In addition to the fact that I think, I'd have to go.
No, it's not, because Phoenix is similar enough to Las Vegas that you are not an out of sample. No.
I mean, you're out of the housing market according to the OMB.
You're learning about a highly correlated thing.
I guess, but actually the land unavailability in Phoenix is actually quite different. The demand is the same, but the supply constraints are different. I can look it up after this if you'd like. So I think this is one of the problems, is that you all think we're learning about demand when we're not. If you look at the coefficients, when you control for the standard proxies for housing demand, or give me any proxy you want. We control for amenities, we control for college share, we control for income, we control for everything, and the coefficients go through. So I understand the hesitancy, but if you just look at the case versus of Chicago versus Las Vegas, if you look at the existing proxies that do this standard thing, you're going to get a result that is wrong. So, I mean, I'm not saying that our result is
Everyone thinks you have a lot to contribute. That's not what you
okay. What I meant to say is that the machine learning approach can uncover these things that standard approaches cannot. And I think that's one of the key advantages of that approach. And I do also think that since we use different methods, so both a supply index and a quantity index, we can do a lot of the things that Albert suggested, and I think that we have done so in the paper. In terms of the micro supply, we also do the micro supply and find the same results. In terms of interacting with house price growth, everyone in the literature, including a lot of papers published by very talented people, interact the size proxy with either house price growth or mortgage rates. There's very little correlation when you do that. And the idea is that if you have a decline in national mortgage rates, you should see an increase in construction in cities that are less constrained. You don't really see that in the data. With our measure, you actually see that. And that's why we have the price pressure index, is to identify those expectation effects, which you should expect given differences in supply across cities. Like Lou has a paper that shows this, for example. So I appreciate the hesitancy, but I'll try and, go back and see how I can incorporate the comments. But I think for the most part, and this again is going to be provocative, so I'll just keep the theme. I think we've actually thought about and addressed most of the comments in this room. Thanks.
All right, thank you. We're going to take one more very quick break, then we'll be back at 4:10.
Everyone would be happy. It's like the housing economy sales.
Okay, so that's.
All right, thanks everyone. We're gonna get started here. All right. Our last paper of the day is Sophie Calder-Wong, The Price and Distributional Impact of Flood Risk Disclosure, Evidence from U.S. Housing Platforms. Take it away.
Okay, thank you for the organizers for including this work in the program, and thank you for sticking around towards the end of the day. This is joint work with Steve Billings, who is there, and Wei-Ling Liu, also at the site, so they will be responsible for all difficult questions afterwards. So today's talk is about understanding the price and distributional impact of flood risk disclosure using data about using evidence from online housing platforms. Okay, so as you know, flood risk is increasingly important of a consideration for home buyers. Yet actually accurate property level forward-looking assessment of flood risk is actually not that easy to assess. Damage-wise, it's quite substantial by various types of accounting. They will estimate in the dozens of billions of dollars how much it costs to US homeowners. One major source of information is these pre-existing FEMA floodplain maps, and it tells you whether you're in a 100-year flood zone or 500-year flood zone. But the key distinction is whether you're in the 100-year floodplain. At that point, you're becoming required to purchase flood insurance if you get a mortgage that is federally backed. So that becomes sort of the major salient pinpoint that people have among all this potential information that they could try to assess. Now, over time, given this lack of granular information, I think some of the online housing platforms have taken essentially the matter into their own hands, and they started displaying these property level flood risk characteristics that is offered from First Street Technology, or formerly First Street Foundation. In 2020, August of 2020, Realtor.com is the first one to display First Street flood factor on the listings that are available for sale on the online platform. Fast forward to February 2021, Redfin.com started displaying that as well, actually on all listings, including both active and existing homes. Also, fast forward to September 2024, Zillow.com started including that information in the app version of Zillow.com. And then I believe in early 2025, they made it available across all web users. But a year later into it, in November 2025, they actually quietly removed it. Our understanding is this is following complaints from the California Regional MLS. So if you're like me, who uses Redfin.com as some sort of entertainment and daydreaming about other people's home, this is a listing. This one is near the beach, not on the beach, in Miami. And if you scroll down a little bit, you're going to see there is a block about climate risk. And the first one is about flood factor. So you'll see it says 9 out of 10 flood factor, estimated of 80% plus chance of flooding reaching the building in the next 30 years. If you click this button, it's going to say, hey, you got a 9 out of 10 flood factor. This is under the category of extreme. Maybe this year it's not going to flood, but over the next 5 years or 10 years, or if you look really ahead, the chances of flooding is pretty high. If you ever bother to keep reading, this is also saying this is actually FEMA Zone X, unshaded. What that actually means is it's actually not in the 100-year floodplain, it's in the 500-year floodplain, as confusing as it is. But at the end, it does say, based on your estimated FEMA zone, flood insurance is not required. However, FEMA always recommends considering insurance. Okay, so this is basically a property that is not technically in the 100-year FEMA flood zone, and therefore insurance is not required for federally backed mortgages. Yet by First Street account, the flood factor is pretty high. This is under extreme flood risk, and most likely that some water is going to reach your footprint over the next 30 years by their model. So as you can imagine, being slapped on an extreme flood risk on your property is going to have some impact on your property value. So this has also generated a fair amount of media attention. So what is the research question? The first question is fairly straightforward, which is basically saying, hey, what is the price impact when such new information become widespread and available to home buyers? And this is a type of disclosure, I should say, a little bit different from traditional disclosure laws. This is actually becoming available at the initial stage of housing search when people sort of starting to look at the housing that is available. So in order to answer this question, what we're going to do, which I think is a pretty nice feature of the research design, is that we uncovered a mapping from the underlying continuous measure of flood risk that the model has produced that is then used to turn into a discrete flood factor that is 1 to 10. So we can use these cutoffs to essentially infer what is the information what is the role of this information on the price. Our estimate is that comparing a home that is basically labeled as flood factor 9 or extreme versus a home that is labeled as flood factor 8, it leads to a 3.3% price increase. Now, importantly and interestingly, we find actually much larger and stronger effect in coastal areas. So this is up to 11%. And also we find stronger effects outside of these designated flood zones, FEMA flood zones. So this is saying this perhaps is an information that first people do pay attention to if they're in coastal areas. And number two, they do pay attention to, especially when this is not in the flood zone already. Following on the price effect research design, we can also look at, hey, who ends up buying these homes that are disclosed to be riskier? So there we can combine the data from CoreLogic with HOMDA as well as L2 voter registration data. And we basically find that the buyers of these homes that are disclosed to be riskier compared to those who sort into slightly less risky homes, they are on average lower in income. They are slightly more likely to hold an FHA loan. So it looks like they are basically slightly financially more constrained buyers. The demographics show they're slightly older, but in terms of partisan affiliation, we actually don't find strong result. If anything, this is insignificant, even if I stare at it. Lastly, we can try to do a bit of a calibration exercise to say, hey, now that you found after disclosure, price have gone down, the people who sort into these homes are lower income. Is it really because they have heterogeneous preferences that are correlated with income and push them into these homes? Or is it just driven by the fact that prices of these homes are cheaper and therefore, only the higher income folks can afford to pay to avoid this environmental disamenity? Okay, so there is obviously a important and growing literature about the pricing of climate risk. Much of it concerns the role of FEMA, some of it about insurance design. I think we very much contribute to this literature. In addition, some work on the digitization of housing market, as well as sort of a question of climate justice. I should say, we view our contribution as providing a credible estimate of the price effect from this large-scale property-level flood risk disclosure during the initial housing search. For those who are not familiar with this literature, there is an interesting paper by Fairweather et al. Where they actually did an RCT at Redfin where they randomized information to a select group of users. So guess what is found there? This is basically they're finding, hey, if you give people information about flood, it really affects their search. So we view our paper as a natural complement to their paper saying, hey, what if you don't just give a randomly select group of people information, we give this information to the entire market, what is equilibrium price impact? And that also allows us to look at what is the equilibrium distributional and resorting after this information disclosure. Okay, so going ahead, let me tell you a little bit about the setting and the data. This is a timeline. Everything prior to August 2020, before Realtor.com started displaying flood factor, is going to be the pre-period. The time period where Redfin was running their RCT, as well as a 6 month after their initial wide disclosure, we're going to basically exclude it. And then after 2021 of August, this is going to be all post-period. Like I said, there is this Zillow disclosure that started in September 2024. Our analysis is not sensitive to whether we include or not include this last 4 months. Okay, the data, it's going to be a combination of the usual suspect, I would say. We will start with CoreLogic in terms of transactions. We then combine that with First Street's essentially parcel level measure of their modeled risk of probability of flooding and depth of flooding, so severity of flooding. There is a quantitative measure of actual expected flood depth, as well as the mapping to the numerical categories from 1 to 10. We also get the FEMA flood map designation through that distribution as well. To the extent we can, we will combine that with the HMDA data. So this is going to give me the subsample of those with mortgages. We match on name and addresses to the voter registration data. So we will know the number of members of household who are registered Republican, Democrats, or independents. Okay, so this process ends up with about 25 million households in the data set. And the HMDA data set is a subset that has mortgages that we can match with, and the voter registration data is the subset that we have voter and their addresses and names that we can match with. One interesting feature to keep in mind as we go forward is that out of this 25 million transactions, vast majority of them have a flood factor of 1. So basically, this is not really subject to flood risk. The remainder of the 20% of properties is subject to various degrees of flood risk from 2 to 10, and it can also be under the category of minor, moderate, major, severe, extreme. The last column shows basically how likely the fraction that is also in the FEMA 100-year flood zone. So as you can see, the higher the flood factor, obviously, the more likely you're going to be in the 100-year flood zone, but it's neither necessary nor sufficient, right? So there are properties that are flood factor 10 that are not in the flood zone, like the one that I was daydreaming about. But then there are also these ones that are in the flood zone, or these flood zone maps are pretty coarse, but by their measure is actually not very high flood risk. So this is, I believe, a map of Tampa. If you plot the FEMA flood zone designation, it's sort of black and white. There is a clear zone that is in the flood zone and a clear part that is not. The middle part is a golf course. And then the remainder, this is the same plot, but for the same set of properties, I'm plotting the First Street flood factor. This is basically various shades of orange, anything ranging from, I think, 3 to 10 in this case. Now, so what are we going to do with the price impact? The usual research design would consider first a diff and diff, but as you would imagine, a diff and diff could be subject to various problems. Number one, to the extent that climate risk has become more salient, people care more about it. I'm going to find, a more negative price over time. There could be correlated amenities, ocean views. Let's say they become more valuable over time. That's going to bias me the other way. There could be other concurrent changes, for example, the risk rating 2.0, and that's also going to affect properties that are of greater flood risk more over time. So what we're going to do is we're going to instead use the RD design, where we're going to basically use this mapping from a continuous underlying risk of flood, which is called expected flood depth. And then we find that this is actually mapped cleanly to the cutoff. So this is, I guess, what you're looking for. On the x-axis, this is a log of flood depth, and the expected flood depth is simply the probability of flood times the severity of flood, and you sum over all the probability distributions. And on the y-axis, it's the First Street flood factor. 1 is basically 0, so it is out of this picture. So it goes from 2, 3, 4, 5, 6, 7, 8, 9, 10. And I guess the identifying assumption is that homes that, let's say this is the 8-9 cutoff, the ones that are right below the cutoff versus the ones that are right above the cutoff are otherwise identical, other than the displayed flood factor, 1 being 8, 1 being 9, or 1 being under the extreme category and 1 being under the severe category. Okay. Now, we think it's very unlikely home sellers or home buyers can, in this case, home sellers can manipulate the displayed flood factor because they don't even know how this running variable is constructed in the first place. We also, given the fact that we have a panel data, you say, hey, Sophie, what if there's some unobserved factors that drives the choice of the cutoff? We can also use a differencing RD design. So as long as these unobservable factors that are contributing to the choice of the cutoff is not time varying, I can also difference that out. We do the usual things of covariate balance and what have you now. So this is the identifying assumption from the differencing RD. So what do we get? Again, the same plot on the expected log expected depth. This is the 8-9 cutoff, and this is the residualized sale price. And you see a clear jump at the cutoff, and the magnitude is about 3.3%. However, as I said, there is important heterogeneity. So if you look at coastal versus non-coastal, the estimate for the coastal subsample is about 11%. So this is actually very, very clear from our data. However, if you look at the non-coastal subsample, like you don't really find anything. People don't seem to responding to a flood factor of 9 when they're not seeing the coast at all. You can also cut this further by whether they're in the flood zone or not. It turns out as long as you are in the coastal area, whether you're in the flood zone or not, they both show up. In fact, if anything, if you're outside of the flood zone and you're in the coastal area, the estimated coefficient is like 16%. This is actually the largest estimate. Once you leave the coastal area, if you're in the non-coastal area, whether you are in the flood zone or not, although there are not that many of these, so basically outside of the coastal area, we don't really find anything from this RD design at all. Okay. You can say, hey, what is so special about 8 versus 9? Well, not really. So you can also look at 7 versus 8 or 9 versus 10. It turns out at every one of these cutoff, you find a comparable estimate. I should say what this is also saying is that people, well, I didn't show you, but for CAC cutoffs that are lower than 6, so if you look at 2 versus 3 or 3 versus 4, we don't find anything. So it's not like people are responding to every single cutoff. People are only responding when the disclosed flood risk seems to be sufficiently high, okay? We can do various additional checks, say different fixed effect, different ways to include controls, or maybe not do this difference in RD design or completely exclude the Zillow period. The price effect from the RD design is very robust. You could also ask, hey, is the number that you find economically meaningful, or what could be a benchmark to compare this number with? So it turns out that First Street also provides an estimate of loss. So what they do is they take historical data of flood depth and flood damages, and then they basically build that mapping, and then they use that mapping to apply their projected loss, right? So future scenarios, they will have different projected flood depth, and then they will project out the loss. So if I use their average annualized loss data, by the way, this information is not freely displayed on the platforms. You have to click into First Street and then become a paying customer to get this information. But if we use that information and compare the 8 versus 9 homes, the average difference annually in terms of loss is about $7,000, which is quite high if you think about it. And even if I apply a conservative discount rate of 5% and looking at just a holding period of 9 years, this is already accruing to about 10%, 9.3% of the MPV of the home value. So you can say, hey, your average estimate of 3.3 actually seems quite low, but I would argue this actually just masks the heterogeneity, because in coastal areas, this magnitude is somewhat comparable. It's in the non-coastal area that it seems that this label doesn't really register and is not really being reflected in the price. Okay. Now you can say, hey, I can put price as outcome in your research design. I can also consider other outcomes. For example, the income, the verified income that HMDA collects when you apply for a mortgage. Here, what you have is still this cutoff at the 8-9 flood factor. And you see the people who basically choose the homes that are disclosed to be riskier are on average lower in income, in this case 5.3% lower in income than the household who sort into the homes that disclose to have a lower flood factor. If you do the same subsample split, let's say looking at coastal areas and looking at coastal areas outside of the flood zone, you basically find the same kind of pattern that mirrors the price impact. They're stronger in coastal areas, also stronger outside of the flood zones. So this suggests that after disclosure, you have price effect, but there's also a redistribution of this environmental risk to, on average, lower income household, right? So this is what this is saying. We can also do it for other characteristics. This is a little bit noisy, but you do find that they're on average slightly more likely to get, I shouldn't say slightly, it's just the statistical power is not as strong, but it's about 1.8 percentage point more likely to get an FHA loan. You can also look at age. They are slightly older. Older folks are more willing to sort into higher risk homes. We do not find effects on demographics such as race and ethnicity, whether you control for income or not. Interestingly, or perhaps it is what it is, in our setting, we do not find significant effect based on whether the household has more or less registered Democrats or Republicans, okay? And this is actually also consistent with the Redfin RCT in that they didn't find strong effects in the search based on the registered partisanship either. So, so far, our reduced form analysis has shown that this disclosure seems to have shifted high-risk homes towards financially more constrained buyers and also on the margin, slightly older buyers. To make some sense of this result, in particular, trying to decompose how much of this reallocation of flood risk by income is driven by price changes versus, say, heterogeneous preferences for flood that we can estimate from observable characteristics, we will attempt to calibrate a discrete choice model. So this is a very lightweight modeling exercise. So this is just to say the utility of household I for housing unit J is going to depend on the price, is going to depend on whether it's labeled as extreme risk versus severe, and there is some control for the underlying flood depths. The price is going to be differentially sensitive by household income, and in particular, you might posit people who are lower in income are going to be more sensitive to price. And then in terms of sensitivity to being labeled as extreme risk, we can allow this to vary by age, or we can allow this to vary by has registered Democrats or whatever you want to throw at it, okay? Now, the estimation part of this exercise is that we do have micro level choice data. We know which household actually purchased which home. So that actually allows us to pin down these heterogeneity parameter in terms of preferences that are heterogeneous by observable characteristics. So for example, we do have a tight estimate of the parameter in front of price by income, where a -1 shows that lower income ones are actually going to have a larger in magnitude price coefficient, and they are therefore more price sensitive. You have a positive estimate in front of age saying, hey, older folks are more tolerant of risky homes, and a slightly negative coefficient in front of the registered Democrats saying they're slightly less tolerant of risky homes, although this coefficient, as consistent with the RD result, is not significant, okay? I should also say the mean coefficients are not identified, and we do not pretend they are. We will just calibrate it. The key point is that the decomposition of the reallocation risk is not particularly sensitive to the mean coefficients. So what do we get? We are going to do not a full counterfactual. This is just a simple decomposition. What is the nature of decomposition? The nature of decomposition is I'm going to turn off the price effect, or I'm going to turn off the heterogeneity in people's preferences for disclosed extreme homes. And I'm going to basically compute as I turn them off one at a time, how does it affect the covariance between the income and the riskiness of the home that they live in? The reason this is called Shapley decomposition, this is just saying I can turn them off in different orders and they can have nonlinear interactions, so I just take an average of them, okay? What do I find? What I find is that the majority of this reallocation of risk into lower household income seems to be primarily driven by the price effect. It's when I turn on and off the price estimate that is really driving the change in this correlation. Age contributes a little bit because in our data set, at least in this mortgage sample, older buyers are actually slightly lower in income. So if they prefer risky homes, that actually also contributes to this reallocation. Political affiliation, in this case, Democrats in our data are on average lower in income in our sample. So if anything, this actually pushes them away from these riskier homes, so slightly offsetting the price effect. Okay, so I think I'm good. To conclude, hopefully this paper provides a credible estimate of the equilibrium price and distributional impact of flood risk disclosure on these housing platforms. We hopefully convinced you that this difference in RD design is novel and useful, and it finds notable price impact, especially in coastal homes and outside of flood zones. Distributional wise, when this information becomes widely available, the ones who sort into these higher risk homes are actually lower in income. The reallocation of risk through the lens of a discrete choice model seems to suggest this is driven primarily by the price change, aka households who are down, who are only wealthier can afford to pay to avoid this environmental disamenity. A little bit of taking a step back. At some level, you could view this as a somewhat of a trade-off between informed decision-making and environmental justice. This is in no way to say this is not allocative efficient, right? Like you're giving everyone better information. They are making better informed choices. Households are just trading off between how much they pay and how risky of a home that they purchase. But I think it does bear this environmental justice question. More broadly, what this paper hasn't done, and I think this is left for future research, is what is the impact on the stock of existing home sellers? I don't have the data for this, but some of you may have it, as well as what is the impact on new construction, investment in adaptation, as well as insurance demand. So we'll leave that for future work. So that's it. Thank you.
Great, thanks. And our discussant will be Abby.
Hi, everyone. So thank you so much to the organizers for asking me to discuss this super cool paper. Let me just get right into it. So this paper's jumping off point is that climate change is increasing the risks of a number of different kinds of natural disasters in ways that are pretty obscure to the general public. And modeling that risk and sharing that risk with the public can enable everybody to make better choices. So that's a plus. But at the same time, any new map is going to reveal that some houses are riskier than we thought they were. Some houses are going to lose prices, and that's going to generate pushback. We see this basically every time any kind of new map is developed, people want to repeal it. But we actually don't have a ton of work about how much these asset values are reduced, and in particularly whose. So I think something I really, really liked about this paper was that it kind of dove into the distributional impacts of this important step for climate adaptation. Okay, so so this paper is doing kind of two things. One is it's looking at the aggregate effects of a flood zone label on house prices. And as Sophie referenced, there's a very long literature looking at the impacts of flood zone labels on house prices. One thing she didn't mention is that many of this work so far has looked at specifically designating an area as a FEMA flood zone. And it'll look at like FEMA flood zone X disaster or FEMA flood zone X disclosure requirements. But I think this paper is super nice in that it looks at the effect of a risk label that's not kind of jointly changing insurance mandates or insurance prices or building codes. That label is, of course, going to be embedding or signaling certain things about the insurance prices or the building codes to the buyers. But I think that this is a nice kind of first step at isolating it. And as Sophie mentioned, this is also presenting this information kind of at the point of browsing, as opposed to previously, this was something that you had to kind of dig into and look for. So I think that's super cool. And then on the distributional impact side, the literature here is, I think, fairly light. We do know that low income and minority households tend to sort into flood zones. But we also know that the highest risk locations have wealthy residents too. And I actually want to show figure from this Chin and Voorhees 2026 paper, because I think it's a really nice motivation for this paper. So what they're doing is they're taking really granular census data, and on the x-axis is the income percentile of that household, and the y-axis is the share of the households that are in the FEMA flood zone. And what we see is that flood risk is very bimodal. You are more likely to be in a FEMA flood zone if you're either very wealthy or very poor. We probably think that the right-hand side of this graph is like coastal amenities, but that's still, we still want to unpack what is driving this like left-hand kind of peak. So that is what this paper digs into, and they do a really nice job of it. This paper has many strengths, really granular data, and a very clever regression discontinuity design, and they combine that with a demand model, and we find the punchline: labeling risk lowers prices and attracts lower income buyers. So super cool. I want to share a couple of thoughts about first the regression discontinuity results. So first, just comparing the magnitude of this headline result, we see that the extreme versus the severe label reduces sales prices by 3%. I actually thought the heterogeneity here was super interesting. This 3% is kind of incomparable to other estimates of the effect of a flood zone label on house prices, but this heterogeneity, the 11% discount in coastal areas, that's really pretty big. And also the fact that non-coastal areas see basically nothing. So I think it might be cool to kind of explore a little bit more, like what the implications of that are. Like, what else can we learn from that? Okay, then looking at the distributional side, we find that the extreme label attracts buyers with 5% lower income. Now, to the best of my knowledge, the only previous piece of evidence we had on this was a study looking at FEMA map updates after Hurricane Sandy in New York City, and that found that using census tract level data, there was no change in income if this area was remapped to a flood zone. And so here, I think this is highlighting a really, really good strength of the data, which is that this granular buyer data allows us to actually see this change in who is buying houses after this risk label has been introduced. So I think that's a super cool contribution as well. One thing I want to flag about this design is that there is a possibility of a violation of the stable unit treatment value assumption. So we might think that this risk label is reducing demand on the right-hand side of the cutoff, but that demand is being shifted to, a house a couple of streets down that's like very similar. And so that's increasing the demand on the left-hand side of the cutoff. And we could be overestimating the direct impact of the label. One thing that could be done to kind of get a handle on whether this is a big deal or not would be to look at heterogeneity across areas where there's more versus less close substitutes, if that's something you can kind of quantify. I also think you can do some work on the modeling side of things to address this. So you could assume a fixed supply of houses and require market clearing. You allow households to choose from all of the houses in the market. My understanding is right now you're just looking around the boundary. But I think if you do that, you like model the equilibrium, you can account for substitution across locations. And I think this, in my paper with Anna Russo, we faced a very similar problem, and it turned out that the overall impact was a factor of 3 less than the direct impact. So it's just something worth thinking about, I think. Okay, the other thing that the model is actually trying to do is unpack the taste versus price channels, which I think is a super cool exercise. Excuse me. One thing that surprised me was that the model doesn't actually allow income heterogeneity in preferences over flood risk. So it's an allowed channel that richer households are younger and younger people have more distaste for flood risk. It's not allowed that richer households of all ages have more distaste for flood risk. And I think it would be nice, if possible, to try and estimate this explicitly. I know it's challenging to do that and have the heterogeneity and the price elasticity of demand, but I think it could be possible. If it turns out to not be possible, I think it might be nice to augment the heterogeneity with education in addition to age. I think education could very easily be correlated with both wealth and taste over risk. So I think that would be worth adding. Okay, you already covered some of these possible extensions, but I think that one thing I want to highlight is that it might be nice to dig a little bit more into the distributional impacts. That's like where this paper has really big contributions. Who currently is like the holder of these assets that are being devalued? What is the distribution of the devaluation across the income distribution, especially accounting for this heterogeneity, this coastal risk? If we're finding that all of the drop in value is like on the right-hand side of this graph, it's like the rich, people on the beach in Naples, like that's less of a concern than if it's, a lot of, kind of low-income households. I also think it might be worth thinking about how this devaluation is allocated across homeowners versus renters, because it's got very different implications if you are a low-income household whose primary asset is being devalued versus if you're a renter and your rent is maybe going down. Okay, I'm gonna kind of, in the interest of time, skip the last couple of things, but overall, great work. And yeah, very cool paper. Thank you.
Questions, comments? We'll start with that.
So this is neat, Sophie. Where are you, Sophie? There you are. Hi, Sophie. This is really neat, and it's the magnitudes are interesting. This is my biggest idea here is I think you should run a survey. I don't know how you get current home buyers, but I want to know what they say they know about like this flood risk, what they think they know in terms of it, how much do they think it's going to cost them? What do we think we learned from various things, right? So actually unpacking, making the sort of information element of it more real, and also understanding, like you can also elicit preferences. Like if you thought this was, I mean, you need to be smart about this, but like you can figure out how different types of people think this is going to impact them in different ways. And I think that could deeply inform, like when you go fishing for heterogeneity in the actual structural work, having it match up in some sense with what you think you've learned from the surveys, I think would be great. I think ideally you're learning from the home buyer. I think that's you're learning from the home buyer, and like you've done an information treatment. You could even like walk them through a fake home, and you can ask them what you think this means, and like you could do like there's lots of ways to do this. You need to spend some money, but you're Wharton, you should be able to do that. That's a and I think that should guide some of Abby's ideas about heterogeneity, which were great. I think the more discipline like a survey will bring that to them, both in terms of like who's going to learn more, but also who's going to think they have to pay more. I mean, otherwise we're just kind of making it up. The second thing, which I think is just like and this is all I'm going to say, is isn't there something intrinsically useful about like the time on the market relationship with the price relationship that helps you get at something completely unrelated to the shock, which is like how much do price drops cause markets to undergo? And I think it might be worthwhile. This is like the old Jenisoven-Meyer kind of question of like guys leaving their houses too long or not long enough on the market when prices go down and markets getting all gummed up. I think there's probably something to do with that is uses this as a natural experiment and then sort of uses that to inform like how does the stickiness of sellers change, and how does price drops slow down the functioning of markets?
I was wondering how, like, I didn't understand how to reconcile the null effect that you have on the non-coastal zones with the model. Maybe there is nothing to say there, but I was just trying to interpret that. And I did a quick Claude search, and it seems that Redfin has also released you have the same discontinuity for fire risk. So I would be very interested to see that, especially with what's happening in Spain right now and in Canada and other climate risk factors.
Thanks. I thought the contrast with Pari Sastri's job market paper would be super valuable and is worth mentioning. So she also looks at the effect of new information about flood risk, but she finds exactly the opposite effects on composition. She also looks at composition, but the results are easy to reconcile because she's looking at information that affects the lenders. So the FEMA flood maps change, the lenders have to change what's going to be covered and what isn't. and the lenders start to credit ration and screen out low types. And so what's left bearing flood risk in her setting is because of the lending channel, and it ends up being high types. In your case, it's a negative demand shock from the high types leaving that pulls in through lower prices the low types. And so it's operating through like demand versus lending. Seems really consistent, but helps us kind of complete the picture of how changes in flood risk information affects the composition.
Yeah, so I found like others, the difference between the coastal effects and non-coastal effects in some ways really surprising. Because if I'm a home buyer and I'm Bayesian and you tell me that the home that's on the coast with waves lapping at its door is extreme flood risk, like I don't update my priors at all. Whereas if you tell me like the little house on the prairie is like secretly in the floor of some ancient riverbed and is going to flood, like I update my priors a lot. And so I'd almost like expect more of an effect in the non-coastal areas before seeing these results. And so I was wondering if you just could maybe dig more into like, why is it that non-coastal buyers just seem to not care at all about this flood risk? Like maybe all the actions happening at the lower thresholds, or maybe for some reason it's just still not salient for them that their home is now extreme flood risk. Yeah.
That's great. You can survey that too. You can do different things.
Really, let's see if I can read my own scribbles. Don't beg for a citation, I think was the first thing. Oh no, hang on, that's for myself. Thank you, Abby, for citing I think what's really interesting is the consistency of your estimates with the estimates that we had for Ireland. And the fact that, so there was the flood information maps were released, and there's about a 4% discount from going from moderate to severe risk. So I think there's something in there. But it goes to Ed's point, we did survey prospective homebuyers, and off the top of my head, the number they gave was an order of magnitude greater. As if when you asked them, they said, "Oh, if it's at flood risk, I'd pay maybe a third less." And so there was something going on between what they said and what they actually did in the end, and that may be to do with housing scarcity. But I think we can chat after about that. I think my main comment was, or suggestion was, you're looking at an interesting period. You're effectively looking at pre-COVID and then post-COVID before the return of the let's get back into the office mandate. And I wonder if the preferences of buyers in that window are slightly different. You're talking about the potential correlation between, say, the amenity, the blue space amenities and flood risk. And I'm just wondering, it's not about the internal validity, it's more about the external validity of the people buying at the time. And I had a suggestion around that, which was, if you, given the data set you have, if you had listed price and transacted price at the time, so you get listings before the information is released on the websites and the sales afterwards. We did this with energy efficiency information, and you find that people price it in. So it doesn't show up in the listing price because the listings are there before, but it shows up in the transaction price. You're really kind of getting a neat estimate of buyer behavior. And that would be a very specific subset, and just a discontinuity in a different way. But really interesting work. Well done.
So neat work. I'm always happy to see more good work on the National Flood Insurance Program. The thing I worry about with these papers is that these flood maps are also used to hand out subsidized flood insurance. So I wonder the extent to which the price effect could reflect could be confounded with the subsidy for flood insurance. Right. I think you can identify that because you'll know whether they're in the 100-year floodplain or the XX zone or whatever. The second thing is that falsification tests take every observable thing you have about the houses, predict prices, and do your RDD on those predicted prices, right? And that's a really nice way to summarize. It's nothing else. And then the third thing is Bayer, Ferrer, and Macmillan, the school district paper, people sorted. And so part of the price effect across school district boundaries was from sorting, not from school district quality. And it seems like you have maybe some of the same issue going on. But great work.
Take a minute and a half to respond.
Okay, great. Thank you for the very helpful discussion and taking a step back. A couple of things perhaps worth thinking through, and I think maybe this is Matt's last point. At some level, we we agree that there may be treatment control contamination if, half of the neighborhood is labeled more risky than the other half. There is going to be a reallocation of demand from one segment to the other segment. It changes how you interpret that estimate. But I think I would still ascribe this to the information impact, right? So now, how do I decompose this further into direct versus indirect? I would agree with you. Without a model and actually market clearing, that would be the more difficult task. And it depends on the nature of that contamination and how much of each type there is. So I completely agree. In terms of a clarification, maybe backwards, Matt's point, I guess the benefit of using First Street data is that it is divorced from the FEMA flood maps. Having a high flood factor score does not come in with any obligations to take out insurance of any kind. And to my knowledge, insurance companies do not use First Street data to price insurance either. So they're kind of a correlated measure of flood risk, but it is not actually fed into any of the other back-end things that you would be worried about. And so I think in some sense, we isolate this information piece at the home door.
Tech aren't using the resident information to tell them how to do their flooding, right? Like whether it's reported on your thing, right?
To my knowledge, the insurance companies are not using these models. Yeah. But they could change their ideas, of course. And if these models are better than their internal models, they could have some correlation. But to my knowledge, this is not the case. And then, Abby, we probably should have included income in the second term. This is actually at the top of my to-do list. Now, to give some assurance is that for the Redfin RCT, when they look at how the information treatment changes home buyers' search behavior, they do not find higher income households change their search more so than lower income households. So that's probably part of it, but to the extent that other correlates map and project onto the income, I think that would be the useful thing to include. So yes, thank you.
One of my small comments is that I looked at their paper and I couldn't find any exhibits that were showing that. So
in the older version, yeah. But I agree with you regardless, to the extent there are other correlates that should also be controlled for. That's it. All right. So yeah, so I'm happy to answer more questions and clarify, but thank you for all the feedback.
All right, that concludes our day. Thank you to all of the presenters and discussants and participants. We are going to go to dinner for those of you who have signed up at Batifol. I'm probably pronouncing that wrong. Batifol is at 291 3rd Street. Google Maps says it is a 14-minute walk. So we are going to gather downstairs in the Hotel Marlowe courtyard at 6:10. So 6:10, and we will all walk over to dinner. And I'll see you then.